and even deeper. We're going to look at AI's disruption patterns and how it impacts your world, how the current conditions of the world impact the state of finances and the economy. Whether you're returning or new, you're in for a treat. Let's jump right in with part 2. How is this disrupting interns? I know you said with interns, those are free jobs, but like people coming in from the industry, entry level. Like I would imagine if you're coming into the industry now and they're training kids in AI, people have AI courses in college. So you can come in with like an AI degree, or you can come in really training AI. So you don't need an entry level job. Is that affecting like how you're hiring people? And then for Main Street, the breakdown between analysis is technical versus fundamental.
Yeah, sure. Well, I'll do that first part first, and then maybe ask me the second part so I don't get too sidetracked. But you were saying like the hiring stuff. Look, I mean, I took an AI for healthcare course at MIT in the summer of 24. I was really interested in applications for healthcare. I learned a ton, but honestly, we're headed to an era where everybody's going to be a programmer, right? Where you'll be able to just tell your box, hey, I'd like to see this. Can you write the code that does this? And it will probably be able to do that. We're probably 3 years away from that.
3 years.
Well, I mean, for people who don't know anything about coding, it's already open source and really efficient on writing new code. And our team is really good at that. But look, to me, the way the people that we hire, I mean, I have a small firm, right? So what can we offer? Content, they have to like doing analysis on the stock market. People, they have to like the people they're working with and for and interacting with. Autonomy, so the ability to think about what they want, when they want, or maybe control their own schedule. And then, some area under the curve to make money. And then the last thing people care about is brand. So we don't have that, right? So if you're somebody who's like, I got to work at Blackstone, I got to work at KKR, I got to work at Morgan Stanley, then what do we offer versus them? We could probably pay more, or they get to interact with more senior people than they would if they worked there. And they have a little bit more control over their life. At the big firms, my brother's getting married in a month. Can I have off on Saturday? And they say no, right? So there's a little bit more schedule, but what we don't have is brand or whatever. So we sink into the fact that you're going to interact with senior people more, you're going to learn more, you're going to see more clients, and that we can pay just as well or more. And so I think that's usually enough for people. People want brand, or they want a big kind of class of people that they can interact with, then we can offer. So it starts with the human stuff, Marcus, on the hiring front for us. And then the AI skills, I'll tell you a funny story. When I was at Morgan Stanley, I had this incredible woman who worked for me with the greatest resume I've ever seen. Okay. I mean, this woman went to, went to Yale, was a Fulbright scholar, spoke fluent Mandarin, but she was Caucasian. She went to Yale Law School. I mean, this was incredible. And she left and I was bummed. So I told the HR team, I wanted someone who went to a not very good college and had not very good grades. And she said, what do you mean? I said, well, I want someone who's hungry like an animal. Okay. And the problem is we only hire people who went to the top universities and got great grades. And so they all want to, be senior when they're junior. Right. And I went to Michigan. I went to the University of Michigan undergrads. This is a joke. I don't want to offend anyone who's listening, but I said, I want someone who went to a bad school like Michigan State. That's a rivalry joke. It's like a UNC Duke joke or whatever.
Right.
But my point was we don't recruit at Michigan State, right? We only recruit at Wharton and Harvard and Chicago and Stanford, right? So give me someone who went to a totally fine university, but just not one of the best ones. Okay. And then I prefer someone who had bad grades. So he said, what do you mean? And so what I mean by that is I want someone who was like a track star or a musician, someone who was great at something, then broke their ankle. And so they had C's their first 2 years and A their last 2 years. So they show them the aptitude, but they present themselves as someone who had B's from Michigan State, like somebody we would never hire under any circumstance at Morgan Stanley. We don't hire people who have B's at Michigan State. We hire people with A's at Wharton, right? But I wanted someone who was an animal, who was I'm going to come in and I'm going to work my ass off because I'm going to prove to you that I belong. And so to me, you asked me a question about hiring, that's what I look for. I look for the person with a story, an aptitude, who's an animal. Okay.
Yeah.
And I don't want them to be, there's nothing wrong with someone with great grades from a great university, but I found the distribution of outcomes is skewed to the negative for me at my firm.
What you want to have is the hunger and the chip on the shoulder, not the pedigree, the chip on the shoulder.
I met a guy. It's funny you say that, Marcus. I met a guy. I also never told this story. And I do millions of podcasts. I've never told this story. I mentioned the phrase chip on a shoulder to a guy, and he pulled his shirt back and he had a tattoo of his chip on his shoulder.
Excellent. Did you hire him? Did you say come?
I made him an offer, but he turned me down.
Now you got a chip on your shoulder from that. That's pretty cool. Never heard before, Main Street. We let it.
So then the second question you asked before was, I'm trying to remind me.
The second question was, so this is more for like Main Street literacy, financial literacy. How people say, you'll hear people mention technical analysis, fundamental analysis. First, explain which one you're doing, and then explain the difference between the two.
Yeah. So I think for technical analysis is, people say, well, I look at the chart, right? They try to figure out either momentum, things that are going up continue to go up, things that are going down continue to go down, or mean reversion. They think it's going down, it's going to go back up, or it's gone up and they think it's going to go back down. And so it's all looking at charts and recent price action. It's price action only. Fundamental analysis is much more digging into what a company does. How fast can it grow? What products do they sell? What pricing do they sell it at to their peers? What are their margins? What are they doing? Are they good stewards of capital? When they make money, what do they do with it? Do they do a dividend? Do they buy back stock? Do they buy other companies? So fundamental is much more kind of an assessment of the business, its strategy. Are they implementing it? And technicals is much more just literally looking at the stock price and trying to predict whether the trends on the price will continue or not. Ultimately, in some cases, they end up correlating. A business that's doing well and gaining share and growing fast and expanding its margins tends to have a stock that goes up, and the technical picks up on that and buys it because the chart looks good. Or so they're not completely unrelated in terms of how maybe stock behavior is ultimately, but in terms of how people come at analyzing things, they can be completely different. I mean, technicians might not care at all about when the company reports earnings, or that, if they're good stewards of capital, the stock went up and they want to buy it because the chart tells them it looks good. That might be all they care about. And they typically would have a shorter investment horizon. A technician, they probably would buy something for a few weeks or days, whereas usually a fundamental person is saying, I think this is going to be a good business and I can hold it for 6, 12, 18, 24, or 36 months.
Got you. So it sounds more like a technical trader, a technical investor is more trading tendencies. But you were mentioning, when you were speaking about fundamental, right. When you were mentioning analysis, your fundamental analysis, you were describing bottoms up. It's also an approach from like top down, right? Where you look at the whole industry. Do y'all take the bottoms up, where you go from the company from the bottom and analyze it that way? Or do you take a tops down approach, top down?
So we try to do both. I mean, we don't have like price targets and earnings estimates for individual names, so it's not bottom up that way. But we look at every company, analytically. So it could be where the margins forecasted to expand, or where they forecast to expand more than their business model average. So it's always trying to like search ideas. I mean, what we kind of focus on in our core business, institutional business, is risk and risk management. Their equity portfolios. We do custom work there. Idea generation. So the ideas are where we think stocks could be outperform or underperform. Tech strategy. So we do a lot of work on tech, on technology companies, just because the S&P 500 is just so filled with tech stocks at this point. We do a lot on like management decision making, so analyzing the deals and buybacks and dividends and those kind of things. So the institutional crowd's very focused on that. I think for Trivector Research, where your listeners hopefully go to the website, there it's going to be much more big picture things, like what do we think the S&P can do per year for the next 5 years, and why you should say invest in the S&P, and what are the sectors and industries that we think have better estimate achievability or not. So bigger picture things. Most institutional investors, they run big funds, and they're not like looking for advice about should they buy equities or not. It's kind of a different animal. So, but listen, for $100 a month, anyone can just go to Trivector Research and check it out.
Got that right. And we'll put the link in there. You said use Marcus, you get a month free. I don't know if that was free.
Yeah, that's right.
But yeah, we'll put it in there. We'll definitely share it with our listeners and viewers alike. Yeah, it's good stuff. Very good stuff. So now, folks, when you hear people speak of research and you hear people talk about those type of things, Adam is broken down for you. Adam, I want to transition a little bit more into more about you, man. We were talking earlier offline about, you said you did your post-grad down here in Wall Street, South Charlotte, but you did at Chapel Hill. So tell me a little bit about that and what you saw literally with financial literacy. That's one of the big reasons for this whole podcast.
Yeah, I guess the root of that is I did a master's degree in something called biostatistics, which, back then, I was in Chapel Hill from 1991 to 1993. Really the only places where there were a lot of data were basically the credit card industry and healthcare. And so in the time, a North Carolina-based company called SAS Institute was the software folks used to ingest and analyze data. I was a statistics major in undergrad, and so I thought, well, this statistics applied to medicine, public health could be interesting. And so I got free tuition and a stipend to teach undergrad calculus and study in Chapel Hill. I ended up doing a PhD in statistics, but I never came back to UNC from when I was 24 years old till I was about 40. And I got a call when I was a U.S. equity strategist at Morgan Stanley from some fundraising guy in my early 40s at Morgan Stanley. And I thought, I wonder why they waited to call guys who graduated 20 years ago and live in New York City this long to ask me for money. Because normally in New York, you get asked way faster.
The IRS is coming for your crypto gains. But it doesn't have to be that way. With a crypto IRA from iTrust Capital, you can buy and sell your favorite cryptocurrencies with tax advantages. Even better, with a Roth IRA, your gains could be 100% tax-free. No account or storage fees, 5-star US-based client service, and tax benefits. It's the smart, secure, and easy way to buy and sell crypto. Don't let the IRS take your crypto gains. Start a tax-advantaged crypto IRA today at itrustcapital.com.
So I gave slower down here in the South, Adam.
I gave some money. I don't remember, but I gave a few bucks. And in my mind, it wasn't very much. And I thought, I'll probably never talk to this guy again, but good for him for hustling the call, young kid. See you later. But evidently, the amount I gave for public health was a lot. For Wall Street, it was not. And so fast forward, I flew down. I started meeting some of the professors, whether they're in maternal and child health or environment or nutrition or health policy or health behavior, whatever. I really found it uncorrelated to what I did for a living, interesting and rewarding. So fast forward at blah, 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 I ended up, being the chair of the board of the Gilling School of Public Health at UNC. And it really gave me a window into a lot about public health. And then in particular, it's a global school, but in particular, obviously a lot of knowledge about North Carolina and it's a very interesting state. As I started to tell you, Marcus, you got very high churches per capita and a lot of people who rely on the church for information. You got a lot of people who don't have access to fruits and vegetables and clean water and, good, maternal health advice, and then you also have like very rich people. So it's and then you got very different in the western part of the state is very different from the coastal part, both topographically and politically and, in every way. So it's a super, I think a great thing you're doing to try to get people's literacy up. I think generally the stock market's complicated and you're competing against incredibly smart people with lots of money and resources. And so you want to make sound decisions. And I'm a little worried about young people in particular who tend to put too much of their wealth into one particular, they don't have any wealth, and they make huge aggressive bets into crypto or one stock. And they end up with, kind of a view that it's that easy to do things. And honestly, I don't think that's a prudent way to accumulate wealth. We do on the trivector thing, we talk a lot about taxes and we talk a lot about fees and other things that I think can really eat at somebody's wealth over time. But for those listening who are just starting on their financial literacy, I would be consistent about it. I would try to put a little bit of money each month into some really low fee S&P long only fund. I would try to maybe trade a little with a small amount of money just to get used to it and then some low fee account. But I would not put all of your money into some fart coin or whatever and pray that it goes up. I think that's not a good way to establish, discipline in your career.
Man, that's great advice. Speaking of retail investors, you didn't particularly say this, but you said younger investors. You deal with institutional investors a lot. And I know that for a while, institutional investors just kind of laughed at retail investors. But if you look at like last year in particular, retail investors carried the market. Every time it went down, they went and bought the dip. And people just kept saying the retail investors are dumb money. How is that like the change inside the retail investor, the amount of money they've been putting into things? You saw a lot of it with like the Robinhood trader, quote unquote. Anyone not institutional, how's that influencing maybe even your research and how institutions are talking? Or they're starting to take notice?
Yeah, for sure. I mean, well, our clients include the large private wealth networks. So the biggest ones that are almost like institutions, all of them are Trivariate clients. And then obviously individuals, advisors there could also be Trivector clients. But you're right. I mean, the retail money was steadier, certainly in the March and April lows from 2025, acute fears on tariffs. But I think the way money is run now is different than history. Like so much more money is run high frequency. I mean, I'll give you some interesting data. I think something like 70% of all of options today are 0 day, and something like 70% of all 0 day options are retail investors. So
hold on, say all those numbers again real quick.
So 70% of all options are 0 day. So they expire at the end of the day. And 70% of all 0 day options are retail. So 49%, 70 times 70 of all options are retail investors 0 day. So you got a bunch of people out there who are making options bets between now and the close. I don't think that's a great way to accumulate wealth, and I think it's highly risky. But it's just an example of why you see really volatile performance in and around earnings reports. And I think institutional investors that are used to lower turnover are, seeing and observing a lot of that. There's a lot more ETFs than there are stocks. There's a lot of levered ETFs. And so you can see big moves in stocks that are, in those ETFs, whether it's Palantir, NVIDIA, Tesla, whatever. And I think the third thing that's probably underappreciated is just the way quantitative money is run. So most quantitative money is run.
Oh, you didn't see that coming.
Watch this!
Power, weakest, falls, money, driven, major, fraud, breathless, body, diamond, bones, wanna be it, wanna feel it. Feel it, rage, power, weakest. Rage, money, power, I'm big, 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 but I'm big, money, power, I'm weak, 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 but I'm big,
where there'll be a lot of leverage. So what that means is, let's say I'm running $100 million in my quant fund. I might have access to running it at 10x, and now I'm running it because I can borrow money from the prime brokerage firms and lever the bet. So now I might only be running 100 million, but really my balance sheet's $1 billion. And there might be 35 guys like me at one firm, and there might be 30 firms like mine.
1929.
Right, these guys run hundreds of stocks, long and short, with a very short investment horizon, 3 hours to 2, 3, 4 days. And so their impact on the market is massive because there's all of these firms that are huge: Citadel, Balyasny, Millennium, Schoenfeld, LMR, Bullridge, Volition, and Cube, 0.72, whatever. There's a million of these firms, and they all have 25 or 30 teams that are running money quantitatively, and they all have a 3 hour to 2 day investment horizon. And so sometimes they purposely don't play when the company reports earnings. They're only in when it's not earnings, price, liquidity, whatever. So the impact that this has in the market is also enormous. And so I think if you look at the quant money and the retail money with the 0 day options, like those are things that weren't the case 10, 15 years ago that are impacting price discovery all the time. And by the way, these people are doing incredibly well and making money doing it. So it's not like, some of the smartest people in the world with the, best access to information that are doing that. So It's just a dynamic you have to deal with. And if you have a big asset pool, permanent capital, and you care about taxes and you care about fees, then you have to kind of say, all right, I'm going to see myself through that kind of volatility to accumulate wealth over the long term. It's a different mindset than trading with a 2-day horizon.
That's a good That's a good breakdown. Also, inside that same move, you mentioned how much liquidity, or not illiquidity, I guess, the margins that people have on this money, how highly levered it is. So when these moves happen, that kicks in the algorithms, and that can just, where you see these huge moves, you just probably as investors just sit still on those days. I know we're running up on our time here. I want to ask you, what are you seeing 2026 that you already kind of anticipated, and two, that has caught you completely off guard with the markets in regard to the beginning of the year?
Stuff that's hard, Marcus. I mean, we do a pretty good job of trying to figure out who could benefit from AI, who could be disrupted. But I think you have to take the tact of, like, if a company has high margin, then a CEO is going to try to predict their employee and customer behavior and not pay that firm. So I'm not shocked when I see S&P Global or Gartner or MSCI or FactSet or consulting companies or software companies suffer because people are trying to get rid of them and they know they pay a lot to them. The part that's harder is when the president comes down and says certain things that impact, whether it's credit card caps at 10%, you see the credit card stocks go down, or when you see the stuff on tariffs or rolling tariffs and the metals move up and down a lot, or when you see stuff on the GSEs, so Fannie and Freddie, it was mentioned that maybe they have to buy back some mortgage-backed securities or whatever. When you get introduce volatility that way, that's hard to predict. And like, I've done a lot of meetings recently where people are saying what industry could be next, or how do we get in front of what housing? There was some comments about home builders and antitrust from the president a couple of weeks ago. Like, those things are really hard to predict, because I think quantitatively we try to look at where estimate dispersion is narrow, where people have some confidence in the estimates, and some industries, that people had confidence in the estimates have gotten disrupted. So I think that part's harder. I think the AI stuff's hard, but not as hard. I think most institutional investors say, Taco, like the Trump always chickens out, right? So let's not overreact. If he does something that causes volatility, we can still stay the course. But I think with the AI stuff, I have the opposite view. If the multiples are coming down, it's probably because they have a higher probability of being disrupted. And so we'll let the price action inform us a little more if we think the volatility comes from something AI related than we think it comes from something policy related.
Got you. And on policy related versus AI related, you said you were meeting with your investors this morning, some of your clients. Anyone mention anything with Iran or the tensions in the Middle East right now because the geopolitical issues going on?
I think only from the standpoint of what it could do to the oil price. I mean, energy has been the best performing sector in the S&P this year. That certainly caught people off guard. We took the 15 largest firms year-ahead outlooks and stuck them in at Gemini and ChatGPT at the end of December, the 2026 outlooks. And none of those people, none of these experts thought that energy or materials would be the best performing sectors in the market. One, I think it is prudent to do the opposite of the bulge bracket firm consensus in a lot of cases. And two, I think the energy move has caught people off guard. And I think that's how people look at the risk there. We've seen so much geopolitical risk in the last couple of years, and the wrong thing has been to sell U.S. equities as an aggregate thing because of it. And we could say, hey, I'm worried about stuff, but I mean, a few weeks ago, a missile got pretty close to Western Ukraine, like to Europe, to Eastern Europe, and the market was up that day, right? So I think people are in this sort of like, I don't want to. Worrying about geopolitical is it wouldn't have helped me make money or choose securities that much in the last 10 years, and maybe it will in the future, but it hasn't in the past. And so I think that's the mindset about it. I don't think there's panic selling about it at all. I think it's more, could it drive up an oil, a demand supply imbalance in oil, and what does that mean for input costs, or should I just own some more oil related securities? And that came up a couple times today already.
Gotcha. Exactly. Inside of that, with the geopolitical, we see where countries and the tariffs and things, just going back from last year, we've seen ex-USA, you mentioned that, outperform. These other countries are starting to invest in their own economies and make different trade deals and things that impact their government. They're starting to build their own defenses. So that's why you see when these missiles fly, those stocks go up, maybe perhaps part of the reason. But
European defense, people like European defense stocks, and they've liked them, and the same with the U.S. I think some of it's, kind of a government investment, and Trump's, view that these countries should defend themselves a little bit better. And some of it's, kind of where they are in the cycle. I'm on the board of, joining the board of later this year of a public European company. And it's been interesting the perspective that Europeans have about the U.S. I think it's changed a little. And so I think it could cause some fragmentation in the U.S. market versus non-U.S. I mean, people think the dollar's going to weak. Certainly, they've been pushing at our events. We do more non-U.S. equities over U.S. than any time I remember in the last 10, 15 years, whether it's European defense, as you mentioned, whether it's the European banks, which have actually been better than the big US tech stocks in the last 5 years, whether it's Japan, or new economy China or Brazil or whatever. So I'm hearing a lot more non-US from people. I think if people are going to do that are listening, putting a small, small percentage of money in some sort of fund, EM fund or non-US fund makes sense. But I think picking individual stocks there for most people is not going to be a great risk reward.
Got you. Yeah, and another region, South Korea, when you speak about memory, that stock market did extremely well last year.
Well, Samsung and Hynix are huge percentages of the whole index, though. So it's like the same conversation about SanDisk, Micron, or whatever. You got to remember, Hynix and Samsung are just massive percentages of the entire stock market there. So when memory goes up, the market looks good. But if and when memory rolls over, those stock markets will massively underperform. So that's just a levered memory.
What about Japan? You saw people speak of the Korean trade. I don't know if you can see where that played into your semis and trades, because that was a huge thing last year. I know I'm getting you pick your mind. You said you're 56 and go back in the time, but like Japan is outperformed as well. I know they're usually they're usually a country where the baseline is set for interest rates, right? People do see that.
Yeah, I think that Japan's historically been about, the yen and rates. But I just think individual investors are seeing more on the technology side there, more optimism about, of shareholder-friendly management teams. Again, if global MSCI is 65, 70% US stocks out of that 100, then if people are making like an equity, I don't think it's imprudent to own 10 or 15% of their total allocation of Japan equities. That's not crazy to me. I've been a little more cautious on EM equities historically, just because a lot of them are more geopolitical. And so I still think, somebody should own, a pretty sizable chunk of their equity exposure in the US. My comment was just more than I can remember. Institutional investors are favoring non-US or thinking that it won't be as correlated as it was in the past.
Perfect. Yeah, I know we're coming up. We got literally like 2 minutes, Adam. I appreciate your time today. If there's one thing you want to tell Main Street, tell them, and then let them know where they can find you, where they can see you, where they can reach out to Adam Parker.
Yeah, no, thanks for that, Marcus. My view is, that the industry that I'm in is filled with incredibly smart, hardworking people that have tons of resources. So, be humble about investing. If you make some money doing something, it's probably more luck than good. So try to be diversified and take too much risk, because I feel like I see too much of that. And yeah, I'd love people to come to my website, www.trivectorresearch.com. Again, it's $100 a month. We do we do monthly Zooms where people can ask me whatever questions they want. We publish 3 or 4 short 2-minute reads a week about what's going on, and we give people insights. So hopefully they'll find that valuable. I do CNBC once a week. I'm a CNBC contributor, and we obviously get quoted all the time in Barron's, Bloomberg, whatever. So you can see all that on our website. So thanks so much, Marcus. Pleasure to meet you. And thanks so much for including me in your.
Yeah, man. Thank you so much for jumping on, Adam. And if you know anyone else over there, CNBC, Wall Street, who wants to come down, have a conversation, tell them I'm open.
Okay.
Seriously, that's like as serious as I can get about that one. Main Street meets Wall Street. We're bringing some Wall Street smarts with some Main Street heart. Just really excited to have Adam on. You're welcome, Adam, to come back on anytime and speak, about anything you like. You got an open invitation. Main Street, we'll talk to you next time. Thank you. Thank you for tuning in to the Main Street Meets Wall Street podcast. We hope you enjoyed today's episode and gained valuable insights. Don't forget to check out the Wall Street South Journal for the latest updates and in-depth analysis on the financial world. Stay informed and ahead of the curve with our expert commentary. Be sure to join us next time for an exciting episode where we'll be diving into the cons of crypto with Clem Miller. You won't want to miss it. If you enjoyed this episode, please subscribe, give a 5-star rating, and leave a review. Your feedback helps us bring the best content possible. Follow us on YouTube, LinkedIn, Apple Podcasts, Spotify for more updates and behind-the-scenes content. Until next time, keep investing in your knowledge and stay curious. Remember, street heart combined with Wall Street smarts. In February 2026, the tech world faced its Lehman Brothers moment. We saw the SaaS apocalypse, a 48-hour window where hundreds of billions in software value vanished. As the market realized that the old per-seat model was being automated out of the system, but to truly understand why this happened, you have to look past the stock tickers and into the cold math of the ledger. I'm sitting down with David Snyder, of CIO of Journey One Advisors. David, welcome. Let's get straight to it. You lived through 1999 and 2008. Looking at the circular flow of capital today, where big tech is essentially funding its own AI revenue, is the SaaS apocalypse we just saw in February the final warning sign, or is it just the first domino in a much larger systematic collapse?
Well, I really think the market is way overdone how much old tech is going to be affected by AI. It's just the similarities are so strong with the late 1990s with the internet. Back then we had almost every industry was going to be disrupted and made obsolete by the internet, whether it was real estate, distribution, all the financial firms are going to lose out to internet trading. And so they really depressed the valuations dramatically. Like in drug distributors, there was no need for a distributor. And you had this incredible increase in valuations of the internet, while at the same time, lowering of valuations in all the industries that people perceived was going to be affected negatively. So today you have the same exact thing obviously, software as a service is the number one industry that's being affected, and the valuations have declined by 60 to 70% over the last year. However, my belief is that it's way overdone, just as the internet was overdone. Back in the late 1990s, a lot of those industries that people thought were going to be disrupted actually ended up surviving and doing very well. And the returns from March of 2000 for the next 10 to 15 years actually were very strong for a lot of those groups. For instance, the real estate investment trust, they were one of the best performing groups from March of 2000 in 2015. So today you have the same thing. So there's just too much enthusiasm for AI and how much it's going to disrupt, and how they don't believe these industries are going to be able to adjust to the new to AI and adapt it in their models. So we're seeing a very similar dynamics playing out. It's somewhat eerie that it's so similar to what happened in the late 90s, which would mean eventually that AI bubble will burst, and then all of the industries like software will actually increase in value as they go down, when people realize that they will benefit from AI.
Whoa. Yeah. So back to the 90s to 2026, and the big thing, I think, you said a lot of interesting things in here, but the big thing was the last thing that you see, the AI bubble bursting. That's very interesting. I mean, you're definitely on the other side of the fence with that one compared to most people, I think. You care to go a little bit deeper into why you see this particular bubble busting? I know most people say that history may rhyme, but it's not the same.
Well, it's every generation has a new revolutionary technology. Every secular bull market had a new revolutionary technology. We had the railroads in the 1800s, and then in 1893, Pennsylvania Railroad, Reading Railroad went bankrupt. They overexpanded. You had in the 1920s, car ownership went from 20 to 60%. The automobile changed the world, and however, they overexpanded, and we had the Depression. And of course, in the late 1960s, we had the first technology rally. And it was because of Moore's Law, and where integrated circuits were first mass produced. And it was an amazing new revolution, miniaturization of computers. And that all came to a bust in 69. And then, of course, you had the internet in the late 90s, which is a new revolutionary technology. So this is nothing new. This has been repeated time over time. Marcus, it doesn't matter how good the technology is. It's the human response to a new technology. So there's three factors. The first factor is the companies that are developing the technology and using it become over-enthusiastic. And so they invest more capital than they should in the short term. Their second mistake is it's called FOMO, fear of missing out. So they'll invest more than they should because they don't want to be left behind. And those are two on the corporate side that cause overexpansion. So we've had every one of the major hyperscalers say they are going to err on the side of overspending. So they're basically telling you they're going to overspend. So you have that, and then you have on the investor side, the investors have an insatiable demand for this new technology, and then they overvalue all of these companies. And so again, it doesn't matter what the technology is. It's those three factors I just mentioned, the human response to those technologies. In fact, I would argue the better the technology is, the more likely the bubble is going to burst. And what we know also is that these things, the bubbles burst in the first 5 or 6 years of a new technology. And so everybody is saying that AI is just in the first or second inning, just like they said the internet was in the first or second inning in 99, 2000. But they're right. It is the first or second inning, but a bubble burst. And then the internet grew when the bubble burst in 2000, internet still grew dramatically for the next 20 years. So it's just this interim period where people become over enthusiastic and overinvest. Investors also overvalue, and then the whole thing burst when just one little thing goes wrong to end that kind of perfect scenario.
Okay, so those are definitely interesting takes, contrarian takes for the most part. Like I said, I think some people would say maybe on the other side of that. So, even as I'm posing this question, I'm kind of thinking this to myself, because so we have these companies now. There are some of these are the greatest companies in the history of the world, correct? Like modern technology, you can kind of say that maybe. But I guess with all these other revolutions were happening, those companies were also like the greatest companies in the world at the time. My question is and I'm sorry to dig so deep into the AI bubble, but that's a big thing. My question is, how do you see the companies leading the way now? So you have the Metas and you spend Google, companies like that spending a lot of money on this CapEx compared to who was leading back then, Cisco, IBM, which ironically this old tech has come back into play. How do you see the leaders now compared to the 99, 2000 bubbles leaders?
Well, I think they're very similar. They're both all of the hyperscalers that are leading this basically have negative cash flow. They're spending every dollar of their operating earnings on CapEx. And so there is a big discrepancy now between earnings and cash flow. And we haven't had that discrepancy since the late 1990s, when there was also this huge increase in capital investment for the internet to, broadband and, all of that. So it's very similar. The market, and by the way, these cash flows are not going to increase much for the next couple of years. So you have to, if you really believe in these AI hyperscaler names, you have to believe in 3, 4, 5 years they're going to get a return on their capital, because they're not going to get it in the next couple of years. I mean, they even, the projections. In other words, they're still in the CapEx investment cycle for this. So it's very similar in the sense that they are spending enormous amounts of CapEx for this new technology. And if it continues, they're going to end up, the similarities are they're going to end up that they're going to realize they spent too much money on all of this. And then, of course, their earnings and cash flow will go down even more, because they won't get a return on investment that you're hoping for, at least not in the near term. But then what's very interesting, what happened in the internet is broadband prices dropped like 95% during the bubble burst. And that actually, ironically, increased the demand for broadband because the prices came down. So you could have the same scenario this time, where all this money spent on data centers, on AI, all drop dramatically in value, and that actually will stimulate the second kind of expansion, and even better expansion, because you're going to be doing it at very low prices. So, we have that. We have the competition with China. China is way more efficient on a dollar, per unit basis for AI, literally 10 times more efficient. in spending money on the internet. On AI. They're getting similar results for spending 30, 40, 50 billion dollars, and we're spending like 700 billion, and they're getting similar results. So it's what could happen is all the capital could chase the capital invested could move towards more efficient models. And so that's another possibility how it could burst. It could burst because the data centers, it's very hard to get approval. It's, not in your backyard, not in your backyard development. And there's all kinds of issues over water, over chemicals, over increased utility bills. The state of Maine just outlawed any new data centers, although the governor is going to overturn it. So, if you don't have enough data centers, it doesn't matter if you have a lot of demand, you're not going to be able to fulfill it. So there's all kinds of things that are possibly going to go wrong. There is just an IPO of a nuclear module nuclear power company that won't have anything up and running till like 2032. Valuation was just enormous earlier in the week. So the market is investing in something 6 years from now, when they will just finally have an operating system, which is just crazy. And who knows if, the politics change, Democrats are not in favor of nuclear power. If Trump loses in 28, Democrats could come in and put all kinds of regulations back on nuclear, and they may never ever, come close to meeting so we have all of these crazy scenarios happening, just like it happened in 99, 2000. So, and the other thing, Marcus, is every cycle this happens. So in 2007, before the financial crisis, Blackstone, the biggest leveraged financial, private equity company, went public 2 or 3 months before the financial crisis, sucked everybody in, and then the whole thing fell apart. You had Coinbase went public in April, May 2021, right at the top of the Bitcoin, the crypto bubble. You had in 99, you had 2000, you had Priceline, and the biggest IPOs came in 99, right before the internet bubble. So what I'm waiting for is we now have SpaceX, Anthropic, and ChatGPT, all $1 trillion or more valuations are going to go public in the third and fourth quarter. And so I don't think the AI bubble is going to burst until they go public, because that will suck in all of the money into those 3 companies, and then the market will go down afterwards, just as every other cycle. That's the way it happens. So that will be the top when all those go public within a few months after, most likely. That's worked in historically. That's the way it's worked. When you go bring the biggest players public right at the end of a favored industry.
Wow. Yeah, those are some eye-opening facts right there. Some ways to go back and just analog with the past, and it definitely is similar as far as it goes. I would say so with the hyperscalers, and I argue, and I tell people this, like Apple's one of the best companies ever, right? Apple doesn't spend a lot of money. They haven't spent a lot of money in this AI build out, and Apple's going to be, in my opinion, and don't take this as investment advice, anyone listening, for like a specific stock, but I think Apple looks like they're going to be the one that will come out on top, just based on their already user base that they have. They haven't spent a lot of money on CapEx inside of AI. So, and another thing is, I do think that with the AI, some of these big companies, like some of these huge companies that we hear right now, they're going to go away. Like they'll never be here again. And people are going to be amazed by this fact.
Well, you're right, because Google didn't go public until after the internet bubble burst. So some of those dominant companies occurred after the bubble burst. So we don't know who that's going to be. As for Apple, is just licensing the technology. That's great, but in the short term, but in the long term, you never make as much money licensing something as you do actually making it. So that's the negative, and they won't control their destiny with it, because they're always going to be licensing from somebody else. So I think in the short term it's good for Apple, but in the long term they're not making these investments. it's going to, and then of course with Apple, we have that we, with the glasses, we may not have, the phone might not be the center of our universe in 10, 15 years. So they have that risk. But as far as the AI, it is, in the near term, they will do better on a relative basis. So I agree with you there.
Yeah. And Apple also has all those services built in. I know my Apple Music payment comes out every month. You have also, but so thinking about in the same vein, so think about Apple and their multiple sources of income, which may be a reason why AI wouldn't sink this company. Google, Alphabet, right? They have a lot of things, different ways to incorporate money. They have YouTube, they have Waymo, which they haven't even put on the books yet, which I guess will have to play into the AI if that's going to be some type of driverless technology. And then even Meta with the Facebook, but they're spending a lot of money as far as hyperscaling go. Does the way that these companies are funding this, like Apple, it's a small percentage and they have a lot of other ways of making money. Google is a larger percentage. They still have a lot of ways of making money. But then you go to someone like Oracle, who Oracle has, not a whole lot of ways of making money. They were based on the SaaS model somewhat, even though they're into the data centers and they're into the software. So it's a layered question. Dig into it.
So first, the SaaS model, it's going to change to a value-added model. So there may be just some disruption in the near term, but these companies are going to learn to just sell their services as on a value-added basis instead of on a seat basis.
Can you expand on what that means?
Well, basically, these software service, when they sell seats, they add each unit, each person, a new employee is going to get a new seat, is going to be using all the products. So they're basically tied to how many people they add to their user base. And so with that being disrupted, they're now going to just do it, change to a model where they'll just charge companies how much they use on a value-added basis. So what should happen is they should see more revenue per person using it, even if they're not, you're not using, getting additional seats. So the whole model will change. Getting back to all those companies, all those other companies have divisions that will, they're not going to get in financial trouble because they do have the security of these other divisions to provide cash flow. The only thing I would tell you, though, is that the companies just mentioned are heavily dependent on advertising revenue, and especially Meta and Google with YouTube, and that is a highly cyclical industry. If you look in 2022, we didn't even have a recession, and all of those companies had big earnings declines. So, if we go into a recession, there will be that they won't have as much support because they're going to lose, just like in 22, it'll be even worse. They'll have much lower earnings because the advertising revenues will shrink in those other divisions. So then they'll even have less support for CapEx. So that could be an issue for them down the road.
Gotcha. Yeah. And so I'm glad you elaborated on, because I think from the conversation that we had so far, people may have gleaned that you were mentioning that these companies will go belly up, all of them, just if the AI bubble bursts, which we are going to get into if this AI bubble bursts. Let's talk a second before we get into what it will look like if this bubble bursts. How about you give people some signs that they should be looking for to see if this bubble is about to burst? What are you seeing that makes you just said a few months, a couple minutes ago. So what's giving you that time frame for a burst?
I think it's going to happen within the next 12 to 18 months. So one of the biggest signals is these major companies going public, Anthropic, ChatGPT, SpaceX, although it's not directly AI. That's a big, big warning sign. You have what could happen is, as I said, there's a lot of things that could go wrong. You're definitely going to get a deceleration. They've been growing CapEx by 50, 100% the last couple of years. It's definitely, even in the projections for 27 and 28, they're definitely going to slow down, although they'll probably raise those numbers. So there will be a slowdown, but there may be a point, you're going to look for, some kind of news where they're not getting, I don't think this is it, but the reports yesterday in the media about ChatGPT not meeting their goals on revenue. So if you get more of that kind of, commentary, that could be the tip of the iceberg to start. And it's all a vicious cycle. Once it's going to hit all the way back to suppliers, to the data centers, to the industrial companies that provide the electrification for the data centers. So everybody's tied into this cycle on AI. So they're all going to, if one gets hit at the top, everybody else is going to get hit, or all the way through the supply chain. So it can just be a vicious cycle on the way down. So there could be all kinds of things. There could be, the chips aren't, become so efficient, you don't need as much data center power, or just, all kinds of things like that could happen. But the biggest thing will be, in my opinion, they won't get the return on investment, and then they'll have to slow down their CapEx. I think that's going to be the biggest issue. Institutions are slow to change. As good as this new AI technology is, it's hard. You're talking about having, these systems ingrained in these corporations. To tear them out, it doesn't happen as quickly as people would hope for. When something like this happens, people are slow to adopt these new technologies. So I think that's going to be an issue nobody's really thought about, that it will take more time. Even if the technology is that good, it'll take time to adopt. So that, it's just going to be a slower, pace. I mean, I heard yesterday somebody on CNBC say that they hope that it does slow down, because that way it won't be, get out of hand. And I'm thinking, no. If there's any evidence of a slowdown, all the stocks are going to get hit really hard. It may be good for the long run, but it would be a massive sell-off if they all started to slow down their spending in the short term. So we're at a point of no return. I mean, if they start slowing down now, it's going to be a disaster. If they keep spending even more, it could, you're causing even more of a bubble. So they're in a catch-22 at this point, the hyperscalers. So so I think it's a very dangerous. So there are so many. You usually need a catalyst to get the market to go down, especially these hyperscalers and all the AI. So you need some kind of we have these oil prices staying really high. These are real companies, Marcus. So people think, oh, they're just going to adopt AI no matter what. Well, let me tell you, if oil prices stay high and we enter recession or just whatever slowdown, these companies have to cut spending. And people think they're not going to cut AI spending. No, they will cut AI spending, or they won't grow as AI spending as much as they were hoping to. So yeah, the overall economy can affect the AI spending. So, but oil prices today, just what did I see, rose $5 to like 104? I mean, it's 7 weeks into this. So it could really, that could be the catalyst down the road if that continues. So yeah, we have every measure we're extremely overvalued in the stock market. So, when you get to this level, it doesn't take much. You're very vulnerable to any kind of bad news because you're at such high valuations. And by the way, Mark, it's not just valuations. Everybody's saying the tech valuations are lower today than they were in the late 90s, which is true. It's really earnings. So earnings caused the collapse of the internet bubble more than the valuation. So you could easily get a 50% drop in tech earnings in a bubble burst. So right away, if you have a 50% burst 50% drop in tech earnings, and you remember the big bulk of tech earnings now with semiconductors doing so well. So you could see, if you have a 50% drop in earnings, you could easily see a 50% drop in the stock market, right? Because if you just stay at the same valuation level. So I'm not convinced just because the techs, and then you have the other industries like industrials, which support the AI. The industrials are trading at all-time high valuations. So it's not just tech that's causing the PE to be at 21. So you have a lot of other industries that are somehow attached to the AI revolution that would also come down dramatically. Marcus, this is so similar to the late 90s. It's almost too easy. We've had, too easy that it'll top, that the bubble will burst in the next 12 to 18 months. I mean, we've had 17 years of real returns in the S&P 500 of about 15%. That's exactly almost to the day. It's very within months of the 1949 to 66 bull market and the 1982 to 2000. Both of those are about 17 years and about 15 to 16% real returns. Real returns are 6.5% a year over the last 100 years. You don't have to be a math genius to know. If you get 17 years of 15% real returns and you average 6.5, the next 10 to 15 have to be like negative real returns, which is what happened between 2000 and 2009 when we had negative 3 or 4% a year returns or 3% a year returns. So we are, we're following almost to a script what happened that ended the 62, the 49 to 66 and the 82 to 2000 bull markets, almost to and the other eerie thing is the biggest at the end, it was the semiconductors. And if you notice, the semiconductors have been on fire for the last 3 weeks. Well, I went back and in the internet from June of 96 until March of 2000, the semiconductor stocks, the index went up 8-fold. From October, using that's 3.5 years, right? From using October of 2022 until today, which is about 3.5 years, we're up about 6.5-fold in the semiconductor industry, which is these are like the two biggest increases in semiconductors ever. But the parallel, 3.5 years, almost the exact same parabolic increases as back in the late 90s. And by the way, we had the same thing in the late 60s with semiconductors, had this enormous run, and then the bubble burst. So we have that parallel, which is just scary. And both of those bull markets, Marcus, in the last 5 years is when a new revolutionary technology came out. And back then it was the integrated circuits, the Moore's Law, and also the aerospace. So you had, now this is the same way. We had the last 5 years has been the AI, just like the last 5 years in the 90s was the internet, and the last 5 years in the 60s was integrated circuits. It's crazy how closely they parallel. And, also we have right now, price to cash flow is 28 times the S&P 500. That's the highest since the late 90s. We are the biggest discrepancy between price to cash flow and price to earnings since 99, 2000. Another incredible parallel. So we have just incredible, and then of course we have the parallels of the disruptions of every other industry going down, like software. And back then it was, real estate and what we discussed before, all the, so we have that parallel. I mean, there are so many parallels. It's crazy. It's just incredible to me.
Yeah. All right. Hold on, David. Let's pull up and take a breath for a second. There.
Okay.
You just gave Main Street a lot. People might be calling and trying to get out of all of their AI investments right now. Listening to this
right now, I'm not saying right now. I'm not saying. I'm saying within the next 18 months.
No, you're good. I understand what you're saying.
And by the way, Marcus, don't forget the biggest gains occur at the very end, and the biggest losses occur at the very beginning of a bear market. So it's very difficult to time. If it's
impossible to time almost.
Yeah.
I was going to say, just speaking back to the market. This market may be different though. I don't know. You've seen a lot of markets. Maybe all markets are the same. So you talk about resilience. And you mentioned China and how much cheaper they are using AI technology. We saw DeepSeek at the end of 24, if I remember correctly. And that was really like a Lehman Brothers moment for NVIDIA, if everyone remembers. It went really far down, but then it came back. And then we've seen, let's say, I'm just trying to think since DeepSeek, we had tariffs, which were, we saw what we did to the market. The market just moves different. And now we're in this Iran conflict. The market moves different. I don't know if it's the speed of information. I don't know if it's the retail investor. A lot of people invest in the market have never seen a recession, like they've never seen the market go down. So people are sitting here listening to you speak right now, David. Go back and tell them a little bit about yourself and your history and what you've seen so they know, like, pay a little bit of attention to this ghost whisperer we have on here right here.
Well, you're right. It seems different, but actually what's happened so far, Marcus, is exactly what you would have thought would happen. In other words, if I go back to March of 2009, when this secular bull market started, and if you had told me back then, Marcus, if you had told me, Dave, it's a new secular bull market, what's going to happen? And here's what I would have told you. I would have said, we're going to have 17 years of about 15 to 16% real returns of a secular bull market. It's going to last 17 years. And at the last 5 or 6 years, I don't know what the technology is. We're going to get a revolutionary technology that's going to capture the imagination of investors. And it's going to cause a bubble. And the bubble is going to burst. And the secular bull market's going to end. So that's exactly what's happened so far. So nothing that has happened so far wasn't predictable based on the past 2 secular bull markets before this. I mean, we're perfect. It's almost a perfect now. But what I will tell you is, if this lasts past next spring, then it will be different. Okay, then it will be different. But in those two, but Mark,
say that again for the listeners, David. What you just said.
If this secular bull market AI lasts past next spring, it will be different than any other secular bull market, because that would last more than 17 years. And the returns would still be, very high. But you're talking you're talking about how the market bounced back from tariffs, from the oil spike, from the Iranian war. But in the late 90s, Marcus, we had the Asian crisis in 1998, and that was very severe. We had a depression in a lot of countries in Asia, and we had the long-term capital where they almost went under. So people were shocked how we bounced off of that and came right back. 98, like that was a 20% drawdown in a couple of months, just like the tariff did. But we bounced back immediately. And we had in 96, we had a high yield crisis, and we had, different things happen, and the market would keep coming back. And people would say to me, Dave, this market's incredible. It just comes back. It doesn't matter. People just buy the dips all the time. Yeah, well, that happened for 17 years. And then after 17 years, guess what happened? The internet bubble burst and everything went on. So when people tell me, Dave, this market's different, it's resilient, we have everything that happens to it, whether it was the inflation spike in 22 or the, tariff, tantrum in 25, or the oil spiked to this in 26, the market just comes back. That's what happened. It's no different than what happened in the late 90s or the late or 60s. Only if it continues past next spring will I be convinced that this is something different. And I don't believe it will. This one thing we haven't talked about, Marcus, is productivity. Everybody thinks it's going to be the panacea, right? And it really hasn't happened yet. People keep quoting these huge productivity gains, right? However, we had negative productivity for like 4 or 5 quarters in 22 to early 23. So we have had increased productivity since then, but that's only because we have had a big, rebound from negative productivity growth in 22, early 23. So if you average that out, it's really not that great. Okay. And if you go back, I think I saw that after 20, productivity is only averaged a little over 1% a year growth after 21 and 22 until now. But everybody will quote you from mid 23 until now, and they'll say productivity growth is 2% or greater now. But that's just a function of a rebound from a decline. But here's the problem with productivity. In 2000, we had the highest productivity we ever had, 4.2%, I think it was. And the stock market went down, 15% that year. The economy went into recession the following year. My point is, it's not a panacea when it depends on the context. Productivity grew 3.2% between 2000 and 2004. That was higher than the 3% from 1995 to 99. Yet the stock market went down in real terms 4% a year from 2000 to 2004. So productivity growth was the highest ever, not the highest ever, but the highest in multi-decades from 2000 to 2004. And we had not so great economy, and we had stock market declines on average, annualized at about minus 5% on a real basis. So it's not a panacea. Even if we have a pickup and by the way, inflation went up in 2000 from 2.8 to 3.4%, even with productivity of 4.3%. So it depends where you are in the business cycle. If you're already close to full employment and inflation is starting to rise like it is now, the productivity is not going to save you. It didn't save us in 2000. So I don't think it's, we have no labor force growth because of the demographics, as you know, because no immigration and because of the baby boomers retiring. We have a decline in the labor force, out there. So that means you are dependent on productivity for growth. I don't know if you know, from 1950 to 2000, productivity grew, the GDP grew about 3.5%. And of that 3.5%, about 40% was from aggregate hours worked. About 1.6% a year aggregate hours grew. So you had almost 40% of GDP growth was aggregate hours. We can't grow aggregate hours now much, okay, because of the demographics. Aggregate hours are based on, how many hours the labor force increases every year. If you don't have increase in the number of people working, you're not going to grow aggregate hours. And with the demographics, it's going to be very difficult. So my point is, almost half of GDP growth came from aggregate hours work. Now, in the next 10 years, we're going to almost have no aggregate hours. So we're totally dependent on productivity. And so if productivity does it needs to grow, over 2% in order to get GDP at 2%, because you're not getting you're losing that whole other growth factor. So that's something that people don't understand. And so, yeah, you will, even if productivity goes up a lot, it's not going to offset the loss of aggregate hours growth that was 40% of GDP growth from 1950 to 2000. So
Okay.
that's a big, big deal that people aren't thinking about, overall. And also within that, Marcus, so even though aggregate hours grew 1.6% from 1950 to 2000, the number of the work week, the number of hours people worked declined. But because labor force growth was so high, it was greater than 2%, aggregate hours can go 1.6%. So if we continue this trend of people working fewer hours in the workforce per week, per year, right? That's another, if you have no labor force growth, that's really going to take a hit on aggregate hours, right? It's really going to affect it negatively. So this is a major force, and it's a big reason. I'm doing a big thing right now on how the amazing thing is that earnings, GDP grew like 2% a year last decade, but earnings grew like close to 10%. And nominal GDP, we already grew like 5%, but earnings grew like 10% a year. Well, if you go back to, last 100 years, nominal growth equals GDP. GDP usually equals earnings growth, very close. In the last 20 years, earnings growth in the S&P has been way higher than nominal GDP growth. And the only way they did that was through the labor getting less percentage of sales, right? They're taking away from labor. And now we have this K-shaped economy. You can't keep taking away the revenue, giving more revenue to the owners versus labor and capital, giving more money to capital and owners. You can't keep doing that because K-shaped economies eventually die. They can't grow anymore because if you have very wealthy people that have most of the wealth, they're not going to spend a high percentage of that wealth, whereas the 50% or lower income groups spend most of their income. So we know there's all kinds of academic studies showing K-shaped economies will suffer lower growth. So I guess what I'm saying is if we're going to get GDP growth by keep taking money from labor, sacrificing labor for profits, eventually that's going to turn on its head because the economy won't continue to grow. And we, as you know, I'm sure you're well aware, this is the most K-shaped economy ever in the history of the U.S. And it's dramatic between the haves and the have-nots. And that will, if it continues, will actually depress economic growth. So that's another big factor, which is also, Marcus, why you mentioned that everybody buys the dips, right? Well, here's the problem with a K-shaped economy. The wealthy keep spending and keep, as long as the stock market exists, there's more, I guess, economic growth has been more tied to the wealth effect today because of the K-shaped economy than any time in our history. So if you really do get a down cycle that stays down, so if the stock market somehow went down 20, 25% and stayed there for a long time, or whatever, you get the virtuous cycle, you get the cycle where it would actually affect the economy way more than in past bear markets. So in other words, a bear market is going to affect the economy more than it ever has. So that's another major risk. If we go in a bear market and recession induced, it's going to be really hard to come out of it because it's going to affect spending more than it would in other recessions. So we have that to deal with. But my whole point of bringing up this earnings growth growing faster than GDP is that if you're going to have these high valuations in the stock market, you're expecting higher earnings growth or more stable earnings growth. Well, how are you going to have higher earnings growth if GDP is going to be less than it was, for the last century without sacrificing labor? So we have that, big issue of how we're going to get growth in the future, right? With all those factors I just commented on.
Got it. So yeah, and that was a lot, and there was some salient points in there for sure. And obviously on the other side, we're looking at a new today while we're recording this. This will come out a little bit later, but this is presumably Fed Chair Powell's last meeting, right? So we have Warsh coming in. I think Tom tells us I'm down here in North Carolina, Wall Street, South Charlotte. Senator Tillis said he will allow the confirmation to go through the nomination up through the board. And so I know Warsh is more concerned with, he thinks AI is going to help the Fed in different ways. He's concerned about AI obviously destroying the economy, but he thinks it's a way that something that we have to embrace and it will possibly help us outgrow this economy. That's just such a diatribe or a divergence in the way that the world's looked at right now, because half of the people and the people in charge of our fiscal policy, by the way, and monetary policy think that we're going to outgrow this that we're at right now with the deficit. That's why they're looking to lower interest rates and reduce the amount of debt that we have so it's easier to service this debt that we're paying. And then they're praising AI for the productivity booms that it's going to bring. But as you just mentioned, AI and this productivity gains, especially when you see in the side of the earnings, the gap in earnings and real GDP, like seems like a formula for chaos. How do you see Chairman, well, I shouldn't call him Chairman Warsh yet, he's not the chairman yet, but how do you see Warsh coming in and affecting this? Because the Fed could actually, this is something they could actually play a big part in, like whether we go into a recession or not.
Well, his number one goal is to reduce the Fed's balance sheet. So if he does that, that would probably cause long-term rates to go up. But he is going to definitely try, in my opinion, try to lower rates. I mean, he knows what Trump expects of him. So every new Fed chairman has been tested in the first 6 months. And what I mean by tested, the markets have taken the stock market or the bond market down within 6 months or a year of when a new Fed. So he's going to get tested likely. So I think the test could be he's going to want to lower rates when he comes in. With inflation still actually rising, especially with oil prices high, the market's not going to like that. And if he is able to convince the rest of the Fed to somehow lower rates, the vigilantes in the bond market could rebel. In other words, the longer term Treasury bond market could sell off significantly because they think he's not going to be an inflation hawk. So that's how I think he might be tested, that he's being too dovish, or it could be that inflation actually goes up a lot and he refuses to hike rates. But so there's a big chance that he is tested within the first 6 months of his term, because for some reason the financial markets, like to test you. It's almost like a rookie in sports when he's on the first sports when he's playing as a rookie, and they test you, whatever sport it is. So I think that's a very, probable, not most likely, if it's going to happen, that would be the most likely scenario where he's trying to lower rates, and the market doesn't like that, doesn't think that that's deserved. Hopefully he'll, because the market, the Fed needs to restore their credibility. I mean, they've been calling for this 2% target inflation rate for 5 years. We haven't even been close to it. Mm-hmm. So they're losing for me and for the financial markets, credibility for the Fed is one of the most important things for long-term investors in all financial markets. And globally, they've lost all credibility by keep pointing to this 2% inflation target. And here's the problem. So, people are more educated in running small and large businesses than they ever have. They know what the Fed target is. So if you're a business owner and he's got this 2% Fed target, and you want to raise your prices by 3%, and you go, no, you know what? I'm only going to raise them 2%, right? Because if that's with the Fed, that's what everybody's going to do. So you keep your prices at 2%, and then inflation comes in at 3% every year, and then the Fed suddenly says, well, we're going to change our inflation target to 3%. Well, what's going to happen if you're a small business owner? You go, wait a minute, I only raised 2% because that's what you said the inflation target was. Everybody else was raising their prices more than me because that's how we got to 3% inflation. And now you raise it to 3%. Well, you know what? I'm not gonna honor your expectation of 3% because you didn't honor your expectation of 2%. So I'm just going to raise my prices 3-4% instead of 2%. So if you follow that pattern, you lose, not only do you lose credibility, but you lose having an influential effect on inflation, because you've lost the credibility, then becomes loss of influence. So it is a big deal. So he doesn't seem like he wants to restore that. So I don't, we'll see how it works out. But those are my views on the Fed.
Do you think the Fed stuck the soft landing?
Well, we still don't know. I mean, it's kind of funny because most recessions occur not when the yield curve is inverted, but when the yield curve inverts and then actually becomes positively sloped afterwards. So we're not totally through that yet. We had in 1990, we had a recession after the Fed. We had a big tightening cycle in 88, early 89, and then the Fed actually lowered rates a couple of times, and we still had a recession in 1990. So, you know, I mean, it is a possibility. You could still have a recession without the Fed tightening from here, if that, you know, the lag effects, you know, so that's still a possibility. But, you know, right now everything's on hold, which will probably be the case for at least the next couple meetings. So we'll have to see how that goes. But yeah, it's still a possibility. In other words, you don't have to have an inverted yield curve to have a recession. What you do need is to have a inverted yield curve that, you know, a couple years before, and then becomes positively sloped. So we're still in that time period where it could happen.
Gotcha. Yeah, and when David keeps mentioning invert yield curve, that just means that the shorter term investments treasury bills somehow are higher interest rates than the longer term, whereas you should get longer term money for taking a longer risk where people are holding your money longer. But that is usually a reflection upon the government or whoever's issuing that note for them to pay it back. So definitely a salient point in there as well. The soft landing is definitely something we'll have to see. Was inflation transitory? I don't know. We'll see. I think Warsh is walking into plenty of challenges already. I mean, Powell had COVID pretty much right when he jumped in, right? And Trump actually had started some tariffs back then. There were some tariffs going on. Like, that's when the tariffs initially started. They just stayed on through Biden's administration. So I think Warsh is definitely walking into some type of situation, to say the least.
And also, Martin, I don't know if we discussed this, but spending has exceeded income every month since the fall of 2024. So you can't do that forever. The savings rate's down to 4%. And even with all these tax refunds, which, by the way, came in lower than expected, the tax refunds, you know, real disposable income from the time the tariffs were put on until like January was negative. Real wages are really slowing down. So you can't keep doing that. You can't keep spending more than your income. You can draw down your savings to a certain extent, but I don't think investors are aware that we are spending. The consumer has been spending more than the increase in spending has been less than the increase in income for like a year and a half, and that's not good.
Yeah, it's definitely not good.
No. And
even as you mentioned, to go back a little bit further, when you were talking about the Fed's credibility and the 2% interest rate, and then, you know, they set the COLA, cost of living adjustment, off of what's PC.
Yes.
They set that, and that number is still coming in higher. They say our target is 2%. Maybe the Fed should say, like you said, that the target is 3%. That's where we're fighting with, and let business owners and Americans figure out, well, global community, because our rates kind of set the bar. Like, Japan sets the lowest bar, I feel like, but our rates kind of set the international bar as well.
Yeah, but
so maybe they should realize that. And then, what do you think would happen if Warsh came in, somehow convinced the board to just cut, regardless of it needing to cut?
That's where I said what will happen is the vigilantes in the bond market will sell off the long-term treasury bond. Yields could go to 5% on the 10-year treasury. And that would cause less economic growth. It would cause the stock market to go down. It would cause financial conditions to tighten. So it could have the reverse effect, right? It could actually have the reverse effect of causing financial conditions to actually tighten. So that's the big risk of him doing that. Remember, he can't control, although they can control through buying, through quantitative easing, buying, long-term treasuries, which he's going to do less of, obviously. But without that, the Fed has no control over long-term rates. So, it could backfire if he tries to do too much. But if he tries to lower rates, and the market doesn't want that. So, they're in a real predicament, a real catch-22. We basically have stagflation right now.
Yeah, self-inflicted.
Year over year, GDP growth was only 2% last year. So a lot of people
Didn't they revise that down?
I'm sorry?
Didn't they revise that down too?
Yeah, that was
GDP.
down to 2% year over year on a fourth quarter to fourth quarter basis, which is a big drop from before. So people comment that, the tariffs didn't really affect the economy. Well, first of all, it slowed the economy down because everything, if you look at, real GDP growth slowed down a lot. And then you had inflation higher. Everybody, inflation came down, but actually tariffs probably caused about 50 base, about, I don't know, maybe, a half percentage point increase in the CPI when it would have otherwise would have been. So, you do have that. We're still contending with, which is still kind of rolling off, but.
To say tariffs didn't cause any, like they weren't impacting the American people is very interesting, especially when you look at the fact that now we're giving back tariff refunds. So clearly some money was somewhere inside of tariffs, right?
Well, yeah, but they're going to go back on with all the different options he has. So the interesting thing, Mark, is whether who's going to get that money, or consumers going to get it, or the businesses are going to get it, or is it going to be, there's lawsuits all over the place now.
You took the words right out of my mouth.
Yeah, the corporations are getting it right now because they're the first ones. But how do we know? Does the consumer benefit because the consumer had to pay higher prices, which is pretty well documented. Just because. So what, Marcus? People didn't understand. So the inflation rate really didn't change much, right, after Trump took over with the tariffs. However, that doesn't mean tariffs didn't affect the inflation rate, right? So in other words, if the inflation rate stayed close to 3%. And so people say, well, the inflation rate didn't go up with tariffs. Well, that's not the way you should look at it, because inflation would have been lower if not for tariffs. So even though it didn't go up, it would have been like 2.5% instead of 3%, right? So that's what people don't understand, that it still did cause higher. And most of the offset to tariffs was lower oil prices last year. That was a big factor in pulling the CPI down, probably the biggest factor. Well, we're not going to have that this year, right, to offset. So it still had, the tariffs still had, people don't understand the no economics. Tariffs actually cause more economic slowdown than they do higher prices. So we're seeing that. We saw the Atlanta GDP tracker for the first quarter is 1.2%. So we just did 2.2% year over year, fourth quarter to fourth quarter. Now we're going to do 1.2%. So that's 5 quarters of subpar growth since the tariffs. So yeah, I don't know how people can say it didn't affect the economy and it didn't affect the inflation rate. Some of these tariffs just don't make sense. Vietnam. In Vietnam, shoes and things like that they make in Vietnam are literally 50% cheaper to produce in Vietnam than here. So if Trump puts a tariff of 20%, which is what it is now in Vietnam, how does that help anything? Because it's not going to move manufacturing of shoes and apparel, whatever, to the US, because he'd have to have 100% tariff in order to make it worthwhile to move to the US. So when you do a 20% tariff on Vietnam, all you're doing is put a tax on American consumers, because there's no benefit of trying to reshoring at 20%. Do you follow that? That it would have to be like over 100% tariff in order to get reshoring from Vietnam. So what's the point of having a 20% tariff? I mean, all it does is it's a regressive tax because shoes and are a higher percentage of incomes of lower income people. It's just a regressive tax in the U.S. It makes no sense at all, and increases the inflation rate.
Yeah, tariffs are definitely something that history's showing. And the Fed, even going back to the Fed, they just keep they don't speak about the tariff impact, I think, enough. Like, they just kind of say they keep waiting to feel it hit or see it hit. But the Americans and people, we know when we go out and shop that things have gotten more expensive since last year. And you can pull out a fancy chart and show us parts here and there and why. But like you said, oil was a big part of the deflationary pressures last year. Oil's going to be higher. The beef prices, going back to the tariff. So we had to change some of our import rules with beef, so we could get lower prices there. Where it's like we should already be sufficient here. It's just a mixed bag and this economic detox that they said we're going through at the beginning of last year?
Also, really important, and nobody knows, is non-defense R&D spending under Trump is gone down 25%. That has been the government R&D spending has been about 20 to 30% of productivity growth. It accounts for 20-30% of productivity growth in the last 100 years. So that is a big deal that nobody, now that's a little more longer term kind of effect, but you more than pay for federal government research, non-defense, you more than pay. Every dollar produces like $3, of income. And we have cut that by 20-25%. And so that's a major long-term negative effect on the economy as well, that people are not really aware of. So, there's other factors. But one thing I left out, Marcus, is the high yield market. The high yield market, even with the private equity getting hit, has actually stayed pretty stable. But I use the Bank of America option adjusted yield spread. That came down to basically match record levels in January of 25. And what that is a sign of complacency, extreme complacency. It was only that low in 1997 and in the fall of 97 and in 2007. And within a couple of years of that, months or 2 years, we had a major, major recession and bear market. So it's a contrarian signal when the high yield spreads are that low, almost 2%, low, 2.5% spread. It is actually a contrarian and negative signal that people are being way too complacent about credit. And we've had now 15 months since that hit in January of 25. So it's another variable that's worked well in the past. And so you have to be very aware when complacency on credit gets that high. And we're already seeing some things in the private equity market this year.
So that's yet another sign of the bubble.
Yeah, another sign of a bull market coming to an end. Yes.
So pretty much I can just set my timer for 2027 to like 2034.
Well, I don't know. The timing of this is going to be tough. I mean, it's going to be hard to know exact. It could be as late as the fall of 27. I don't think it's going to be past that. I'd be shocked. Okay. I'll be shocked.
David, so yeah, you're great, man. Sitting on here just giving all this great information. So we need to let Main Street know, because you saw these things coming, you predicted them, you've done this, you've called highs and lows for those who don't know. If you were investing right now, not particularly positions, how would you position yourself for what you see coming?
Well, the next 10 years, if you just invest in an S&P 500 fund, index fund, you're probably going to make very little money, if any, and especially on a real basis, on adjusting for inflation. So you're going to need to be more conservative. You may miss out on the next 6 to 12 months of this internet bubble, but if you're a long-term investor, it's worth it at this point. So you want to, if you're going to invest, you need to invest more in income-oriented stocks. And especially for the next couple of years, more of the income generating stocks that are not cyclical. So that would be one area. It maintains a decent amount of cash. And you got to be tactical. Tactical, I mean, when you do see the downturns, you start to buy. And because believe me, I've been in this 40 years. You're always going to get opportunities. It just happens. It's human nature. People get over enthusiastic, over greedy. So I would try to stick with, really good, high quality. You want to go to high quality at this point in the cycle. We're late stage of the cycle, and stick with good low valuation companies, stocks, and don't be tempted to try to jump into to the bubble stocks, the bubble this late in the stage, even though you may miss out in the next 6 to 12 months, because it's really difficult to time. Your question more is about if you're 10 to 15 year investment horizon. So
any horizon.
Yeah,
You can
that
break it down
would
for the
be better.
listeners.
So yeah, so it's very important to be more conservative at this point in the risk cycle. So yeah, that's what, bonds will be fine. I am not, I mean, I think bonds are going to have more difficulties because of the government deficit. So I wouldn't go too long in bonds right now. Although if you see a recession coming, I would up my allocation to bonds. I'd completely stay away from private equity right now. Wouldn't even go near it. Or I would stay away from the high yield market right now. Just way too much complacency. You'll get an opportunity within the next couple of years, believe me, when spreads widen. So yeah, so a much more conservative type of portfolio at this stage.
Yeah.
People are just completely, especially healthcare stocks. Healthcare stocks are really attractive again. They had this big run from July until December of last year, and then they gave a lot of it back the last few months. But you have companies like Medtronic, a blue chip medical device company that's been high return on capital, incredible franchise, and they're growing, close to 10% a year earnings, and it's trading like at 16 or 17 times earnings. I mean, this should get a premium because it's recession proof. They don't have a lot of drug exposure where they're trying to, medical devices, the prices actually are flattened down for most medical device companies. So they're not in the crosshairs of the Trump administration. And they, you got the demographics with, the baby boomers retiring. So, and it yields like over 3%, a dividend yield. So those kind of things nobody cares about when you're in a go-go market, but they will care. So that's where I would be emphasizing.
Got you. Okay. And so we can't sit here and stay in those positions for ever or forever long. What signs should people be looking for? Say they make the move, because that seems to be the problem when people try to time the market. Because you're talking about becoming clearly less, not getting out of the market, but taking less risk. So being more risk off.
Yeah.
How do you know when to put the risk back on?
But investing in more conservative equities for one, and staying away from all the risk private equity, high yield. Stay away from those for now. It will come. You'll get a chance, but now's not the time.
Can you expand on private credit and private equity while you stay away from that?
There was so much money put into private equity and private credit over the last 10, 15 years. And it just, when you have that much money, you're competing for capital, which means you're going to offer better and better companies that are running the private equity. They're offering better deals, meaning more risky, in order to get the deals. So if your private equity was doing, they were investing in companies and get 10, 11, 12% a year in private credit. You don't get 10, 11, 12% a year without taking risk. Okay. Because if the companies were that good, they wouldn't need to go to private equity and get loans at 10, 11, 12%. So that's telling you something right there. And there's just too much money. Anytime too much money, chases too little capital, you end up making deals that you shouldn't make, which is what's probably happened, especially in the 2021 timeframe, where some of this stuff is coming due. They were making really very liberal terms, a lot of the private credit and even private equity. So, and private equity is tied to the stock market. And so they need exits. And if the market's, this high priced and is vulnerable, they're not going to be able to exit as fast as they would like. And then the things they're investing in a high price right now. So yeah, I'm not a fan of those two areas right now at all.
Got you. And you also mentioned the move in healthcare. You said how healthcare had a run from like October until now. Something else that had a parabolic run that has come back down is gold. What are your thoughts with gold and metals? And I think we saw the basement trade, but maybe you didn't.
Well, you don't really know my view on gold. I don't invest in gold. It doesn't produce anything. But
no intrinsic value.
The biggest thing for gold is it's not correlated with anything. So people think it's correlated with inflation, right? Inflation in 22, the biggest spike in inflation ever, maybe except for the late 70s, and gold hardly did anything. Inflation peaked. The core inflation rate peaked in October of 2022. And gold actually then started going up, bottomed. The exact opposite of what you would expect, right? And so then it went ahead this amazing 3 or 4 year run, gold, when inflation was coming down, the steepest it's ever come down, except for the early 80s. So if inflation was really, if it's really correlated with gold, this past 5 years really did not work at all. But I have a really funny story about gold. So
Perfect.
I was at Morgan Stanley in 2002, and we had two really smart guys, and they gave presentations. And this is when gold was at the lowest. It was like $300 back then. It had been in a 20-year bear market, gold, since 1980 and 82, whatever. So one guy gets up and says, because we were trying to get out of recession in 2001, too. And so the Fed had really lowered rates dramatically. And he said, it's going to cause hyperinflation. He says, I'm buying gold because we're going to have hyperinflation. And so gold's going to do really well. The next guy gets up and he says, gold, I'm buying gold because there's going to be deflation. We're trying to get out of this deflationary period and the Fed's lowering rates, but they're not going to be able to. You can't push on a string was the saying back then. So gold does very well in deflationary periods as well as in inflationary periods. So so I thought about it for a while, and these are two great guys. And I thought, I think inflation is just going to be like it was in the 90s, 2.5%, 3% a year. So I'm not going to believe what they say. I mean, what they're recommending. So what happened? I was right. Inflation went up like 2.5% a year. The other two guys were totally wrong. The one that said there was going to be hyperinflation, the one that said there was going to be deflation. Yet, they made a fortune. Gold went up like tripled or quadrupled during that period. Where else can you be? So two guys were totally wrong and made a fortune. I was totally right and didn't make a penny. So that tells you about gold. There's no. I have researched it. People say really, low real yields. Well, we had the lowest real yields ever last decade. Gold did nothing, right? They say inflation. They say geopolitical events. Maybe for the very short term on geopolitical events, but there's no correlation in intermediate to long term. What's the other oil prices? Oil prices correlate with gold. Guess what? Gold tripled in the last 2.5 years, while oil prices went straight down. This is before February this year. Gold had tripled, while oil prices went straight down for 2.5 years, completely negatively correlated when everybody says they're positively correlated. So, and I also think, I know this is crazy, I also think that gold is going to be replaced by man-made gold someday. There's now
diamonds?
There's a company called Marathon Fusion that's a private company that's raised like 10, 20 million. And one of their goals is to produce through nuclear fission to produce man-made gold. I don't know if you know this, but man-made diamonds, which are really hard to detect if they're not real, have caused the price of diamonds in real terms to go down 40% since 2012.
Huh.
And so with all this new AI and stuff, we're gonna be making man-made commodities, not having to dig underground at some point. Obviously, it's still a theoretical and still way off, but it will probably happen faster than you can think. So that's another risk. But gold, I have done a lot of research on it, and there is almost no correlation with anything except for price momentum. If you buy it when it's up a lot, it's up, if you see it on a 20% move and you buy and you put a tight stop on it. And because when gold tripled in the last couple of years, there were only 2 or 3 10% corrections. That's it. So you never got scared out of your position, right? So it's just the best way to play gold is on a momentum basis. If it's going up strongly, you buy it with a tight stop. And so because there's no other correlation with anything. And by the way, fair value in the long term, fair value of gold is usually about 50% above the production cost. Production costs right now about $1,700, $1,750. So the fair value of gold is probably like $2,600. So it'll eventually get to 50% premium to the cost of gold. It may not happen for 5 years, 10 years, but if you're a long-term investor, I don't think it's a good entry point.
Got you. Are there any commodities that you like? I mean, you didn't like oil, you don't like gold, or any commodities?
I thought copper was pretty good because, it's tied. There's a lot of copper and, electrification and all that. So, and there's been some disruptions in copper production around the world, even before the Iranian war. So, yeah, I mean, I think we're short-term commodities look okay, but I'm never a big believer in commodities. Commodities over the long term, become less part of our economy. I think between 1800 and 2000, there were only 3 commodities that outpaced inflation. They were timber, fish, and I can't think of the third. But people say oil did not outpaced inflation from 1800 to 2000. Well, gold did. Gold did because when we off the cycle, the Bretton Woods. But so commodities over time, especially with AI now, that all we have is going to be less and less important, in my opinion.
And for people listening, they should realize that, David knows what he's talking about. He's made some great market calls. Let's take a second, and I want to respect your time. We've been on here just talking. This has been a great conversation. Take a second and just go back through some of the history, maybe if you can, to let people know like some of the things you've called, some of the things you've seen, and maybe how you saw them and how you called them. Even though you may not have said them yourself, you might have wrote it out there, you put it out there. How are you getting these market calls out?
So, I have an investment strategy letter, Journey One Advisors, and I've been doing it since 1986. So my biggest call was in the financial crisis. In November of 2007, I made a big call that there was going to be a massive bear market recession. And I actually have that real-time research report on my website that was written in real time. And then in April of 2009, I put out a massive 35-page paper on how this was the start of a new multi-year bull market. So I didn't get the exact bottom, but I did get close. Close in the sense that I got the direction right. So yeah, I did have that. My biggest mistake in investing was in 2000. Even though I knew the market was way overvalued in 98, 99, I stayed with it. And in March of 2000, I called the exact top in tech stocks. And they dropped dramatically in the fall of 2000.
Like 70-80%, right?
Yeah, well, not at that point. At that point, they dropped like in half. And I went back in and with hands that full, and I got back in way too early. I knew it was a bubble, and I just didn't realize when a bubble bursts that it takes more than 6 months to revert to the mean. And so I remember like Oracle went in when it was down like 50-60% from March to October, and I jumped in and it went down another 60% after that. So that was my biggest mistake was getting into I called the top, but I got in way too early. And I also got the Fed had lowered rates in January of 2001. And every time in the past century, when the Fed started lowering rates, the market went up. It was the first time the market didn't go up, Marcus, in 50 years when they aggressively started to lower rates. So, that's a whole nother point. There used to be Marty Zweig was one of my gurus, and his saying was, don't fight the Fed, especially when they're lowering rates. That completely changed in January of 2001. January 2001, we were down 20% in 2000. The bubble had burst in the internet, and the Fed lowered rates 2 or 3 times in January. The market went up just like it normally does when he starts lowering rates, and then it died. And then the Fed lowered rates 5, 6, 7 more times over the next 2 years, and the market kept going down. That never happened before in the history of our stock market the last 100 years. So this whole thing is no longer valid that don't fight the Fed. We had in 2007, they started lowering rates in in October of 07. And for the next 18 months, they lowered rates to 0 from where it was like 5.5. One of the big, massive loosening cycles ever. And guess what? The market went down another 40, 50%. So now you have you can't just say, follow the Fed and everything. Tightening still has a negative effect. But on the loosening side, you have to get to a threshold now. You have to know, when is it the third interest rate drop? Is it the seventh drop that's really going to spur the economy and the stock market? You did not. It was so much easier to invest from 1950 to 2000 because every single time the Fed stopped tightening and then started to lower rates, the market and the economy responded. And part of it is that what we call velocity of money peaked in 1999. So even if you increase the money supply, it's the velocity. The economic is the increased supply times the velocity, and that has changed since 1999. It's been much lower velocity of money. So lower rates don't necessarily get multiplied through the economy. The velocity is just how much it's multiplied to So these people, it's a much harder environment now to invest in because you don't have that ease, that security that if the Fed's lowering rates, everything's going to be fine. We just saw in 2000 and 2008, 2 times where it completely did the reverse. Lowering rates just led to lower and lower stock market, and the economy got worse and worse. Not that it caused the economy getting worse, but it didn't help. So that's a real big distinction versus the prior century. Not many people talk about it.
Yeah, it's definitely the Fed and the rates and the returns and the rate of return have definitely all changed. We saw
it's not as good a signal as it was in the past.
Right. We also saw like when the Fed cut nearly 100 points. When was that? 24, end of 24, and the interest rates went up.
Yeah.
Like the 10-year went up, mortgage rates went up. That goes back to the focus. Yeah, man. This has been a really good conversation. You all right? You need a drink of water?
I'm fine. That's fine.
Perfect. Let me while I have you here, I'm borrowing Dave. David is he's a wealth of knowledge. People, how did you get so smart about all this stuff, David? Like, tell us a little bit more. I'm trying to get back into
okay. So
how did you get to this point?
So I got into business in 86. So I've seen
86.
everything. I've seen 40 years. I've seen the world end and come back. I got in a year before the stock market crash of 87. So that was a real awakening. So I was always interested in, I was an economics major in college, and I was always interested in the stock market. I practiced law for a couple of years, and then I got into the business, and I've done a lot. I've just really enjoy doing research and writing investment strategy reports. So I've written them for 40 years. So I have I'm really, I'm more historical based. I like to look at historical patterns to see, because they repeat so much. So I have a real good sense of history going back to the 1800s about the financial markets. And so I use a lot of it, apply a lot of these historical patterns to today's markets, and things do change and you do adjust for that. But most of the time, it's not different. That old saying, it's different this time. So I was very, very research intensive, do a lot of reading, just multitude of research reports and economic reports. It takes a lot of work, and, just have a real sense of history, and really, I would say that the biggest thing is just trying to not be influenced by other people. If I do my research, I try to pretend like I'm coming down from Mars and say, this looks like this, or this looks like that. And then I'll, see what it is in reality. And then I'm like, wow, that's so much different than what the status quo is today. I try not to be influenced by the status quo and not accept a lot of things that other people accept. So I tend to be skeptical of anything. In other words, I want to look and make sure that whatever people are saying is actually factually correct, and also intuitively is correct as far as their conclusion. So that's a big part, is just doubting everything, and working from there and trying to prove that that's my theory is correct or whatever, my thesis.
Yeah, you're a data dog. Something hits the
Yeah,
floor, you're
yeah,
sniffing it, getting ready to go.
yeah. So, I've done a lot of, I do a lot of research, as I said, and a lot of long research investment strat. One of my reports are very detailed, so that they can be cumbersome at times. So I try to, make sure I get the point across.
How many words are these research papers usually? Like general range, or I guess pages for people who don't look at the words.
They can be 10, 20,000 words. Yeah.
Really?
Yeah.
So
Yeah.
you do go deep into your
Yeah.
research.
Yeah. So I just did, in December, I did this massive research report because I wanted everybody to hear my views on almost everything in the financial markets. That's still on my website. And it's broken down into about 20 different categories. So if you want, you can just pick your own category if you want to review it. But I just want to make sure I got everything out that to be on the record of what I thought at the time.
How is it holding up, your research, 4 or 5 months in?
You mean how there's everything I've said? A lot of it's
Well, yeah, just from like the December letter.
a lot of it's a lot of it's coming true so far. So it's more longer term. We'll see in the next couple of years. It's really more of a longer term strategy piece. So I don't, we'll have to wait and see. So yeah.
Perfect. All right. Good. David, this has been a long, great conversation.
Yeah, it's long. Yeah,
It's been a
yeah.
long, great
Really
conversation.
appreciate it. I appreciate
I guess before we hop off, I found you because obviously people don't realize they listen to you speak. They've heard a lot of what's being said here, like your mannerisms are being put out in the media, but you're not popping out there. So so your research papers are how people found you. How did you get connected with those people who do that? They just read your work and then just started.
So what
They
happened
reached out
is
to
that
you?
I would send my research reports to Michael Santoli at CNBC,
Okay.
starting in like 2008, and he really liked the reports, and he started publishing my research on. He was working for Barron's then, and then he moved to CNBC like in 2015, I think, and he continued to rate and also cite a lot of my reports all the way through. So I became known on Barron's and CNBC for my investment strategy pieces. And then, of course, I had my first appearance on CNBC. I got it on December 30th of this past year. So he had always referred to me as the mystery broker. So it was kind of it was pretty cool. It was the unveiling of the mystery broker. Nobody knew my real name until that unveiling on CNBC. So that was pretty exciting and fun to do the unveiling. But yeah, he as I said, he was he had written, I'd cited my reports all the way through. So it became had a decent pretty big following.
Nice. So your good hard work came out. You just put it to the right people's hands, and they realized that was good stuff. Yeah, I got David in here like, whew, he needs a drink of water. We're gonna hop up off here in a second, David. I guess let the Main Street audience know where they can find you if they need anything, where they can get that research from, and then anything else you want to tell them before we hop off.
So if you need, my website, my firm is Journey One Advisors, and my website is Journey, the number one, not the number, Journey, the number one, advisors.com is my website where you can find any information you want. There's some research reports. If you want to contact me, you can do it through the website, and we can go from there if you're interested.
Perfect. There you go.
I don't know.
Tell the main.
I'll try. You got Adam Parker, so
Yeah, Adam Parker. The podcast has been doing great, man. We've had a lot of really cool guests on here. I don't know if people realize, and we've done the reports on like live reports from the war since it started happening. It's been really cool stuff for anyone who's popped on. But yeah, David, you have to come back on here.
Okay.
And also let me know when me and you can do a live session so we can hop on.
Okay.
But unless there's anything else you want to tell Main Street.
That's all. Let's wrap it up.
All right. Main Street Heart meets Wall Street Smarts. David Snyderall, the mystery broker. Thank you so much.
Thank you.
Welcome to the Main Street Meets Wall Street podcast. I'm your host, Marcus Sturtevant Sr. Today, we're cutting through the noise. We're navigating an economy defined by more massive infrastructure spending, macro headwinds fueled by geopolitical instability in the Middle East, momentum that's tested historical valuations, and a ruthless need for operational realignments as companies fight to prove that their AI investments are actually delivering tangible earnings growth. To help us translate these headlines into actionable intelligence, I'm joined by Brad Olson, Chief Content Officer at Benzinga. Brad is a seasoned media executive with over 15 years of experience leading editorial teams and growth strategies across the industry's most influential financial brands. From shaping the gold standard intelligence of the Bloomberg terminal to his current role at Benzinga, he has spent his career bridging the gap between professional data and the retail investor. Between his institutional background, Brad brings a unique perspective, having spent his formative years immersed in the cultural and markets of Eastern Europe, Central Asia, and the Middle East. He doesn't just report on the news, he understands the second-order effects that move the needles for your portfolio in a volatile world. Brad, let's get right into it. We're seeing a massive trillion-dollar AI build-out, yet the market is increasingly skeptical about monetization. When you look at this current rally, are you seeing genuine operational realignment that justifies these valuations, or just high frequency momentum masking up deeper macro fragility?
Yeah, Marcus, first of all, thanks for having me. And these are very, very tough questions that I think the whole market is wrestling to and grappling with, frankly. We saw just today and earlier this week, Dell's earnings kind of exemplify how far reaching some of this AI build out is going at the moment. Yeah, at first, in the earlier stages of all of this AI investment, you had these circular financing deals where all these different AI companies would sign a commitment for power usage or chips or compute, and then they would turn around and they'd sign another deal with a similar company. And it was back and forth, and no one really understood, how these agreements were actually going to translate into financial results. And now we're seeing the downstream effects of that from all the picks and shovels plays, be it the NVIDIAs of the world, although you could argue they're not the picks and shovels. They are one of the main beneficiaries of the secular trend, and all the way up to Dell. And then now we see some analytical thought that says that all of this build out's going to have a ripple through inflation too, when it comes to construction jobs in all these different locations. You're talking about electrical engineering demand and so on and so forth. So to some extent, will these companies get the ROI that they want? That's to be seen. You're seeing token prices slowly increase at some of these AI companies. You had some larger companies blow through their AI spend within the first quarter of 2026 after budgeting billions of dollars in spend on AI compute. So it's still TBD. I think we're still in the earliest stages, but clearly you look at the Anthropic commitments with SpaceX, they're willing to spend $1.25 billion per month. There's clear money that's following a lot of this, and so it's only a matter of time till the profitability comes. And I always look at the Uber and Lyft model, where VC massively subsidize the cost for all the consumers, and over time, you now have Uber and Lyft who are making lots of money now because the prices have finally caught up with this with demand. So I believe that these companies will see the fruits of these labor very soon. But obviously, with these very, very large numbers being thrown around, it's very hard to feel super comfortable that the money is going to be returned at a healthy return.
Yeah, and that's a great explanation. Yeah, and I'm glad you hopped on with us. So yeah, it seems like breaking it down just from 50,000 feet. You were mentioning circular investments is one thing. Do you think the circular investments are over with, where like people are invested in one company, it seems to always come back to NVIDIA? So I definitely look at NVIDIA as a picks and shovel, because everything's built off of NVIDIA, even though they're not physically building the data centers or things. And that way, they are building chips, kind of like Taiwan Semi. I kind of send them like a baseline. Do you see like less? I haven't heard circular investment in a while. You were the first person I've heard speak of it in a while. Are you hearing that less in the markets now?
Yeah, I think so. This was at the earlier stages, the circular financing agreements, whether it was Microsoft investing in OpenAI and then OpenAI turning around and committing to another business. That used to be kind of a trope, some sort of comedic punchline for a lot of the Wall Street pundits for a while. But I think as things start to shake out, there's going to be real money to be made as these companies start to invest on their own. Right, we're seeing some developments now where rather than leaning entirely on NVIDIA, many of these large companies are going to go out and start building their own chips. So I think it was just a matter of forming strategic partnerships when there was a lot of unknown. And I think it was more about just sticking your stake in the ground early just to avoid this moment passing you by.
Got you. Yeah, and we're going to come back to this in just a second, but you made a really good point when you were talking about companies needing to diverge outside of maybe NVIDIA as they needed capacity, they couldn't reach it. We see companies like Micron right now who are just going parabolic with demands for storage and supply. With that whole thesis, I want to jump. You've seen a lot of global. You've lived in different places around the world. In my opinion, I feel like America has kind of forced the world to rebalance the way their strategic partnerships, kind of like we were talking about with the circular investments. What are you seeing and hearing over there at your outlet that, as far as that goes, are you seeing results to people rebalancing outside the USA, sovereign nations as well?
So it's interesting. We're talking about whether you, as an investor, you want to be invested in U.S. equities or global equities. It's been a constant refrain in the 20 plus years that I've been in this career where there's always this idea that you need to be invested internationally to balance some of the returns that you might see in the US-based companies, especially in the past several years. That hasn't panned out very well. Yes, sure, you're seeing Taiwan Semi definitely capture the hearts and minds of a lot of new investors over the past year or so. But I still think by and large, the US is kind of at the front end. It's definitely the deepest capital markets that there are. There's deep liquidity. If you want to have any sort of investable opportunity, this is the place to be. We have at Benzinga, we have a lot of different partnerships that we're forming overseas, especially in Asia. By and large, the information that we hear from brokerage platforms and otherwise is that investors want to have access to US-based companies, the US capital markets. And so yes, there are a few of these players that have that global reach that are very interesting to some of our US audience. But I think still the fact that OpenAI, SpaceX, Anthropic, Microsoft, Alphabet, all of these players are still US based, and that's basically where all of this is happening. Now, is that to say that China is not a place to watch between the DeepSeek models that came out and all of the efforts they're making? I think there's a recent headline just a couple of days ago about restricting some of their citizens from leaving the country who happen to work in sensitive industries like AI, broadening that restriction from that used to exist around government individuals is now extending to the private sector. Definitely China is going to be at the forefront of a lot of this AI innovation, but I think by and large it's still opportunity. There's a lot of money sloshing around, as you saw with the Anthropic, the recent raise for Anthropic with a valuation of close to $1 trillion. And obviously the SpaceX IPO, which is very well covered by our outlet and many others, and is very highly anticipated. And all those are still US focused businesses.
Gotcha. Yeah, and there is a lot of push with the USA. There was a US exceptionalism trade, quote unquote, air quotes for anyone listening, that actually did run really strong until like the last year when international definitely flipped and outperformed. I think the US may have taken the lead back here recently.
Yes, I think, yeah.
But, and that's the thing.
Yeah, there was that weird period. Yeah, there was that period recently where international did kind of take the lead.
But you mentioned how portfolios are constructed, and for our listeners or viewers who don't know, it's based on modern portfolio theory, which goes way back to like the 60s. This guy who created it won a Nobel Peace Prize not Peace Prize, he won a Nobel Prize for the theory, right? So folks listen, so it's based on back in the day, these nations weren't correlated, and part of that was, speed of information, like everything couldn't move as quickly. Diversification, right? We had countries being rebuilt by the US dollar at this time that people didn't realize from the war. But so modern portfolio theory is just basically that when the US is up, Europe will be down. But eventually, U.S. would be up, Europe would be down. It would make an up to the right curve. In 99, that's when you saw it break. You said it's been for a few years, like 25 years. That's where it broke, and it's just not been the same. The U.S. has just been outperforming, except for a section like just a few minutes ago, where you mentioned like last year, it pops out. Speaking of things that just pop up every few years and seem to take the lead, and we're talking about things that are actually leading the market, small caps. What do you see with small caps? Because they're leading the markets right now.
Yeah, it's funny. Several years ago at Bloomberg, I was writing a column, and there was one particular reader who kept writing into me and saying, we're talking a lot about the S&P 500 or SPY. You should really start to pay attention to the equal weighted ETF, the S&P ETF. And I think that always keeps coming back to my mind, especially as we talk about market concentration. These top names, these multi-trillion-dollar companies like Apple and Alphabet and Microsoft and Nvidia, it's only a matter of time until the pendulum starts to swing back and the concentration is lessened. I don't have a strong opinion about the small caps. I think it's just the trend may have gone a little bit too far, too fast. You still have, we'll remember in the first administration, 2016, that the America First idea was a very heavily focused platform that tended to benefit small caps the most. There was this idea that money would stay within the country. These smaller companies would benefit. These companies that have a high concentration of businesses in the U.S. A lot of people tend to forget. I'm buying McDonald's stock. I'm buying Nike stock. I'm buying all of these American brands. So they make all their money in America, but they don't, right? A large portion of their revenue and their profit, frankly, is derived overseas. And so when you think about either the fiscal policy or monetary policy of the U.S. and to the extent that it's going to benefit, whether it's in the tax code or in contracts or other policies, the small caps are going to be bigger beneficiaries because they're more heavily concentrated in the U.S. and in their ultimate businesses. So, in terms of their recent upswing, I don't have a strong opinion on it one way or the other. I think it's just over time, this idea, the saturation of money in these very, very large names, people tend to get a little bit of a cold feet buying into a company with several $1 trillion valuation. There are definitely very sophisticated actors within this marketplace, and they can determine whether they want to buy a company at 50 times earnings or more. And I'm going to let them kind of do that math. I know that the average buy-stander, if you're trying to figure out whether you want to buy a value name or a growth name, it's pretty hard to think, is this worth 3.3 trillion today and it's worth 3.8 trillion tomorrow? Is it really worth that when that's a swing of 500 billion, like a billion here, a billion there, and sooner, then, at a certain point, that's some real money. So yeah, I think these big numbers are making it a little hard for everyone to kind of contemplate whether these companies are truly worth what the market is saying they're worth. But, don't fight the market, as they say.
Don't fight the market. Yeah, and it's been like some irrational exuberance. I heard that word thrown around a little bit more, but even when that was first said back in what was that, like 96 by Greenspan, the market still ran for like 3 more years. So we're definitely giving people, this is one thing we want to sit back and take a second for people to realize, like, we're trying to give them information. We're not telling you to go invest or not invest time in the market, though I will tell you that. Don't try to hop in time in the market, but we're trying to give you information so you can figure out how to make a more informed decision, right? Brad's all about delivering alpha over there, and we'll talk about some of what you do over there at Benzinga, as well as your history at Bloomberg before. But fresh off the presses, I heard Secretary Bessent speaking, or I heard some sound bites where he said, the Fed's going to get back to the basics. There's going to be they have 100% approval for removing forward guidance. How do you think the global community is viewing our Federal Reserve right now? Because the American Federal Reserve pretty much controls global interest rates, in my opinion. Like, Japan sets the floor for lowest pretty much, but America controls it.
Yeah, I think recently we all talked about how the central banks are supposed to be independent. Many of them are independent. There's some countries that there's less of a line between the political parties that run the business, run the country and their central banks. I'm not going to name any names. You can look it up yourself. But those types of things are wearing, we're getting very, very close to that line in the U.S. I'm not casting aspersions. It's just when there is frequent commentary about the central bank coming from political figures that should, I think it's not crazy to say that that's kind of a concerning thing, only because it's a departure from the norm. Whether that's a good or a bad thing, that's up for the markets to decide, not myself. But it is a different way of doing things. And what we're noticing politically is, look, there were these norms in the post-World War II era. The US, Europe, and the UK were very, very closely tied. And now you're seeing rumblings within the European Union about not relying on the US for the same types of support that they may have, relied on. And this idea that they don't necessarily have to look to the US to emulate any of the things that they are doing. And so even if the Fed stops with the forward guidance, I don't really expect some of the other countries in Europe to, like the ECB, the European Central Bank, I don't expect them to necessarily alter any of their policies, nor the BOE or the Bank of Japan. I think they've understood that the way of doing business with the U.S. has changed, and they have to forge their own path. Are the markets happy with forward guidance? Nothing's set in stone yet. I think we're going to have to wait to see it before the market can react. But I definitely saw the criticism around these different central bankers showing exactly where they think things are going to be, only to be proven wrong several months later. Where's the value in that? I know when those dot plots were originally put together, it was out of a need of transparency. The market wanted to know exactly where things were going. And I think that's a common phrase and refrain that we hear a lot, is that the market doesn't like uncertainty. And so the more information the market can absorb and contain, the better. When you don't have that kind of transparency or information, then that's when excessive volatility tends to occur.
Yeah, and excessive volatility is actually something where some of the biggest gains are made in stock markets, but
Absolutely.
Hence why you have to stay invested in the market. What are your thoughts, digging a little bit deeper into that? We're talking about central banks and their guidance. What are your thoughts on the SEC's move to reduce the amount of time from quarterly reporting for
this is a good one. This is a sticky one for the financial media world too. Obviously, Reg FD, it was huge for not only transparency in markets, for companies to be obliged to disclose material events that are happening within their company, whether that's a departure of a key executive or a particular lawsuit that they might have to settle that might have some sort of material adverse impact or positive impact to their business. And quarterly reporting, in my view, but this could just be biased and anchored in the role that I financial media, I think it's important. If you think about 6 months, 6 months is a long time, right? If we move from quarterly to this kind of semi-yearly or even annual disclosure, that's a long time. A lot of things can change in a year. If we want to use AI as an example, just think back 6 months. What happened 6 months ago in AI? You had Anthropic, and look, Anthropic's a private company, and they don't have to disclose any information that they don't need to. But imagine taking a company that was in a similar trajectory as Anthropic. In a span of 3 to 4 months, they went from a $9 billion revenue run rate to $44 billion. And that kind of movement in a short span of time without disclosure is rather interesting. And I don't think it's necessarily helpful for investors. I know the concern, and that's for the burdens that it puts on certain companies. And then also, I think even Warren Buffett and others have been very vocal about short-termism and how the quarterly reporting cycle drives companies to make decisions that may not necessarily be in the long-term interest of a business. However, there are key examples of very, very well-established businesses that have had that long-term view, Berkshire Hathaway being one of them, where they've ignored the need to want to beat every single quarter and to make short-term decisions to juice gains. I think when a company does that, there are more concerns that you should be worried about. When they feel they have to do that, you should probably be digging more under the surface about that company itself and whether they're taking the long-term view. So, my personal view is a little biased. I think that more disclosure is better. It provides a better narrative. It gives people more information about what's going on. There are more opportunities for companies to talk. And look, the proposal that's out there right now allows companies to do what they want, right? It doesn't oblige them to no longer report quarterly, as far as I understand it, and I could be wrong there. But my guess is that some companies are probably going to choose to pull back the curtain. I don't know if that's the wrong. I think it's the other way. They're going to pull the curtain in front of their results. Pull the curtain the other way and
pull down the curtain.
Yeah, pull down the curtain. And I think for retail investors, that's less information. They don't get access to the countless investor conferences and other kinds of non-public exposure to executive commentary and financial results that other more sophisticated investors get. So my view is Reg FD was a win. I think giving investors more information is better, especially with AI now. The ability to translate a ton of new information is helpful. And I think more information is probably better.
Yeah, transparency definitely helps because, I mean, like we said, like I was saying earlier, like that was part of the reason why modern portfolio theory was working. Like the information wasn't getting across to other people as quickly, so they couldn't exactly move or make moves. The velocity and speed at which we trade in this world nowadays, like 0-day options, like it's just insane. People don't have a long-term mindset. Like going past quarterly, some people will go crazy, as you said, like the retail investor. What are you seeing with the retail investor? I've been making the case now that like 2025 was the year of the retail investor, whether anyone wants to admit it or not. Like that was, the retail investor came in and bought the dips. And they continue to buy the dips, but institutional money has come back in buying dips in this year, right? And they started to buy it towards the end of last year. What are you seeing with retail investors right now? You think they're still strong or are they pretty much exhausted?
I wouldn't say they're exhausted by any stretch. I think there's so much opportunity in different stocks, right? That people don't normally think about. Uranium and nuclear stocks are obviously hot for the power story that, we talked about the picks and shovels and AI earlier in the show. Nuclear stocks are of note. You have the space stocks that are also capturing everyone's attention, quantum stocks. All of these are great stocks that people really weren't paying attention to several years ago and now are for better or for worse, right? There are definitely some dogs with fleas, as Gordon Gekko would say. And you need to do a lot of due diligence when it comes to some of these smaller names that may not have a strong pedigree or track record. Obviously not casting aspersions about any of these groups, but where there's opportunity, there are always people who are looking to capture that opportunity, whether a company has renamed itself in a new vein, it was doing something else entirely 3 months ago and is capitalizing on the new zeitgeist. That's something to always be aware of. They could very well be successful doing the new thing that they want to do. And, I guess one of the more famous examples in recent memory is Allbirds, right? Allbirds is the sneaker company that now is an AI company, but that they're not the only ones. And they may have a really good business idea for taking that IP cash and reinvesting it. You had a long line of companies in cannabis and in blockchain and otherwise who rebranded based upon, new opportunities. So that would be the only concern, is just do your due diligence as an investor. But as far as our readership is concerned, they can't get enough about what's happening in AI. That's where there's opportunity in the markets. And we could talk about how $0 commissions is helping, and fractional investing is really clearing the pathway. You don't have to worry about that high cost stock. If you only want to buy $50 of a stock, you can. As you said earlier in the call, stay invested. That's probably one of the most important things that you can learn. But stay invested in stocks that you understand, I think is another key principle. Either you want to be buying an index that is trustworthy and has a track record, or you want to be broadly invested, but make sure that you don't, like you said, try to time the market. We talked about YOLO trading, and at Benzinga, we were definitely part of the GameStop saga and AM's back well into COVID, and we were part of chronicling that story, and a lot of our readers were really enjoying it. But right now, from my vantage point, people want to know about where that next opportunity is, and so we're doing our best to chronicle that.
Perfect. Yeah, and that's actually a great lead. So you mentioned Gordon Gekko. I actually did a podcast episode last week where I started on the More economy and started with the Gordon Gekko speech where he said greed is good, and then he explained why greed is good. And I was saying, people, that was 1987, and the people who run the country now were like, some of them were like in college, or some of them, that was the environment of the world. So we're back into that environment now where like irrational exuberance, people want more, they want more, they want more. Like you mentioned though, you said the GameStop move, and you covered the whole meme trade move back then. Can you take us back through that from back then to like, even right now, the latest you're hearing on Ryan Cohen and the eBay thing? I think Cohen may be trying to play chess. People told me I was crazy with the whole move and I know I can unpack this question a little bit more because it's long, but I know when he was on the interview, which I think most people seen, where he just kept saying, read the website, half cash, half stock. And then they asked him, they said, what if eBay made an offer for you? You think he's trying to get eBay to buy them? Like,
I'm not sure. I saw that interview. I think what is more interesting about that interview is that he did two interviews. He did one interview on CNBC, and then he did another interview on a different outlet, and he had a completely different countenance to that that whole interview. One was lighthearted, one of them was a little more skeptical, cynical. I don't know I do think there's a little bit of gamesmanship going in there. I don't know if it's checkers necessarily, but there is definitely some gamesmanship. I think he really understands, and I think there's been one idea that he wanted to galvanize the retail community to help drive the value higher, which would then allow that process to unfold. Similar to any sort of story stock, right? If you can even use Tesla as one of the original story stocks. You have a very strong figure at the helm who tells a great story, who is always in the public, trying to provide his vision for the business. He has a strong group of people who are they're on top of every word. They're willing to buy the stock. And guess what that allows Tesla to do? They can go out into the market. They can raise capital extremely cheaply. And is it any wonder that they can go out and raise $5 billion at next to zero cost on the valuation of their business, while their competitors like Ford and GM and others are still saddled with traditional forms of debt. They don't have any sort of room for dilution of their investor base, and it's harder for them to compete given the cost of capital. So I think if you can galvanize the base, if you can tell the story, and that can drive the value of your business up, that gives you a war chest to go out and make a splash and do the things that you want to do. So whether it's a reverse psychology of wanting eBay to buy them, or whether it's trying to galvanize the base to drive up the stock to allow them to better afford that acquisition, I'm not sure. I actually don't think it's a terrible idea, those two companies getting together. I think there's been some criticism that I've seen about why they would even get together in the first place. I don't think that's a terrible idea for both of those businesses. But, in terms of his plan for the future of those two businesses, I guess I'll let the analysts duke it out on whether that's the right idea or not.
Why do you think that's not a bad idea?
I think where GameStop has been and where it can go, the memorabilia push, having those retail stores available for people to visit, trading, collectibles, all of those, that whole area has really done extremely well. You can even look at the success of a Netflix show. What is it? The King of Collectibles. All sorts of memorabilia has performed exceptionally well as an alternative asset class, especially at the high end, whether it's Pokemon cards or otherwise. And so I think having GameStop move into that area, whether it's video games and memorabilia, having that overlap with eBay as like the front retail store, this is my ignorant view of both of those companies. I bet they're much more sophisticated than that, but I don't necessarily hate the idea of a tie-up there.
Gotcha. Yeah, and that's the thing. Like, companies need to be able to have their investors understand their company, like you said, understand what you're investing in at the simplest level, and you just broke it down like kind of how like eBay and GameStop, where you see the synergy. eBay stock was not doing bad, for the record, when Cohen came in and made this statement.
No, not at all. And that's the interesting part of that, right? Is usually you'll see some sort of takeover offer, or even sometimes you'll see a take under offer around businesses that aren't doing well. But yeah, it didn't look like eBay was hurting for it. And by the way, I'm not advocating to buy any one of these stocks. I don't think anything, or any stocks, period,
Yeah, no advocation for any stocks. This is just general conversation.
Exactly.
Everyone.
But again, just on the surface, I wouldn't put it past him that there's some good ideas back there.
Got you. Yeah, and speaking of stocks, we're about to mention another stock. And you were talking about with Anthropic, if people could see the run rate and what it would look like if it was a public company, Intel. Is that not kind of what you just saw? Like with what happened with Intel, even going back 6 months, and you mentioned the guidance, right? So with these AI booms, 6 months ago, when companies were reporting, they would have strong reports and their stock price would go down. Last quarter, we saw companies report and some of them were rewarded, like Intel, which is parabolic. That's got to be some meme stuff in there, right? And then Dell today.
Yeah, I think, underscores the need for transparency. Dell blew away every analyst by far. They blew away their own guidance by far. And that was only 3 months ago. So big fan. I think we need to continue the disclosure processes. Imagine if this lasted 3 more months. The only people who would know this was happening would be the executives and the people who knew inside the company. And maybe a limited set of investors. And so I think important for the rest of the world to see this and have their opportunity. In terms of stocks that have risen on poor results and fallen on good results, there was an old trope and it's not anything that we made up at Bloomberg, but one of my technology reporters back in the day, we would always joke, we would just call it P2P, and we'd say price to perfection. So there were companies that would just, it was so telegraphed that they were going to do well. And one would argue, well, if it was telegraphed that they would do well, why didn't the analysts catch up to to those expectations? Well, sometimes the market can get ahead of those very, very quickly. And sometimes they ignore analysts' expectations for just a short period of time. Now, you talk to analysts themselves, they'll say stocks always follow earnings, right? Don't worry about the stock price, just worry about earnings. And stock prices will follow those earnings. But there are those temporary dislocations, and those can happen, several weeks ahead of earnings, where there's this kind of boundless optimism that may surround a stock. And it doesn't matter how well they did. There was an opportunity to sell into the news, right? That it could be either the company is priced to perfection, they already knew the results were going to beat, or there was a whisper number, or hedge funds who were doing their mosaic theory already knew that there were numbers that were going to suggest that they would outperform and had bid up the stock. But there's also stocks that have done extremely well over the past year, and this is an opportunity to sell into that report, right? You have to think about a market is not just some abstract theory. It's people that are trading against one another, and there's going to be a large set of people on one side who want to exit a position, but they can't exit a position without a similar number of people or market makers taking the other side of that position. And so you want to make sure, in many cases, there are these market dynamics that play a part in stock prices rather than just, is it good, it goes up, is it bad, it goes down.
Right. For every dollar every dollar has a party. Like $1 goes to another person. Like we can't create money. We can, but it would be bad. Like right. The money you already have.
We do create a little bit of money each year.
I got you. We're saying the alpha and delta. Jumping into that, because that's what you do over Benghazi, right? You help Benzinga. I'm sorry, Benghazi, my bad. Benzinga. That's what you do over here. Take our listeners, I want you to take your time and just take them back to when you were at Bloomberg. Just tell us a little bit about you. Like, everyone may not know you, Brad, but they should definitely listen because you have a different perspective. So take a few minutes and just tell us about you, like how you got into this industry.
Yeah, so I mean, the I'm trying to use my little quick elevator pitch here because it's hard to compress 20 plus years into a short sound bite. But most of my career has been around trading and investing, and media is something that I've embraced over time. I started in media providing services to hedge fund clients and retail investors who were curious about how to trade, quite literally trade the news that they were seeing. And that kind of led into a natural fit at Bloomberg, where the team that I happened to work with we were tasked with trying to provide that immediate color. When there's a piece of information that comes out, why is the stock doing what it's doing? What did Wall Street think about that stock leading into that piece of news and otherwise? And we had an opportunity to be at the forefront of short form content before that was really commonplace. There were many people who think of traditional financial media as these long-winded, maybe 700, 800 word articles about some XYZ company that launched a new product, or maybe it's a long-winded piece around their earnings, but our job was tasked with trying to break down very, very quickly and succinctly why someone needs to care about what's happening in a particular stock. And our goal was both analytical and journalistic. We would be talking with investors on the buy side. We'd be talking with sell side analysts. We'd be on the receiving end of a lot of their notes and information and their views on the stock. And then we'd also be using our own tools at our disposal to track, at scale, how stocks were behaving, whether it was volume or volatility or investor ownership. All of those things kind of bled together to help us tell a strong story about each individual stock. And then ever since then, I've had the opportunity to lead a couple different organizations, and where the goal has been to just truly qualify what is happening in the market at any given time. And you may look at your brokerage app and see, think you may be a genius and said, hey, wow, I'm up 5-6% today. And then you may not know why. But part of what our job is to do at Benzinga is to tell people, okay, but within that portfolio, you had 2 or 3 names that outperformed, and they outperformed for these reasons. And by the way, you may want to take a look at some of these other stocks that might have some sort of knock-on impact that you may want to be aware of. So those second-order effects, the second derivative of what might be happening, we talk about the picks and shovels at the top of the show, all those interconnected relationships between ETFs, sector-wide moves, even though there might be a piece of news around one particular space stock, even that other space stock that may or may not have some questionable origins, that might benefit from that same type of piece of news. And it's our job to help qualify what's going on and help people either construct their portfolios if there's a little bit of self-directed element there, or at least make them more informed about what it is that they want to do with their portfolio, whether it's dividend investing. You can be a REIT investor. You could try to YOLO some of your portfolio as well in space stocks and nuclear, or you can go for that solid return. And we'll talk about that too, between our personal finance content and markets content.
Very cool, very cool. And so that's a very cool story. Been doing this for 20-something years. So you've seen several bubbles and several moves and several pops. And now we're talking about the current bubble, the AI, quote unquote bubble. First of all, do you think AI is a bubble?
I think, and I'm happy that we're having this conversation this week, where the CEOs of the very AI companies that swore that there would be doom and gloom imminently have walked back some of their statements. I don't feel as crazy now saying that I also thought that those were a little overstretched in their assumptions, right? What was the quote? My death was greatly exaggerated. I forget. I'm butchering that quote.
Premature death. Yeah.
The news of my demise was greatly exaggerated, or something like that. But I believe that was the case. We were an early adopter of AI for a lot of different reasons at Benzinga, in terms of helping us produce research, compile and automate a lot of research and data. It wasn't necessarily to generate slop. It was more around the research side and bringing together all sorts of different data sets that we actually have at our disposal on a proprietary basis, and just to reduce the amount of time it takes for a lot of our reporters and editors to get that information. And so we're trying to use it in a smart way. But I don't want to say we're not an upstart. We've been around for quite some time now. But being at the middle part of the financial media spectrum, having to punch up to some of the bigger players, having AI has been a tool for us, but not a tool for efficiency or firing people and restructuring. That's not how we're viewing it. We're viewing it as just a better way to even the playing field and become more competitive. So the idea that somehow AI is going to come in here and make, sweeping changes to the workforce and massively improve profitability. I'm of the mind now, and I think there are a lot of other executives who said the same thing, is that I think just everyone's going to continue to work. We're just going to work more using AI. And then in the aggregate, we're all going to move forward at a much faster clip. And in terms of the more doomsday scenarios, I'm most optimistic about healthcare offsetting those doomsday scenarios, right? When healthcare prices drop inevitably, when diseases can be cured at much earlier stages in life when there are patterns that are recognized that are unrecognizable now, and we can get ahead of chronic care that might need to be done. I'm most optimistic for that cost curve and that inflation curve to be bent. And when that happens, I think people across the globe will probably benefit handsomely, even though, they may work fewer hours, or maybe their job might be gone and they might have to do another piece of work. Hopefully the overall cost curve will have dropped to such where people will still be in a much better position. But I don't think it's a bubble necessarily. I do think the market is getting very, very ahead of itself on valuations, but that doesn't mean that they're not worth what they're worth. I don't want to say that the SpaceX at 1.8 trillion or 1.7 trillion or 2 trillion is a good or bad valuation. For the name, you could argue with the total addressable market calculations that get to those numbers, but and how that happens. But I don't think it's necessarily a bubble. I do think that the assumptions about what AI were going to do were not correct. I think the pendulum is swinging back towards trust. People have seen AI overviews. Some of them are trusting them. Some of them are not. I think it's only a matter of time before you pour bleach on an open wound because some AI overview told you to do that, or inject yourself with some other crazy chemical, where people will slowly start to realize it's not 100% trustworthy. I probably need to go to a real valid source. That's something that I think existing stakeholders or embedded entities in today's world will probably benefit from. The larger players in media will probably benefit outsized from this move towards trust, as opposed to any sort of random source that AI happened to pick up and provide an overview of. It's something that we're counting on. It's something I've talked about, how we've been chronicling AI in the age of AI for many, many years. I don't think that we're written by humans, even though we're telling an AI story. And I think people will still thirst after a human perspective to know that there was some degree of research until a company, loses that trust. And similarly, expert networks and other trusted institutions where you have experienced individuals at the helm will soon benefit, even though the original knee-jerk reaction was that everything will be aggregated, no one will care, and we'll move on. But I think the move towards trust is only going to, I think the value of trust is only going to improve from here. And you're seeing that actually, sorry to long-winded answer, but I get a little, agitated with this. But you're seeing, it was a great post on LinkedIn recently about how the irony of a lot of the AI job openings is that they're looking for people to do the jobs that AI was supposed to displace. So your chief marketing officer or people writing content, and those were obviously the first types of roles that everyone thought there'd be a death knell for. But those are the roles that they need a human to look at and they need a human to lead. So I think AI will be a massive productivity surge for everyone. I hope it'll be a societal gain, especially on the healthcare side. But I don't think it's necessarily a bubble, but the valuations might be stretched.
Gotcha. Yeah. So, and yeah, people listening, don't pour bleach in your eyes. That's not how you rinse them out. Like, regardless of what AI may tell you, that was a great quote about the open wound, the AI. Great statement. But so you don't see AI. I think of AI in my job, in my profession. People are always like, we saw the SaaS apocalypse, which happened earlier in February, and people are like, oh, AI is coming to take your lunch. So we saw Hazel. So Altruist is my custodian for my firm. So I see Hazel and that kind of stuff. And I'm like, no, man, this stuff's not coming. It's not coming to take my job. It's coming to enhance what I can do for my clients, like how I can help my clients with what I do every day. Do you see AI taking your job at any point, like journalist jobs? Is everything still written by journalists over there? Because y'all put out a lot of content.
We have a lot of content. We produce a ton of content. Like I said, our AI use is right now limited to the more mundane tasks, and bringing together all sorts of data sets and structuring it in a way that makes it easy for a reporter to use it or not use it. But we want to put everything in front of a reporter as quickly as possible so that they can get on with the business of actually being journalists as opposed to being data dredgers. So that's how we're using it predominantly. We've actually had, and most publishers have, had some form of automated content for a while. We've been very upfront about which pieces of content those happen to be. Even the big guys like Bloomberg, they have automated content, but you're very clear about it. And those serve a small purpose. But by and large, most of our content is going to be human written. And if AI tools are used, we have a disclaimer. And in many cases, the AI tools are used to just enhance or help ideate what the reporters are going to do, whether it's going to be a headline or maybe it's bringing together some technical analysis that might be easy for them to pull. So those types of things we're just using to make it be additive and supplement the content. But ultimately, even our automated content is getting humanized. So now, is it too soon to say? I think the world of journalism has been hollowed out. The hollowing out of journalism started well before AI.
Mm-hmm.
It started with trust deficits. It started with a lot of different reasons why people have moved away from it. How cheaply other media is to consume, and the diversity of the diet, and the fragmenting of attention. So, although journalist jobs may continue to compress over the next several years, I think that trend started long before AI, and I think AI should only make those journalists even more valuable, considering they can do more with less.
Perfect. And that's a great explanation. Now, you have a unique view of retail investors, like I said, and actually institutional investors. Like I said, you mentioned Benzinga, like y'all are a tiny company, man. Y'all are a disruptor, and you're not a little guy, man. You're playing it down. Nice try. But over there, what are you seeing with private credit, gold, and Bitcoin? Just those are things that have been pushed by retail investors, it seems like, here lately. Gold went memeish, in my opinion.
Yeah, gold's an interesting story, but gold's also one of those picks and shovels things, right? You have the silver and gold relationship. The demand for silver obviously is off the charts. So there's a fundamental supply and demand question there. And the same is going to be true with gold to some extent. Did it go memeish? Yeah, I think it kind of got a little bit ahead of itself. Like a lot of these things in these almost tulip mania style AI bubble. But in terms of Bitcoin, that's a complicated question. I think they're losing. I'm going to cheat and use Mark Cuban's quote. They lost the plot. But I don't think Bitcoin lost the plot. I think Bitcoin is still Bitcoin. I think Bitcoin is losing the mouthpieces.
Yeah.
So I'm just going to turn his quote around a little bit and say they're losing the mouthpieces. The people who were the most vocal supporters of the trend are now losing the faith, and that has we talk in this job around price dictating sentiment, and sure enough, when the price started to stall, you started to see the stalwarts kind of leave the room, and so that's a problem for Bitcoin. Is that if the only real source of demand were people chasing price and capitalizing on the story, then maybe the story wasn't as strong as it was told. But I still fundamentally think there's a place for Bitcoin. We cover crypto extensively at Benzinga through a lot of different lenses. An interesting trend now is how prediction markets kind of work hand in glove with crypto, and so to some extent, I think probably prediction markets were the wheels were greased by the existence of crypto. So I don't think Bitcoin's going anywhere. There are very interesting plot lines that we follow every day around strategy, formerly MicroStrategy, and what they're doing in an innovative way. Whether it's the correct thing, I'm not going to say, but they're making very innovative plays on how to monetize and finance what they do over there. And then, I think the last thing that you mentioned was private credit. We've actually launched, and this is not exactly private credit, but just this year we launched a new coverage area around private companies. And part of the remit of that vertical is to chronicle what's happening in private credit, and to the extent that it has ripple effects across private companies and financing the world. So I'm bullish on disclosure. I'm hoping that with the advent of this new legislation that allows people to put private companies in their portfolios to the extent that you're allowed, this will hopefully open up a new avenue of disclosure so that people can participate. Because a big frustration for for retail investors has been that most of the return is gone by the time that companies ever make it to private markets. And think about SpaceX as an example. If you're buying SpaceX, at the $1.8 trillion valuation, and you want to get a rate of return of what's typical in the market of 8 to 10% annually, that's going to have to be a really, really large company very, very quickly. And they have a lot of work to do. Meanwhile, if you were an investor in SpaceX in 2021, you've 10x or more from there almost every year. So it not every year, but it's considerable returns, and that existed. That kind of trend has existed for the last 10 years at least, with a lot of private companies doing extremely well in the private while they were still private and before they got public.
Yeah, I mean, even like Dell was private until like they come 2018. You know, they went took their
right. Well, they were public, then they went private, and then they came public again, and yeah, there was quite a story.
Right, and I know you got to run here, man. Speaking of going public to private, private to public, I feel like we would be remiss if we didn't speak about, and I know you kind of spoke on, so SpaceX, Anthropic, and OpenAI, going public this year. Is that one, you think that's going to take all of the money out of the capital out of the market? Where is this money going to continue to come from to fund this? Between Bitcoin, gold, the S&P 500, which is very concentrated right now inside of the tech and semis and software, like oil, where's this stuff going to come from?
Yeah, no, I mean, it's a good question. I don't have the answer. I think that but it is a common conversation that's being had right now, is the race to get public first so that you can soak up all of that excess, retail money or new money that hasn't been involved since. I have a lot of faith that the money's going to come from somewhere. I don't know if it's leverage but that people somehow manage to find the money. But it's a good point about where would that money come from similar companies. I think the biggest example right now is Tesla. So if you were a Tesla investor and you love Elon Musk and you're bullish on that whole idea, maybe you're probably going to sell a slice of the Tesla story so that you can get a piece of the SpaceX story. And I think that's why you're seeing a lot of information bandied about in at least the financial media space, that maybe there's going to be a tie-up between the two, because they understand that that Venn diagram is rather less a Venn diagram and more just a circle. And so that's my anticipation, is I think there's going to be a little air that's being let out of that balloon. I think a little bit of that has already happened, but I don't know if it's because retail investors are abandoning ship or because there are fundamental other decisions that are being made in terms of sunsetting some vehicle production and moving that over to robotics. And that story needs to be told a little bit better. But it's a good point. I would definitely, as people think about the traditional, I guess, evolution of investing, whether it's like the tax loss harvesting or all of these other types of strategies, it wouldn't surprise me if people start to sell their winners to start getting invested in some of these other new places.
Yeah, and speaking of selling winners, definitely with what we're seeing in this market right now, people should have done some kind of rebalancing at this point. This stuff is running crazy, even since like the end of March. Like, it's just been absolutely crazy. Brad, what are you hearing with, I know you're talking about companies going private, coming public. What is the big thing right now over there at Benzinga? Like, what are you hearing in general, not just the public or private, in general?
We just continue to cover. Look, I mean, the one thing I talk to my reporters about a lot is still the underlying health of the consumer. So that's one of the areas that I like to focus on, even though we're talking about all this opportunity in AI that may exist and all the opportunity that may exist in private companies coming public. I still like to look at the situation that's happening with the typical consumer. How is inflation impacting their spending? Are they dropping? Are they jettisoning some of their subscriptions in favor of buying essentials? Gasoline, how is that impacting what they're doing day to day? Because ultimately, if you follow those trends, you're going to find some of the winners within the marketplace. And we could talk about SpaceX till we're blue in the face, but SpaceX is not part of the consumer story. It's part of the way in the future story. It's government contracts. It's about providing accessible internet to places that are less fortunate, whether it's globally or even in the US. But one thing to think about is that's kind of a very opaque story. It's very hard to kind of understand. Where I like to think about it is we wrote a couple stories around, I think it was Hilton talking about a new type of a C-shaped recovery or C-shaped consumer in terms of how they're purchasing their travel opportunities. We talk about Dollar Tree had they had some fantastic news earlier today, but is that a good sign, right? If people are flocking to dollar stores, is that a positive in the economy, and what does that portend to others? Over the past 2 years, I've seen lots of moves from McDonald's and some of these other fast food places try to discount further and make some of the affordability options clearer for some of their consumers. I think that's the real economy, and that's what I'm interested in covering and chronicling, because that's you see a lot of that data in executive commentary, and you can get ahead of what's going on, broadly speaking. But it's really hard to talk about the SpaceXs and the Anthropics of the world because you don't understand. It's no real way to forecast a lot of what's going on there, other than just trying to listen to executives speak about their AI adoption or token maxing or whatever they're trying to do to stimulate growth. But I look at the Dollar Trees of the world, Hilton, Priceline, Expedia, even automakers. The self-driving concept is still something that captures the hearts and minds of individuals. Whether that's going to pan out or not, I don't know. I think you have a huge customer public service struggle ahead of whoever wants to launch one of these self-driving stories, even though there are a lot of in mass, a lot of aggregate benefits that might inure to the end user, be it lower car insurance rates or fewer deaths on the road. But it's a big public communication challenge, to say the least. But in terms of what we're thinking about here, I like to just focus on what are the economic shocks that people are struggling with: housing, mortgage prices. With the latest PCE numbers that we saw, what does that mean for mortgage rates, and how are people going to continue to afford a home and put a roof over their head?
Very good. That's salient stuff to hit people with as well, like what's hitting Main Street as well. Like people can look and hear all these things and not really understand it or not realize that actually impacts them. They just see something happen in the Strait of Hormuz. Which strait's more important, Strait of Hormuz or Strait of Taiwan?
We're a real-time news organization, so right now it's Strait of Hormuz. I mean, long term, it's definitely in Taiwan, but it's the Hormuz is the only thing we care about. Although it's funny, not funny, haha, but you have to think about, we've been near a deal for months now. So the market, I think, has already priced it in. I think the moment that we get a signed, sealed, and delivered deal, I wouldn't be surprised if there's a little bit of the sell-off, because there's just been this optimism for a long time. Although you probably still might see a small bump because of what might happen to gas prices, right? If gas prices start to come down, that's a real that's money back in people's pockets, and that should hopefully help some of the broader economy.
Gotcha. Yeah. When gas prices come down, that'll definitely help with equities. Hopefully, treasury yields continue to come down so people aren't running to risk-off positions as well. Brad, in your 20 plus years doing this, I know you've written a lot of great pieces. What's a piece that you've written or something that you put out that you were like, man, I probably wish I didn't put that out there? Or like maybe you just totally got it wrong. You know what I mean? Because people have to realize, like, everyone's not perfect. We all make mistakes.
That's that's actually a really good question. I don't write as much as I used to. I wrote a column back in the day, and my job was to write about the market every single day, about 1,700 words. And I also managed a team, and that was challenging. But there were several hundred columns that I had written. So was there something that I got wrong in there? Absolutely. I did my best to try to let the opportunities speak for themselves. My job was to surface the opportunities and ultimately let other people make the decision that was right for them. But do I regret anything that I've written? There was a time and a place for that. I'm sure that if someone were to show me a piece that they said, well, aha, look at this. Are you proud of this? I don't have any pride in authorship. I'd probably eat crow and say that was probably not wise to write that at the time. But we can all look at that at things that we've probably done in the past and said, I shouldn't have done it. I wish I had an example for you, because it'd be humorous to think about. But I love the markets are fun to me. I like to have fun with content. I think if you were to look up my columns, the ones that were public, not all of them were public. A lot of them were in the terminal, but they were terminal only. Some of them were on the web, but I like to have fun. The market is dry. And so maybe there were some stretches and some creative license that I may have abused in trying to make something entertaining, but yeah, nothing jumps to mind.
I know it's good. I'm glad that was a question that made you sit back and think for a second. Like, I don't know if you ever been asked that one, right? But
I've had some corrections, right? And I mean, I've also written about, like, was it my proudest moment to have to write about, a Kardashian at some point? No, I would have rather probably not write about, or I think it was a Jenner. I forget which one it was, but at the time it was moving markets, and we had to do it. So I don't regret those either.
yeah, I mean, you got to write about billionaires or proposed billionaires, perpetuated billionaires. I don't know, one of those collars or one of those Jenners or Kardashians is supposedly a billionaire. We're a long time here, Brad. I know you gotta go. Let people know, one, what you're working on right now. Two, what you're looking for. I don't know if you still take people like sending in submissions or if anyone wants to give you any good ideas, and how they can reach you.
Yeah, so at Benzinga, we're always innovating our portfolio tools, portfolio monitoring tools. We have a lot of value add products, whether you're looking for someone to help with new ideas that you may not have thought of. We provide those services. We're building new enhanced tools around disclosures, public disclosures, and how you can look for some of the signal within all of that noise, whether it's transactions that people are making or other filings. So we're spending a lot of time digging into a lot of that data. We have our own proprietary stock rating system that helps people look at stocks from a variety of different criteria and let them make the decision on whether that's something that they want to have in their portfolio. That's something we're really excited about and working on now. And yeah, if there are interesting viewpoints that you have, or you're share a story that's worth an investigative angle, we always welcome submissions, info@Benzinga, or even tips or corrections or editorial at Benzinga. Our news desk is also an alias that we accept submissions to. So yeah, if there's something that's interesting that we've overlooked or something that you want to flag as offensive, we definitely take those seriously and we'll respond. So, but I would encourage everyone to take a look at our site, and people can sign up for free. And if they want to have a much better experience, then we have an offering for them there too. And that's nothing to say of our more advanced tool called Benzinga Pro, which is, a much more expensive subscription, several $100s a month, but you'll have a market guide with you all day. There's an audio service in addition to breaking news headlines that, with the exception of maybe Bloomberg and Reuters, we will usually beat everyone to pretty much all the relevant news that you need to have during the market day.
Very good, very good. So do you ever get to sleep, man? Or you just open all the time, 24/7, 365?
No, we are 24 hours. We're a 24-hour operation. We've got hundreds of people around the globe working hard to deliver that kind of critical color and information for us. So I love, I've eaten and drank this craft for 20 plus years. And I think the advent of productivity tools is probably a positive. People don't necessarily hate being chained to their phone, but I don't hate it. I love to respond. And if there's a good news story, we got to cover it. And I'm excited to do that.
Perfect. Anything else you want to tell Main Street?
Just visit our site.
Yeah. Give them the site again, Brad.
Tell them Benzinga.com. That's right.
Very, very good. Very good. Yeah, and I could talk to Brad for like another hour. Hopefully me and Brad can get together and chat another time. I know he's really busy. I already stole more of his time than he had promised. I'm sorry, Brad.
All good. This is a great conversation. Love
great conversation. This is the Main Street Meets Wall Street, the podcast. Check us out on the YouTube channel, Main Street Heart Meets Wall Street Smarts. Thank you so much, Brad, for hopping on with us. And check out the episode. Check him out on Benzinga too. People understand the plummet of the markets like this man. He didn't start his journey in an institutional "I retire." He started exactly where many of you are, in the trenches, YouTubes, digital chat rooms, teaching himself the game from the ground up. He went from a dedicated subscriber to the director of customer success at Benzinga and the host of a very successful AM show. He commands the pre-market playbook over there on Bazinga Pro. He's an absolute powerhouse when it comes to translating order flows, unusual option activities, and level 2 data into pure executable clarity for everyday wealth builders. In part 1, we lay out the macro map. Part 2, we're going to dive even deeper. Welcome back. Hit that like button, and let's welcome Ryan Falon. Good stuff. Part 2 starts right now. People don't generally think about when you say trading and you say trader, people like if they were to check out a show and we talk about trades, they talk about trading, people usually think that's like happening in a day, 0 day expiration options. But you're telling people like trading can be a longer term investment. It should be a longer term investment. Tell people, go a little bit deeper into like how you kind of structure your portfolio. You don't have to tell individual positions to like build out as a trader.
Yes, that's great. That's a really good thing to talk about. So first of all, I day trade every day. To be quite honest with you, I wouldn't if I wouldn't like to. My ultimate goal would not be to do that every day because I'll be perfectly honest with you. I am an average day trader as far as I'm concerned. Trader, swing trader, investor, I think I'm above average, and I think that that's one of the reasons I'll be able to do this for the rest of my life. But as far as a day trader, I mean, you can go on FinTwit right now, and you can find people that post the actual, I'm not saying like the graphic with the big 100% gain. I'm talking about like the entries and the exits. And these guys make video, guys and gals, frankly, make videos about exactly what they're looking for, how they do this, how they do that. There's plenty of that on there for the purpose of day trading. But that's not really my thing. Like I was saying earlier, my thing is find a story, try to be early, and then have that thesis work over time. Because when it comes to portfolio construction, what's most important is that you're not just pigeonholed. I know a lot of day traders that are really good and really successful that are flat every day at the end of the night. And maybe they do have a separate account for investments and all of that. That's not the case for me. I've got long-term investments. I do have a long-term account that I separate because I want to like not look at it. I kind of want to force myself to not look at it almost. But in my regular account, I have a mixture of stuff. I've got stuff that pays me dividends. So I know on certain days when I wake up, my account's going to have more money in it. I don't have to do anything. And I know I'm going to get it. So I have dividend stocks in my account. I have long-term stuff in my account. I have speculative stuff in my account. I do trade options occasionally, although I highly recommend against doing that for newer traders, at least until you feel comfortable. Stick with the stock, stick with stuff that you know. So I would say that what's the most important thing is to diversify the portfolio. Now, the percentages on what you do, how much cash do you have, all of that stuff is kind of fungible, right? Like everyone's a little bit different. So I don't necessarily think that there's a right or a wrong answer there, but you have to have trades of different time horizons. You have to have trades with different thesis, and you have to have just different kinds of stock in a well-balanced portfolio. When in a day where tech is getting absolutely murdered, if you have a tech-heavy portfolio, that's going to weigh on you. And it's like you want to have something else to balance that off.
Well, how do you not have 1,000 positions, Ryan, for the people listening?
Yeah, so that's another good question. How do you not have 1,000 positions? Well, the first thing is that you learn real quick that you can definitely overtrade. Like overtrading is a thing. And I see this all the time because of the position that I'm at here at Benzinga. I'm often talking to newer traders. And one of the things that I notice is that a lot of them want to be active all the time, every single day. And they want to buy and sell. There's news every day. We want to do this every single day. And it's like, okay, if you can do that, if you're practiced at that, that's one thing. But that's not necessarily better. More doesn't equal better. In a lot of cases, less is actually more, right? In a lot of periods, the less trading I do, the more profit I make because I focus on just the quality positions and I keep those. So you asked me, how do I not have 1,000 positions? I really keep myself disciplined. If I'm looking for short-term stuff, I'm looking at maybe just a handful of different things that I'm willing to hold overnight. If I'm willing to hold a bunch of stuff overnight, they have to be long-term investable. Things like Apple or Goldman Sachs or something like that, Tesla or even SpaceX now. So it's discipline, and obviously you're also limited by funds, right? Like, if you start in this business and you have a $5,000 account, you're not going to have a whole lot of options. If you're fortunate enough to work that $5,000 account up to a $50,000 account, you have a lot more options, but probably you've kind of learned things along the way, and you've really kind of focused on things that have worked for you. So I'm a big proponent in being able to know what I own, know why I own it, and then be able to keep track of all of that stuff. More is not always better. And I had to learn that lesson early on.
Yeah, Warren Buffett and Charlie Munger, rest in peace, would tell you that. Rest in peace, Charlie Munger, not Warren Buffett. He's still kicking. Tell you that, concentration sometimes helps with your returns. And it can, especially if you're inside the proper position, but it can definitely kill you with your losses as well. Let's take a second here. I'm on the Benzinga site. You can see it, correct? Ryan?
Yep.
The tabs at the top, for the people listening, for the Main Street folks, walk us through those tabs and let's just explain what those different type of traders are, if you can do that for someone who doesn't quite understand.
I think the tabs that you're talking about are the custom day trading, swing trading, options, and long-term that I see on the screen.
Like a day trader versus a swing trader. You mentioned day trading and swing trading.
So just to take a step back here, the Benzinga Pro platform is a research platform, right? It's designed to give you information so that you can make better trades, but it tries to appeal to as many traders as possible. So there are day traders, there are swing traders, there are options traders, and there are long-term investors. And what we're trying to do with the different tabs there is we're trying to give you an idea of how you can use this platform to benefit any strategy that you might have. I think one of the big things that the entire team should be very proud of when it comes to Benzinga Pro is that we've created this tool that it serves such a huge addressable market. It serves any type of trader. But it has so many features in it that the downside of that is that it can be intimidating, right? There can be a learning curve. There can be the feeling that, well, gosh, I'm not using everything, so I'm not getting my money's worth. And that's just not the case. Those tabs that you had shown there at the top, we're trying to give you an idea of how you can use this tool to raise the tide for yourself.
Gotcha. And then once you go into the tabs, you just customize them for yourself or into whatever you're trying to go into.
Yeah, the tabs that you have there are more like ideas. When you're actually in the platform, it'll show you a bunch of different recommended workspaces. These are designed as starting off points to kind of give you ideas on what you can do, how you can set this up, and on all of that. The reality, though, is that this platform gives you full control over things. So if you want to create a specific news feed that only finds biotech news for phase 1 and 2 results that are positive, you can do all of that. So the degrees of freedom is so huge. You can literally do whatever you want with the platform. Having the different kind of headings up there allow folks to kind of get an idea of how they can use this instead of just looking at a blank canvas. Not everybody can look at a blank canvas and be like, I see the Mona Lisa. This is what I'm going to do. It doesn't work like that. And it doesn't work like that with Benzinga Pro either. So we try to give you some ideas of how some of this different stuff can work together. But ultimately, at the end of the day, it's up to you to create a customized workspace that fits you. What are you looking at? What's your trading style?
That's a great breakdown. It's almost like when I see art, I don't know what it is, but I know what I like. As they say with art.
Yeah.
I don't know what I'm looking at, but I know what I like.
Yeah, same with me. I don't necessarily know the history behind this, but damn, that looks cool.
Yeah. Speaking of history behind things, the stuff that looks cool, let's go into your show, man. How did you go from trading on the app, or I guess they didn't even have apps back then, trading online on the web, to actually getting a show, which is pretty cool show, man? And talk about your show, please. Let's for folks who don't know.
Okay, so this is actually one of the really magnificent things about my job and why I love Benzinga as a company. I would just say, just right on the top, I would say that Benzinga offers different avenues for skills and passion. And I am absolutely an example of that. So I told you that I was working a bunch of jobs I didn't like. I tried to become a full-time trader. I realized I needed to have something at the same time to give me guaranteed income so I could weather the bad times when I was trading. That is 100% the case. I feel even stronger about that now. I was in a different job that I had before, and it was okay. It allowed me to do this, but it was not terribly enjoyable, and I would get pulled away from things that I really did care about. So I was like, I'm just going to take a shot in the dark here. And Benzinga Pro had a chat room that had just become available. And I had typed in there, hey, I'm set up to do customer support because I've always been good with computers. In fact, I haven't bought a desktop machine since the 90s, probably a Dell from the 90s. So what I do is I build them. I buy the individual components and then I put the computer together and then I install everything. Like I've been doing that since I was 13 years old. Side note, when I was in college, I could fix people's crashed computers. And it would be amazing how many people would have a crashed computer when I was on emergency $100 an hour, fix it for you, right? Sunday night before you have a test on Monday, I don't know what to tell you. It is what it is. But that really kind of helped me get through college, or at least beer money for college. But I digress. Nice. As far as like computers go and manipulating software, it's been like a second, like a natural trait for me. And so the previous job that I had, I worked with this archaic software that did a really good job of what it was supposed to do, but it just wasn't that easy to use. So that company had brought me in to kind of bridge that gap between the end user that paid them and their own business, right? Like we wanted that software to work well for them, but it had nothing to do with stocks. It had nothing to do with finance. And so when I was doing this, when I had suggested that, I was like, hey, I'm set up to do customer support. If you ever have a need for that, let me know. They added me on LinkedIn. 6 months later, all of a sudden there was a position and they interviewed me for that. And then the rest is history. So as far as how did it start? It started by me getting my foot in the door. And I got my foot in the door by doing something that I knew I was good at and actually had on my resume. Customer support was something that I have been doing pretty much my whole life. I've always been the computer guy in some capacity. So once I got in there, I thought to myself, okay, Ryan, you're passionate about the market. You want to have a career that revolves around stocks in some capacity. And now your 9-to-5 job that you kind of need to help get yourself along, now that job is one in this very field. So and it's funny too, because the job, they hired me for a remote, and this was before COVID. So I was like remote before remote was cool. And it works really well for me, by the way, because I'm self-motivated and I'm a perfectionist in some cases. And I never run out of things to do. That is for sure. So remote work works for me. But I kept convincing, Benzinga wanted, for my first week, they flew me out. I live in Chicago. Benzinga's headquartered in Detroit. They flew me out there so that I could meet the team and for my first week, kind of learn the ropes from inside the office. Now, as you can imagine, I was very nervous, but I told myself going into that, I said, okay, this is your chance. Like, you don't necessarily want to be working at other jobs just to kind of get by until this clicks. This is your chance. If you make an impact here, this might be one of your last jobs. And that really sounded appealing to me at the time. So I was like, I'm going to give this a 110%. Like from the moment I walk in the door on Monday before we open, I am going to give everything I can 110%. So that's what I did. Now, the first week was a crash course in systems. I had to learn how to fill out tickets. I had to learn how to answer the phone. I knew how to use Pro, which is why they brought me on, but I had to learn everything else that they would do, the back end stuff and all of that. So that's what I did. And then once I got comfortable, and I would say that took about 2 to 3 weeks for me to get comfortable with everything that was going on there. Once I got comfortable, I was like, now we're going to push it. Now we're going to push it. Now we're going to try to do more. We're going to try to get involved in different things. So one of the first things that I got involved with were help videos because I knew the platform so well and I was able to explain technical things in a way that a layman can understand. I volunteered to do some help videos. And my boss at the time was like, these are great. I would like you to keep doing these. And I was like, awesome, because I like doing them. Like I had played around with streaming video games prior to that. So I know how to do all of this stuff. And I had all of the equipment already. So I was like, why don't I just try to accelerate this? Then I made the first version of our video course on how to use Benzinga Pro. And I didn't know how it was going to work. I used I used OBS. I used, my webcam. I put it so Benzinga was on the screen and I was in the corner, just like you would see if you go over to Twitch right now and you pick any streamer. It was that type of setup, except I was teaching folks how to use Benzinga Pro. And I wasn't sure what to expect from that, but once we got it live, it also had like quizzes in it just to kind of test your knowledge. Once we had it live, I started to see a whole bunch of people sign up for this. And then I started to get emails that were like, man, this is really good. This really helped. This is excellent. And I was like, okay, we got something here. So I'm just going to keep trying to do this more and more and more. And that just kind of grew. And eventually then COVID hit. And when COVID hit, I was like, okay, not disparaging anybody here. Okay. But there were people that lived around the office that would not go into the office because of COVID. I was like, I'm going to take a different approach. I'm going to say yes to everything and I'm going to go and I'm going to make myself valuable. And sure enough, that's exactly what happened. And once we said, hey, we're going to have an on-site, it's optional because COVID, I was like, yep, I want to go. Yep. And when's the next one? Because I want to go to that one too. And so I kept doing more and more, and I kept kind of evolving every day. And that's the one thing that I will say about Benzinga. They allow you to find your stride, especially back in those days. They were very, very encouraging. Like if you have an idea that you think is going to be good, do it. Jason Raznick, the company's founder, used to have an expression that said, ask for forgiveness, not for permission. And what he was trying to say is go try things, just do it. And if it's bad, say sorry, learn from it and move on. But don't wait around and ask. Just go out there and try things. And I took that seriously. Through COVID, we realized that there were a lot of people at home, a lot of people that wanted to get involved in the market, and YouTube was like a huge thing. So they actually hired people to do like a YouTube stream and all of that. And I just joined on one day. And as soon as I joined, I was like, okay, well, this is it. This is where I want to be. My co-host at the time was Mitch. I love that guy. I still think he's a great guy. We had a lot of fun. And then it just kind of evolved a little bit more. And I was like, you know what I really need to do is I need to focus on creating a community that's a little bit unique. So to your point about talking about the show, I wanted something that nobody else had. I didn't want to have an alert service. I didn't want to be looked at as a guru. I want our show and our community to feel like it felt for me. Like when I joined Benzinga Pro, I felt that I was joining a team of traders that I was constantly learning from. Learning good things and learning bad things, frankly. But I felt like that feedback loop, like being involved with other people that were doing this was going to make me better. And I stand by that to this day, not just within Benzinga Pro, but in general. And so I wanted to create that on the show. And so I started to think, okay, well, one of the things we're going to tell people is that there's no dumb questions. Like if you get on there and you say, what's an option? I'll answer that. I don't think that's a dumb question. I won't answer it 6 times a show, but I'll answer it because I want there's a perception from folks that are not involved in the market that it's very Wall Street and it's very elitist and all of that. And I've known people that are just regular Joes that make it in the market and then it changes their life going forward. So I wanted to have this feeling that, look, you don't have to be a Wall Street baby. You don't have to be connected to someone at a hedge fund. You can be a regular guy. It doesn't matter what you do or what you're interested in. If you work hard and you pay attention to what's going on in the market, you can make this work for you. And I was like, that's what I want the main core of the show to be. And you know what I'll do in order to do that? I'll share Benzinga Pro because this is the tool that helped me get to that spot. I'm an expert with the tool. And so what we'll do is I'll just kind of show that and we'll show how we can trade. And then I realized that people were having fun. And I also knew that this job, like the days that are good, Marcus, the days that are good are so good. You literally feel like nobody can touch you, like you're invincible. But on the flip side, the days that are bad, you're like rethinking your life. Like, is this really what I want to do? And I realized there had to be like a middle ground in there. And you have to be able to control your emotions. Because if you're like emotionally not right, trading is exponentially more difficult. At least it is for me. I don't know if it's like that for everybody. But if you don't feel good, if your emotions are bad, probably not a good day to trade, especially with any type of size. So I wanted to create this environment where people had fun and people are entertained, but at the same time, they're learning for themselves. So this is why you've joined the show a lot. So this is why I will often, like, we'll be talking about a stock. Someone will say, give me levels for stock XYZ. We'll do it. And then I'll turn around and ask the group, what do you think about it? What do you think about those? What levels do you see? What do you think about this news? Do you like a different peer? Do you have a different viewpoint? And I want to create this community where we can all help one another. And I'm very fortunate because during COVID, 13, my co-host on the morning show that you're asking about, he's just a customer of Benzinga. And he started, like me, at a ground floor. And very, very quickly, I was like, this guy is sharp. This guy is really good at looking at charts. He's really sharp. And when he gets on a task, he like does A+ quality research. I was like, this is a guy in our community from what we're trying to do, from our customer pool that we should try to promote. This is another example of a regular guy. You can do it. You can do it if you put the work in. He's a great example of that. Eventually, I was able to bring him on, and that's kind of where we're at now. So the show I love it because it's basically a reflection of what I'm doing all of the time, but I've amplified it by bringing a whole bunch of other people in it. And now we're at the point where I will get trading ideas from the audience just because we've got so many people looking at so many different things.
Yeah, show's great, man. 1 to the 3, 13's good. You bring on guests and show interviews. People need to check out your show for those who have not checked it out. I mean,
definitely. We have a great community.
Yeah, I don't even want to glean on. Yeah, you defended the community the other day. I think someone got you a little agitated when what were they commenting on? Why are we talking about certain stocks or something? You were like, dude,
oh yeah,
more than a day.
Yeah, I mean, well, here's the thing. Like that's the other thing. Like I realized that not everybody is going to trade the same thing, and so I try to keep the show segmented in a way where we're going to be able to cover some of that stuff. I will say I'm a little bit biased against penny stocks. Just going to say that. I totally admit it. But for the most part, like if this is a Chinese $2 micro cap pump, if you think there's a trade there, let's talk about that. And I think what you're referencing is that there are a number of folks that join that are like, why are we wasting time with this piece of junk China name when we could be talking about Micron or Marvell? And like, there's some truth to that. They're not, these people aren't wrong. Like I get it, but at the same time, we're trying to appeal to a broader audience. And it's just, every day when the same stocks are being brought up or when the same thing is being brought up, like I want to keep that spice, right? Like I want to keep that diversity that we've talked about. I would say that I don't know that I'm actually aggravated. I am so lucky with what I am able to do. I'm lucky with where I live. I'm lucky with my health. So I don't know that I'm actually aggravated. It's more just, how do you effectively deal with random people on the internet that you've never met? Sometimes you got to put your foot down.
Trolls are they're definitely something. Sometimes you got to ignore them, but yeah, you definitely got to like.
It's part of it. It's part of it. You got to be able to like laugh that off,
If you don't have a troll or someone in there trolling, you're probably not doing enough anyway.
That's right. That's absolutely right.
Yeah. So just talking about the show, where do you see the show in like a year and 5 years from now? I know you think that far.
Yeah, that's a good question. First of all, it is hard to see that far ahead. I also sometimes I will consult my magic 8-ball, and even that doesn't do the greatest job all the time. So this is subject to change. Where I see it, what I would really like to do is I would like to continue to be able to add different guests to it. I want to bring different people on from different areas of the trading and finance world. I want to bring on more CEOs. It turns out, I love interviewing these CEOs. I love interviewing other traders. I love kind of picking your brain about what is it that you see or what is it that you think. And again, that really goes back to the ethos of trying to raise the tide for everybody. And I feel like, why would you read a story that you see in some publication? I won't even name a specific one, just generally. If you can hear directly from the CEO himself or herself, why would you not want that? Sure, that you want to get a second opinion, you want someone more experienced, you want to do that, that's fine. But don't you want to hear from the people themselves? So I try to do that as best I can. I try to bring on as many people as I can. Because again, for a viewer in the show, I don't want you to be like, okay, the guys on the screen are hitting buy now, so that's what I should be doing. That's not the goal. The goal is, okay, there's information being presented here. How does that factor into a trade? Is this good for a trade? Is this bad for a trade? Is this something I never thought about? Maybe this is something that I should look into. And I think bringing on CEOs that are talking about their forward vision and what they want for the company is a really good way of doing that. So where do I see the show a year from now? I would like to just do more of that. I'd like to have more people in the community that are actually about helping others, or I shouldn't even say that. I should say participating in what we're trying to build. I'd like to talk to more traders. I'd like to talk to more CEOs. I'd like to talk to more people that are involved in finance. I'd love to get guys on like Dan Ives or Gene Munster who have been doing this for a long time and be like, what is it that you think? Tell me what you think. So that's kind of where I see the show going.
Oh, cool. I might can connect you with Dan, like if you're on LinkedIn.
Oh yeah, absolutely. Connect us. I would absolutely love that.
We'll see what happens.
And I heard he's doing his own thing now. I heard he left Wedbush. He's going to do his own thing. Good for him.
Yeah, I saw. We're connected on LinkedIn X. Sent some messages. Not like I'm going to his house or anything like that. Don't get it twisted, of course. But like definitely make some kind of like intro. Yeah, and that would be good, man. Your show is really good. Who would you say your show is actually designed for?
My show is designed for anybody that benefits from doing their trading, investing, or research with other people. There are some people that I know that they are just like, not now, chief, I'm in the zone. Like they're locked into what they're doing. They're locked into their scanner. They're locked into their thing. They're locked into their news. They got whatever going on. They got their routine. Okay, it might not be for that. I still want to bridge that guy. I still want to break into that. But what this is for the people that say, man, I feel more confident when I'm able to bounce ideas off other people. I feel like I see more when I work with a community. If you feel that you do better in the presence of other like-minded people, that's the people that I want in the community. That's what I want to grow. So that's who the show is for, to be quite honest with you.
Got you. And like when you first started the show, were you saying like 10 people showing up to your stream and now it's grown? Or
no,
I'm built in.
I'm very, very fortunate in that regard. No, it wasn't like that. It was, first of all, because when we first started the video show, I wasn't part of it, right? It was Mitch, and I think there was actually somebody else in there. And then there was another show before us. And by the way, I will mention these guys' names. It was Dennis Dick and Joel L. Conan, and they were doing the pre-market prep show. You have to understand, before I worked at Benzinga, I watched that show. I watched Dennis Dick like he was someone that knew more than me, and he is still. And then I got to meet them, right? I got to meet Joel in person when I worked for Benzinga. So I was very, very fortunate that I kind of stepped into something that kind of already had, I would say, stage one completed. But so I wasn't really dealing with just the 10 people showing up. I was dealing with more than that, but I realized that, especially when things started to go different directions, I realized that I needed to carve out my own niche here. And I need to do something that is unique that people want to come back for. And I think that I've done an all right job of that so far.
What do you think your secret sauce was compared to what
I think my secret sauce, again, low barrier to entry, right? This is a field that can be very complex depending on what you're reading about. I mean, I read some of these press releases right now. I'm like, what the hell is going on? Like, give me the AI tool to help me because I don't understand half of this stuff already. But it's a good learning opportunity. So anyone that wants to be entertained, anyone that wants to just kind of learn more, that's who's going to be most effective.
Got you. And with your show coming on, you're out there, and like you said, you're in Chicago, so you're in Central Time. So you're an hour, I guess that's an hour earlier for you when the market opens at 9:30. So you're open at 8:30. What's your like morning look like? What does it look like to get up and start a morning show like that?
That's a great question. It is a whirlwind. I wake up at 4:30 a.m. Central Time. I stumble out of my bedroom to my coffee machine so that I can actually get through the day. I make my first cup of coffee and I sit down on the couch and I start to sip that and I turn on CNBC. And this kind of gives me an idea of what's going on. Then I'll do some push-ups. And once I get to a spot where I feel like I've woken up, that generally takes 20 minutes or so, I get into the shower. I get all ready for the day. And then I get back to my desk. I shoot for being back at my desk before 6 a.m. A good day, I'm at desk at somewhere, but maybe 5:45, let's call it. All right. So I sit down at my desk. I immediately load up Pro, and then I roll through the different workspaces that I have on Pro that kind of get me ready. But I'm preparing for the show. So I first make sure that I know what's taken place from when I signed off the day before to where I am now. What are the big stories? What's the market doing? Then I have to select news that I want to cover. I always do our stock market update because that's like a kitchen sink story that's really incredible. And then I try to pick news that I think the people that are joining want to hear about. So, for example, things about robo-taxis, things about AI, things about the memory names, these things about drones, these popular things that the audience talks about every single day. When I'm sifting through the news, I'm thinking, the group would like that, the group would like that, the group would like that. And I make sure that I have enough news to get me through the morning, the A block, as we call it. We, as you know, we try to line up different guests for that. So we've got great repeat guests like Tim Melvin, Mark Petrino, Anne Marie Band, these people that have worked with us for a long time that are just absolutely phenomenal, both phenomenal people in the market and phenomenal human beings on top of that. And it's just about kind of getting ready. So when it comes to Benzinga, I take a look at why stocks are moving. I take a look at what the broader market is doing. Then I look for the list of gappers. I say, okay, what stocks are gapping here? Do I see any trends in here? Do I recognize any of these stocks? And then what stocks are new issues, if you will, or have a new piece of news, or I don't really know what's going on. And I kind of separate those. Then I prepare the news for the show. Then I think about my little opener that I try to get a smile with every single day. Then I make sure all of the audio and video is ready. Then I speak with my producer to make sure that we have a understanding of what the rundown is for the show that day. Then we go live.
Boom. And then you're only like 3 hours.
Yeah, we go live at 7 a.m. Central, and we sign off at either 9:30 or 10 Central. So it's 2.5 or 3 hours every day.
And then when you finish that, what do you do?
After that, I am at that point. I'm up. I've been 100, and I've been sitting for 3 hours. So the very first thing I do is I get up and I go take a walk. I get outside. I go touch grass. I breathe in fresh air. And I don't want to hear, I live in Chicago, so I don't want to hear any of this. It's cold. No. It could be minus 10 degrees. I am outside getting fresh air and moving around. The human body needs that. We cannot sit at a computer terminal for 12 hours a day, every day. It is not good for your mental health. It's not good for your physical health. So every single day, I do some type of exercise, some type of movement after my 3-hour session, or actually with the prep hour, it's actually 4 hours right away. And then as soon as I get back from that, I dive into what I need to do at work. I answer emails. I answer support tickets. I work with the team here, both on the content team, the video team, the B2C team, which is business to customer, which is our subscriptions. I go over whatever we need to do for the product itself. So we'll have meetings about what we're planning for the next installment of the product. We have team meetings and all of that. So I do all of that work stuff pretty much the rest of the day. And then every Monday through Thursday, we have the happy hour show. The happy hour show is a Zoom call. It's only for pro customers. We want really to keep that exclusive. It is a Zoom call. And this thing, remember I was telling you about Jason Raznick saying, ask for forgiveness, not for permission. This was one of those things. This was born out of that. It was during COVID. Everyone's at home. We realized all people wanted to do was talk about the market. So I figured I got an idea. Why don't I create we'll call it a happy hour, right? And actually, at the early days of that, I was encouraging people to bring their own booze to that, because I was like, the work day is over. Let's have some fun. Let's lighten the mood here. So we created this show called Happy Hour, where we basically just shot the shit about what happened. We talked about the day, we looked at charts, we looked at setups and all of that. More and more people started to join. And within like literally the first month, I started to realize that I was getting people that were joining that from all these different walks of life. And I was like, man, there's value here. Like one of the guys that's been joining since COVID is a retired 40-year private equity veteran. Imagine the amount of things he knows. Just for a second, imagine that. So what we do, we have this thing, we had a piece of news about stock XYZ. We say, what does this mean? And he'll, a lot of the times he'll say, I've seen stuff like this before. I know this, I've got this trading idea. We kind of blend all of these different people and their very unique backgrounds into one group where we just talk about stock ideas or talk about what happened. Actually, a couple of years ago, we had a gentleman that worked for Google who was of Iranian descent. And one of the days, he was just kind of talking about what it was like. And a couple of the folks in the happy hour asked him about what was life like. And that session turned into a 30-minute history lesson on what happened and how a lot of these people fled Iran back in the day and why and all of that. So you never really know what's going to happen there. But again, that was born just out of just try something. We knew people were at home. We knew people wanted to talk about stocks. So we tried something and it's been running ever since.
Man, that's extremely cool. And the history of all of it definitely matters. People more than folks realize, especially when you're investing, when you're learning about community, because you're going to have bad days in the market. The people on Wall Street clap every day when the market closes because they make money whether it goes up or goes down. But individual traders, they don't have that same hedge or back funding to be able to do that. I know I don't want to steal all your time. Just a couple more things I want to talk about. Let's talk about, in digital crypto, let's just throw in IPOs and SpaceX. What's your take? What's over there? Where are you sitting over there in Benzinga right now? Because I know there was a shift where people were saying is the SpaceX IPO forcing people to leave Bitcoin and crypto? Is that why we're seeing large caps come down, which even continue today, like you mentioned with the market, we saw six coming down. So what are you seeing over there at Benzinga? Where y'all hearing crypto and IPOs and space?
What I can say with crypto, and I have learned this since I started at Benzinga, there is absolutely an appetite for this. There are people that have worked here, and there are also people that still currently work here that are big on crypto, big believers of this. So you asked me, what do I see over at Benzinga about crypto? I see there is a future here, and it might be kind of wintry right now, right? It might be a little bit of a stormy night right now. When Bitcoin was hitting new highs, 120,000, this and that, I mean, it was wild times. There were a lot of folks that had Bitcoin from very, very low prices. My first Bitcoin buy, by the way, was 6,000. So nice. And I felt late at the time, but that's neither here nor there. So as far as Bitcoin goes, we're kind of on pause right now. It's a little bit of a winter, but there's a huge appetite for it, and it is definitely not off the radar. Now, as far as SpaceX goes and the rest of these IPOs, it is all of the rage. I mean, SpaceX, I think this company 10 years from now could be one of the most influential companies in American history, depending on what happens and what we end up doing. They are just into so much. There's an AI angle. There's a leaving the planet angle, which is still difficult to kind of wrap your mind around. Before, that had really only been done by the government and NASA and things like that. And it's like now we have private companies that are like, actually, we want to go to a different planet and we want to mine asteroids and all this crazy stuff. So to me, one of the things that's so exciting about this job is that there is so much cool stuff in the future. And the SpaceX and some of these other IPOs that we're expecting, like OpenAI, Anthropic, and so on and so forth, it is all part of the same story. The future is going to be incredibly exciting. And we feel as if we're kind of at the nexus of that. So a lot of the people that work here are news junkies too, right? So a new piece of news comes out, they want to be the first to read it. They want to understand that. And that attitude is just kind of pervasive around here. So a lot of optimism, I would say, to answer your question.
A lot of optimism. You mentioned that you got in Bitcoin at 6,000. What inspired you to buy Bitcoin?
Just talking to friends. I was talking to friends. They were trying to explain this to me. At first, I was like, I don't really get why you would do this. And then I watched it go from 5,000 to 6,500. And I was like, okay, maybe it's not just like this fad story or something. Maybe there's actually something going on here. And then I would have my friend kind of explain it to me. And I admit I didn't totally understand it. I was like, decentralized what? There's no paper? Well, what are you talking about? But I started to just kind of watch it. And I was like, oh, I'll try it. Couple $100 at 6,000. A couple weeks later, it was 18,000. And I'm like, oh my God. And then it would come back to 7,000. I'll buy a little bit more here. And it would go to 20,000. I'm like, that was a good move. That was a good move. So where did I learn about it? I learned about it from a friend. I saw its volatility. And as I started to read more and more about it, I was like, there's a lot of really good ideas here. A lot of really, really good things here. So I think this is going to be one of those things where down the road, you're going to look back on it and be like, oh my gosh, I cannot believe that I didn't do that. So I was like, at this point, I didn't have a lot of money at the time. I was like, I'm going to put what I can in here. And that ended up going huge. So
are you still holding, as they say? Holding?
No, I do have some. I have all of my Ethereum. I've never sold Ethereum because I stake it and earn APY off of it. But I did finally crack, and I did sell a large chunk of my Bitcoin. I ended up buying a BMW with it.
It's not a bad thing to do, man.
No,
you said with like regret, like,
well,
I sold my Bitcoin.
Well, because like, look, I say that now, but if in 10 years from now, someone finds this podcast and they look back at the date and they're like, so he sold his Bitcoin at 100,000, and then they look over at the current price of Bitcoin and it's 1.1. We'll see if it was worth it then. It was definitely worth it now. This way. And here's the other thing about that. One of the reasons I chose to do that is because along this Bitcoin journey, I cannot even count the number of times I've been told by people that I know, this is a scam. It's a fraud. You're going to lose it all. I remember when this first was happening, when it first went to 18,000, the guy that I was working for at the time, he's like, look, this is like a triple from where you bought it. Like, I'd probably sell it. I'm like, no, I think there's more to this. Like, what's a couple grand? Like, I want to make more than that. And he's like, oh, it's silly. And then it went back down to 7K. It's like, I told you. And then it's at 50K. And I'm like, sup? Yeah. What's going on? So there was definitely like an element of, I told you so, when I ended up selling that. But
got you. Yeah, man. I don't know, from 5,000 to 100,000 versus 100,000 to 1 million. Those are both fine percentages. You know what I mean?
Yeah.
Increases.
Yeah.
Like, no one's complaining about that. No one's complaining about that.
Just to be clear, I'm not complaining about any of it. Okay, so a digital currency 10 years ago, or maybe not 10 years ago, maybe 15 years ago, I'd have laughed at you if you had tried to pitch me on that. Now I've owned one. Now I've actually made money off of it. And now I've exchanged it for something in the physical world that I use every day and love. So the circle's complete, my man.
Did you pay for it?
Yeah, it was actually a down payment. I didn't pay for the entire. And actually, it's funny because when I was in the dealership, I asked them, I said, do you take Bitcoin? And they're like, nah, bro. So I actually had to sell the Bitcoin and use the fiat for the down payment. But
yeah, John, that's actually really cool. That's really cool. Ryan, before we hop off, man, it's been a really good conversation. I could talk to you for like 2, 3, 5 hours, but we can't do that today. Before we go, so everyone in the world always sees, well, not everyone in the world, but like we're sitting like on your show and just in general, everyone sees everything going great. Traders usually see it great. And if it's not good, it's usually for a day. We've been at a time where buy the dip has just worked. Retail trader has carried this market since 2025. You asked me, what could break this market? What would be a sign you see where it's like, okay, it's time to do something different? And what would you do?
Okay, that's a really good question. What could break this market? Well, given where we sit here today, I'm going to be a prisoner of the moment. Looking like it's not going to amount to anything would really create trouble for this market. No question about that. More specifically, if we see a retreat or a very fast retreat in the price of memory or DRAM, I think that could also serve as a downside catalyst here. If it turns out that some of these circular funding worries from some of these AI companies actually creates a big problem that leads to like a company collapsing, I think that could be a calamity for a lot of these other stocks and then subsequently the market. But I'll be honest, man, other than that, the way that the market just kind of handles some of the different like macro things that you can't predict, like the conflict in Iran and all of that stuff, the way it handles it, man, it feels tough to come up with things that would really break it. I would say just a huge like like tragedy to the American government or something. I didn't even want to put it into the universe. But if something really, really terrible happens to, you know, the American government or the American financial system, of course that could end up kind of cracking things. But ultimately, I think I want everyone to remember that breakdowns are not necessarily a bad thing. If you're getting ready to cash everything out and the market declines by 50%, it's going to suck. I'm not trying to, you know, sell you a bill of goods here. But if you're young or if you've just gotten into this, big time pullback in the market is actually what you want, because you're going to be able to buy quality companies at discounted prices. And the final lesson here about this is that there will never be a time, at least that I can see, where I would bet against America. I'm just not going to do that. I'm not ever going to do that. We have our flaws. We have our things that don't work sometimes, and there might be some things to avoid. But in terms of outright betting against it, never going to happen. There is nothing in this world that has created more wealth than the United States stock market. And so when you talk about what a crack, a move down, that's I almost as a reset. Now it's time for new flowers to get planted and new gardens to grow. I'm always going to approach it with a glass half full mentality.
Very good. Very good. Great way to frame it. And people should realize that, yeah, unless you're retiring in like the next year or two and you need that cash, these dips that we see are like really great buying opportunities. Volatility is where you make a lot of money. The alpha created inside of there. You could take the approach that Ryan took where he bought the stock at $9 and went down to 70 cents. And I guess he just kept buying it, you know, buying those dips, and he saw the returns. It's just great framing and great way to think. And the American exceptionalism trade, people say whatever they may say about it, but it worked for several years, and it looks like it's going back to where we're framing it right now. It seems that we're going back to the American exceptionalism trade. Ryan, I said in the chat that I was going to ask a couple questions before we go. What's your favorite color?
My favorite color, I would say it's a tie between green, blue, and purple. I guess there are some art or color nerds out there that say black's not a color. I love black. So I would say black, blue, green, and purple. A tie really depends on my mood.
You just named 5 colors. You are a Bears
4.
fan. 4. Yeah, and I'm a Raiders fan with that math.
Okay.
Several colors. Favorite Power Ranger?
Favorite Power Ranger? Gosh. So it started off as the green one. I think his name was Tommy. He was tall and had a sweet ponytail. He would whoop ass back then. But very quick back then, it didn't take long for it to be the pink one. I mean, she was super cute. I don't know what to say.
She's still running around somewhere, I think.
I'm sure.
Any message you want to give to anyone watching this podcast, whether it's now or, like you said, 10 years in the future?
Yeah. Okay. So the advice. So definitely, if you're interested in making your life better, definitely think about finance. If you absolutely hate numbers and you can't, and you have like a mental block for that type of thing, find a financial advisor, or better yet, a fiduciary, someone that can actually help you and look out for your financial best interests. But that's a caveat, because what I've learned in my life is that there is absolutely nobody in this world that cares more about your money than you do. So learn what the different levers are. Learn how to make it work for you. Learn how you can kind of generate that. Learn how to build wealth so that you can enjoy the latter years in your life when things might get a little bit more difficult, or you don't have some of your circle around you. Warren Buffett has a famous quote. I might butcher it here, so I'll just paraphrase it. You have to find a way to make money while you sleep. Otherwise, you're going to work until you die. And I'll be honest with you, Marcus, life is too beautiful and too grand to spend the entire time working. I'm driven. I have goals. I've got things I want to do. But man, I like enjoying it too. I like enjoying life. I'm given one of these. I want to make the most of it. And so I want to be as active as possible in creating my financial future and giving myself the freedom to do things in my life that are important for me. And I think everybody else should do the same thing.
That's very good. That's great. Great points. Great way to frame and way to see things. Ron, how do you say your last name? Faluna?
Faluna. So just I'll just get the elephant in the room, just get it out of the way. When I was a kid, I would get made fun of. It was very, very easy to see my last name and say Baluna or Balbuna or any other funny word based off that. It's pronounced Faluna. The story goes is that I'm half Irish, half Polish. The name itself is Irish. The story goes is that when my Irish ancestors arrived here in America, they were horse thieves in Ireland, and the name was O'Fallon. And in order to avoid being detected and to be more American, they took the O and moved it from the outside to the middle and added an A at the end for America. And
That's pretty American
Falunas.
right there. That's about as American as it gets, man. I'm going to let you go, Ryan.
Like it.
One more question. Last question. If you were not here, if you died tomorrow, what would you want the world to remember you for?
Oh man, I didn't think you were going to go that deep.
Boom.
I would think that I would want the world to know that every day I did my best to try and raise the tide for everybody around me. It doesn't matter if we're watching a Bears game. It doesn't matter if we're trading stocks. It doesn't matter if we're doing something for work. It doesn't matter if we're just hanging out, washing cars or something like that. I tried my best to make things better for those around me. Because I think that it's very easy to be selfish in life, especially when you're kind of focusing on your own goals and all of that. But if you can actually make the life around you better, there is so much reward in that I would want people to be able to remember that.
I think you've made your mark with that one, Ryan. That's good stuff, man. For anyone who wants to find you, tell them where they can find you and end this episode, Ryan. How about that? I'll let you
Okay,
go.
that sounds good. You can find me on X. I am at rfaluna, so that's RALOONA. Of course, you can also find me here at Benzinga. Just type Benzinga into YouTube and you're going to see videos with my face on it. If you join our ecosystem, you will probably see me in some capacity at some point, or you'll be able to talk to me. Or you know what, man? Why don't you just go watch Pre-Market Playbook? www.youtube.com/@Benzinga. You can join our show every single morning. We talk about the market, obviously. We talk about investments, but we have fun. We talk about sports. We talk about pop culture. We talk about life. Come hang out. Come say hi.
Main Street Hard meets Wall Street Smarts. Thanks, Ryan, for joining us. That's great.
My pleasure, Marcus. Thank you.
What another great session with Ryan Faluna. We just took you inside the engine room, stripped away the media noise, and showed you exactly how institutional order flows, block trades, and unusual option sweeps dictate momentum before it ever hits mainstream headlines. This is how you bridge the gap between Main Street and Wall Street. Now, we didn't drop this level of raw, actionable data just for you to sit on it. It's time to execute. I need you to take action right now to solidify your edge. Hit the like button and subscribe. If today's deep dive gave you a clear view of the market, hit that like button, subscribe to the channel, and turn on the notification bell so you never miss an instant premiere live strategy session. Also, share this broadcast. Don't let your circle trade blindly on old headlines. Share this video right now with at least one investor or trader or family member who needs to stop guessing and start leveraging real-time market mechanics. Please drop your comments below. We want to hear from the community. What specific scanning tools or data indicators that Ryan broke into today or you implement into your game plan first? Drop it in the live chat or comment section below. Ryan and I'll be checking in. Then if you're over on LinkedIn, check out the Wall Street South Journal. It's a great place to get some of my market insights. And then if you're looking to upgrade your financial tools, you can give a trial or check out Benzinga Pro. There'll be a description in the link. Also, Monarch Money for budgeting and budgeting tools to help you clean up your budget and track your net worth automatically. See how your portfolio grows. These are affiliate links to this one, so if you do use them, I may be compensated at no extra charge to you. But Ryan, thank you again for bringing that fire to the show and the community with real execution looks like. Family, the data is in front of you. Tools are in the description. Stop reacting, start strategizing. Remember, you got to make informed decisions. I'm Marcus Dermott Sr., founder of the ABC Square financial planning firm, host of the Main Street Meets Wall Street podcast. Let's keep building. Let's keep executing. We'll see you next live stream. Remember, Main Street Heart meets Wall Street Smarts. So much on this channel right now. Share it with someone. It's an outlet. Thank you, Main Street. More sports talk is just noise. Rehash stats and the same tired headlines. Tonight we're doing something different. We're stripping back the layers of a multi-billion-dollar machine, from the locker room to the sweet seat, and from the gambling scandals rocking collegiate sports to the high-stake equity plays on Wall Street. Cut through the statistics, I'm joined by LinkedIn sports editor John Tomasi. This isn't just a guest appearance. It's a collision of worlds that doesn't exist anywhere else. We're bridging the gap between institutional knowledge and the brutal realities of professional and insider editorial roadmap for building true career capital. Whether you're here for the breakdown of the next market influence, or you're looking at the master the algorithm, which we don't have the secret, and build a premium digital signal, we're auditing all that. John, thanks for hopping on, man. How are you?
I'm doing great, Marcus. Thanks for having me. That's quite the intro. I'm ready to bridge everything you were just talking about.
Exactly. Excellent. Excellent. And just so folks know, just to let you know where we're going today, we will be covering the NBA Finals, the World Cup. We're going to talk about the NILs in Major League Baseball, AI and .com. I have an interesting thought on Bobby Bonilla, how that contract can play out for athletes nowadays. Look at the broke profile. That was a big thing that I wrote about in the Wall Street South Journal. And then obviously John can tell us about being the LinkedIn sports editor, some Q&A. We'll wait a couple minutes here for some more people to hop in. John, just tell us a little bit about yourself, John, before we get started.
Sure thing. So born and raised in Boston. I'm one of those people who never left. I went to college here. I grew up reading the great sports pages here, Boston Globe, Boston Herald, guys like Dan Shaughnessy and Bob Ryan and Ron Borges. And you go down Tim Horgan, like you go down the list. Those guys are actually my heroes. I grew up kind of in the 80s during the Bird era. So Celtics were my team growing up. And I played basketball in high school. I played Little League as a kid. I wasn't great at any of them, but I loved playing sports. But I always knew I was going to end up as a sports writer. In third grade, I had an elementary school teacher. We had to write on a little piece of paper, what do you want to be when you grow up? And, most kids wrote fireman or whatever. And I wrote sports writer. So I knew like in third grade, that's what I wanted to be. And that's what I was able to do for virtually my whole career here. I wrote for a paper in Massachusetts called the Lawrence Eagle Tribune. I covered the Red Sox when they won the World Series in 2004. I moved to the Boston Herald, where I covered the Patriots and the Red Sox. I went to WEEI, sports radio station, so I hosted talk shows there. Still covered all the teams. I was there when the Sox won in 04 and 13 and 18, when the Patriots won in 05, the Patriots' perfect season in 07 that didn't end so well. Celtics when they won in 08, I was there for that. I was in LA when they had their incredible comeback in game 5 or game 4. Now, game 4, I want to say. Great experience for me. I'd always been somebody who followed the business stuff anyway. And now to sort of mix these worlds with LinkedIn launching a sports product, it's been a lot of fun, to look at these from the perspective of the business side and obviously bringing my expertise as someone who's covered all these teams and games and, has been in locker rooms and had relationships with players and executives and that kind of stuff. I think I have a pretty good handle on both sides of it. And, seeing the business world, your world, and how it intersects with sports has been really fascinating for me.
Excellent. So you said LinkedIn that's a pretty robust career as well. You said LinkedIn is launching an initiative with their sports section. You want to expand on that a little bit?
Yeah. So, we're just, if you look around, there's a lot of different sites that are leaning into sports. Just today, Time Magazine came out. They always have the Time 100, the 100 most influential people in the world. Well, they just came out with the Time Sports 100. So it's the 100 most influential sports figures in the world. Yahoo, if you look at them, they just launched a whole business section. So I think a lot of people are looking at sports as a way to capture attention.
Business. Oh, and here we go. I was here for this.
Sorry.
Oh, you can let that. You can absolutely let that play if you like.
I'm going to let it play. Don't you worry. Keep talking.
Yeah. So anyway, LinkedIn is trying out sports. We are pushing more sports coverage to see if we can expand our readership. I think that's how everybody looks at sports right now. And sports business is such a huge thing. A lot of it is laid out in the list that you put up to start this episode, between NIL, between labor stuff in baseball, between franchise relocation, between players and their personal brands, which have never been bigger, with social media, with all this stuff. There's just so many ways where sports and business really are intersecting. And so we're trying to get in on that as well.
Very cool. Very cool. That's something we're definitely going to come back to a little bit later on. We go into the LinkedIn section where we can ask some questions. Whether people are asking them or not, I definitely have some questions for you.
Sure thing.
I do want to take you back. So John doesn't know about any of these clips I'm going to play. So we're going to play this one right here. I want you to think. John and I have had conversations offline about, he's a Red Sox fan. I'm a Yankees fan. He's a Patriots fan. I'm a Raiders fan and a Panthers fan, but there were no Panthers first. So it's pretty much, diverse, but we mesh here. So take a second. I want you to listen to this and then tell me where you were when both of these things happened.
Back to Folk. Red Sox fans have longed to hear it. The Boston Red Sox are...
Direct snap to Brady. Standing in there. Looks to the left, loses the football. It's on the ground, and let's see if it's a fumble or a pass attempt. I believe it's going to be called a fumble. It is. And the Oakland Raiders recovered.
We didn't have Woodson blocked, and really Tom should have read that and gotten rid of the ball. He was looking on the other side of the field. Woodson stripped them.
All of New England, all of the nation saw Woodson coming. The Raiders are 143 away from going back to the AFC Championship game.
I couldn't believe that I fumbled the ball to lose the game.
That part. The last thing you said, right?
The truth right there. So we'll start with the Red Sox. So I was there in St. Louis in 2004 when they won. The moment they won, however, never saw it. We were all on our way down because you have to be down on the field in the clubhouse when the game ends. You can't sit in the press box and then make it down for all that stuff through the rush of fans and all of that. So oftentimes you go down early. So I heard that. I think I heard that over a TV monitor as I was lined up outside the Red Sox clubhouse because we knew they had won. So we had to get in there. So that's one of those, it's kind of funny. You're there, but you don't see it. I had a similar experience when the Patriots won the Super Bowl in 2005 against Carolina. Again, see the end of that game because I was down trying to get in to the locker room. So that's how that goes. As far as the Snow Bowl game, now this is a famously painful moment for Raiders fans like Marcus because Tom Brady clearly fumbled. And if you're unfamiliar with that play, there was a very arcane rule that the NFL did away with after this game. But unfortunately for Marcus, and fortunately for the Patriots dynasty, it was in play. It was ruled that Brady was tucking the football instead of passing it. So therefore it couldn't be a fumble. Which was just an insane rule then and now. Every time you see it, you can't believe it happened. I was working in my office that night. We had separate Patriots writers, so I was helping lay out the section. I was watching that game on TV, and I was as dumbfounded as everyone else.
Yeah, you had to be disgusted when you saw that play. Like, you had to think, like, oh, we just lost the game. Because I saw that play, the Brady play, and I was like, exactly what they all said. That's a fumble. Even when they reviewed it, it's like, when they had the note card that they stuck down. That was against the Raiders too, if I remember correctly. You remember the official stuck the note card down in between to see if it was a first down on Sunday Night Football?
Yep.
I was against the Raiders too, so there's a conspiracy theory. Hopefully.
Well, I will say real quick, this goes back before either of our times, but in the 70s, the Patriots lost a playoff game a year they probably would have won the Super Bowl. I think it was 1976 because of a phantom roughing the passer call on Sugar Bear Hamilton against Ken Stabler, and Patriots fans were incensed about that call. It was every bit as bad, and it cost the Patriots a chance to go to the Super Bowl. So maybe the universe evened out right there with the tuck rule.
I think that's some revisionist history right there up in Boston. So that's why I'm going to take that as, like, come on, man. But so going back from that to where we are in modern sports, right? People are like, y'all keep reminiscing. The finals, right? We're in the NHL finals are 2-1. The NBA finals are 2-1 right now. We got the NHL game 4 coming off tonight. Don't worry, folks. We'll have you off in time to check out the game. But the way these teams are constructed, particularly in the NBA, is you have the Knicks, where Jalen Brunson took a pay cut, essentially bet on himself, but took a pay cut. and then you have the Spurs, but they're still like the second largest payroll. And then you have the Spurs, who are a much smaller payroll and building out. How does that compare to the Boston teams? Because I remember the Brady took a pay cut with the Patriots, but the Red Sox, they went all in like the Yankees, correct?
Oh yeah. The Red Sox, not anymore, and that's why they're in last place. They used to be huge spenders. They signed Manny Ramirez. They traded for Pedro Martinez and extended him. They gave Nomar Garcia-Parra kind of a big contract before they traded him, but they had just a parade. Josh Beckett, you go through all of the big names that they signed. These NBA teams are kind of fascinating how they're built. The Spurs are built through the draft mainly. And they're super young, as we know. And they hit the jackpot on the lottery, and they got Wemby. If Wembanyama's not on this team, they're nowhere near the finals, but that's how the NBA works. You get the best player. I think the way the Knicks did it is more interesting, honestly, because Jalen Brunson was Luka's backup in Dallas. And even though he signed for 100 and whatever million, and you can say it was below market, nobody he's turned out to be a better winner than Luka. He's not a better player, but if you ask me which guy I'd rather have on my team, it's Brunson. Luka doesn't play defense. His teams don't really win in the postseason outside of one run to the finals where the Celtics did handle them. So I think the Brunson thing, you got to give the Knicks a huge amount of credit for that. And then also the way the Knicks looked at their roster and said at the time, we need to compete with Boston. Boston just won a title. They've got Brown and Tatum, so they have these two great athletic wing players. How do we defend that? They go out and get Mikal Bridges, great defender, and a similar kind of player, a better scorer probably before he got to New York than he's been with New York, but still like a highly respected player. You get OG Anunoby, somebody who's won a title in Toronto, again, is somebody who can defend multiple positions, and you make the Cat trade, which I kind of thought Karl Anthony Towns, I'm like, he's a little soft. He's a big guy who shoots threes, but you look at what he has transformed himself into with this Knicks team, pushing Wemby around the first two games, really being that rugged, physical presence that I don't know we necessarily associated with his game. So I give the Knicks a ton of credit for how they have put this thing together. They didn't do it by just winning the lottery, and landing the top pick. They really targeted the right pieces, made smart deals, even the Alvarado deal. Like that's an under the radar one, but just a pest of a player, a good defender. So I really like how the Knicks put this roster together.
Yeah, it's very surprising to see the Knicks in the finals, I think, but they've definitely ground their way up there. They had to grind out. They've lost in playoff series, and kind of what you've seen growing up. Like you and I, you saw the Bulls had to get over the Pistons had to get over the Celtics, et cetera. And then you have the Spurs, who have a culture and franchise that's ingrained in them, from Greg Popovich, who's no longer the coach, down to even Tim Duncan coming and helping players, down there in San Antonio. I think another big thing with Jalen Brunson, I watched an interview with him, and he was speaking on how they were negotiating in Dallas, right? So they were negotiating. It was about to be the trade deadline. Luka got hurt, or Luka didn't get hurt, but he told them right before that he didn't want to negotiate during the season. So like right then, somewhere in the season, they came to him with like a $44 million offer. No, he said he would take the $44 million offer, which would have been like the max for him at that point. But they said, we won't wait. The Mavericks have quite the history. Let's talk about that in a second. But right, so he said, okay, we're not going to negotiate during the season. They get into the season. He starts playing well. Luka gets hurt. As you said, I don't know if you recall, they have that playoff run. And he's like, yeah, I think my market value has changed.
Yep.
Then after that, Mark Cuban's he did an interview. We can pay him the most money. Jalen Brunson says he didn't hear anything from them. It was crickets. So what's going on with Dallas? Like how bad Luka, AD?
Yeah, so I mean they canned Nico Harrison, so that's part of trying to fix that. They got lucky with the ping pong balls and landed Cooper Flagg, so they go right from Luka to Cooper, who had an amazing rookie season. He's from my neck of the woods in Maine, so we've been hearing about him for a while, and all I knew about him was that, he's going to be one of these guys who gets to the NBA, and he's going to be pretty good at everything. He's a good defender. He's a good passer. He's an okay shooter. He's an okay scorer. And he gets into the NBA, and he's got like a grown man's game. I mean, you see him dunking on guys all year. So they've changed their leadership. They brought in, I'm blanking on his name, from Toronto, the guy who built the Raptors into a champion. I'm sorry. It'll come to me in a second. Anyway,
His name's like Uzo. I know you're talking about.
Usai, I'm going to say his name wrong, so I don't want to say his name wrong. But somebody who is highly respected in the NBA, built a winner, made a gutsy trade to get Kawhi Leonard in Toronto. He's now in charge of Dallas, so I think they're probably on the upswing. They have a real basketball boss there now. And it'll be interesting to see because, they're still going to have high draft picks. And at some point, people are probably going to want to play with Cooper Flag. So I think before too long, I think the Mavs will be back. And they just got rid of Jason Kidd as well. So they can sort of start fresh from the coaching perspective as well.
Yeah, it's interesting to fire your coach after you just had the Rookie of the Year and the #1 draft pick, and your coach is a point guard, one of the all-time great point guards.
I know, exactly. It is amazing. And somebody who should really understand better than anyone exactly what Flag is going through.
Yeah, I'm sure he helped Flag exceed at point guard much more than he would have. But, some people play, some people coach. But Jason Kidd was a good coach before this. He's been a good coach.
Yeah, no, I totally agree. But it's also the kind of thing, he's here at a bad time. They're rebuilding. So you bring in a new guy in charge of the whole basketball operation, the first thing he's going to do is find his own coach.
Got you. And I heard, moving from Dallas, but staying on the West Coast in the Western Conference, I heard maybe Kawhi Leonard and Golden State. Have you heard that? Like rumors of that?
Yeah, so it seems like every year there's either a LeBron in Golden State or a Kawhi in Golden State, or somebody who's going to go to Golden State to have a last hurrah. It's almost like, what's the movie, The Expendables, with all of the old-time action stars, It's kind of like Golden State is reaching that point, Draymond's old. Steph is still amazing, but, he's, what is he, like 38 right now? So he's kind of near in the end. Do they try to put together, like, the super old-timer team and see if they can do something? That would be fun. And Kawhi's got that whole mess in LA as it is right now with the league investigation and Pablo Torre and all of that, with how he was maybe paid under the table to circumvent the cap. So maybe a fresh start for him wouldn't be the worst thing either.
Yeah, but that was with the Clippers.
That's what I mean. That's what I mean. Yeah.
Yeah, just madness there. And then we would be remiss if we didn't really speak about the Spurs. I feel like we kind of talked about the Knicks a lot. What are your thoughts on the Spurs and their future? Right now?
So I mean, they have some just incredible young talent. You look at Castle, you look at Ron Harper's kid, who 20 years old, and he's really, to me, he's already their second best player. They made a trade to get, I don't even know if you can call him a veteran, but the trade they made with the Kings to get the lefty point guard. Why am I blanking on his name? De'Aaron Fox, who actually hasn't played as well in the play. I always really liked his game in Sacramento, but he hasn't played as well. He had a big shot last night, but he hasn't played as well in the playoffs as I would have hoped. But they're doing it the right way for a team with Wembanyama. They are going with that young core, and they are building a team that can compete already. The fact that they can already physically handle what OKC threw at them, I think is really impressive. And that wasn't just about Wembanyama being dominant, even though he was. It took Vassell, it took Steph Castle, it took a bunch of those guys, those younger guys, who have really just stepped up. Champagny, has made a bunch of big shots. Has turned out to be a pretty good three-point shooter for them. So I like where they're at, but you watch the first 3 games of the finals, and maybe they're about to turn it around because they had the big win in New York last night. They played better in the second half of game 2. But for a lot of the finals, they have looked really shaky, passing the ball to nobody and that kind of stuff. And you wonder if maybe they're just not ready. I mean, you remember Shaq's first finals in 95, he got swept. LeBron's first finals in 07, he got swept. So it's kind of a rite of passage a lot of times for these younger players. You make your first finals and it doesn't go well. And then you are rededicated and you have that drive and you come back and you win one.
Yeah, well, I don't know. OKC definitely just won it last year without that blueprint, and that's what the Spurs are trying to do as well. It's very interesting. Let's go to the NHL. Let's talk about the NHL finals for a second. Now I'm down here in Wall Street South, Charlotte, North Carolina. So go Hurricanes! Hurricanes in 6 or 7 games for those who don't know. What are you seeing and hearing with the NHL right now?
Yeah, so one thing that's fascinating to me before we get to the finals, which have been tremendous, the TV numbers have been through the roof for the NHL, and I'm not even sure why. I don't know if it's an Olympics kind of thing where that sparked a lot of interest in the sport. There have actually been stories that Heated Rivalry, the HBO show, has brought in a lot of female fans. A lot of women are watching hockey now. I don't know if that's true or not. I guess I would tell them, if you're coming from Heated Rivalry and you turn on a hockey game, be prepared to just watch hockey. That's all you're going to see. But the ratings, they're up like almost 100% over last year. And part of that is ABC versus TNT, so you have a bigger reach. But it doesn't fully explain. And even Nielsen's ratings have changed this year. They have a new formulation to how they do it. And so ratings have risen across the board for every sport. They have a better way now of accounting for like games that you watch in bars, how many people are seeing them, that kind of thing. So that has boosted ratings, but it has not boosted them to the level that hockey has seen. So there is clearly some kind of renaissance going on there. I will then say, to get to this finals, these 3 games have been amazing. And if they can somehow miraculously maintain this pace for 7 games, this would be the greatest Stanley Cup final in history. That's not even an exaggeration. I mean, you've had 2 games in overtime, 1 game in double overtime. You and I were talking before we came on, and you made the point. It's like, whoever looks like they're about to win is the team that's going to lose. I mean, the comeback that Carolina had in game 3, they're down 4-0, and they score 4 goals in what feels like about a minute. And then they lose on the craziest bounce I've ever seen in double OT. Shot that hits the boards and caroms in off the back of the goalie. So anyway, just been a ton of drama. You have Mitch Marner playing out of his mind for Vegas. You talk about how teams have been built. Vegas is an expansion team. They're only like 8 years old or whatever it is, and they're already in their 3rd finals, trying to win their 2nd. So anyway, it's just been tremendous theater. Both finals. ABC has both finals, NBA and NHL, and they are killing it right now because every other night, the sports are just alternating. Both series, super compelling, super fun to watch.
Yeah, and on the business side of that, like, it is interesting that ABC has both finals because the NBA has the NBC deal, and they also have they were showing the playoffs through Prime a lot, and then you get to the finals and it's like back on ABC where they've been for a while.
And you know what? That's an interesting point you make, because one thing that I think plays in the favor of the NHL, there's been so many stories, and rightfully so, because it is so frustrating as a fan. The NBA, first rounds of the NBA were so frustrating. The Celtics played on Prime, they played on Peacock, they played on ESPN. And it was like, what am I don't know which one of these stupid streamers I have to watch tonight. The NHL playoffs, every single game has been available on what we call linear television, whether it's ESPN or ABC. Or TNT, all of the games have been available without streaming. That doesn't mean you can't stream them. Some of you have been able to stream on the ESPN app, whatever. But you've been able to watch all of those games on regular TV, and I think there is something to be said for that.
Definitely something to be said to that. I don't understand why I do understand revenue. You want your revenue. The Knicks were one of the first one, Madison Square Garden. Their stock, I got to talk about stocks a little bit. Their stock prices shot up during this playoff run. But you look at hockey and the way these teams are constructed, their salary caps are not like the NBA and MLB. How are they building these teams?
So it's totally, so MLB has no salary cap, which we will get to, but it's maybe coming in the next CBA. But the NFL and NBA, you look at a hockey contract, like some star player will sign a deal. If he were a baseball player, it would be $250 million. If he were a basketball player, it'd be 300 and something million. He's a hockey player, so maybe it's 80 million. I mean, the numbers are just completely different. Like a $6 to $8 million AAV is really high in hockey. And $6 million in baseball is like a middle reliever, a good middle reliever, but a middle reliever. So it's just a completely different sport. And hockey really does. The NBA has all kinds of rules, with its salary cap. And especially in the new CBA, it really punishes teams like the Celtics that have 2 great players in Jaylen Brown and Jason Tatum. It's really hard to build a team around them, which is why the Celtics last year got rid of Porzingis and Drew Holiday and all these guys who would help them win a title, Al Horford. The NHL salary cap is real. And so if you have a couple of bad contracts, it's you basically, to boil it down, you have to hit on your big contracts. And you look at the finals, I don't have the numbers in front of me, but like Mitch Marner was a great player in Toronto. Toronto is kind of a cursed franchise, so they always get bounced in the first round. Their fans are kind of like what Red Sox fans were pre-2004. They just know it's going to end badly. And he comes to Vegas, and he's a killer. I mean, he's going to win the Conn Smythe for a playoff MVP, assuming even if Vegas loses, he might win it. I mean, he's been that good. So these teams have hit on the guys they need to hit on.
Very impressive. Yeah. And you have like the Charlotte Hornets down here in the small market team. And there was a while, even when they were the Bobcats, where they were getting draft pick after draft pick after draft pick, but they just were not hitting with them. I remember like Rudy Gay just won the NCAA championship at UConn, and we drafted Adam Morrison, who was great in college, but you got to realize college doesn't translate into pros. Jimmer, you remember Jimmer? He was great in college.
BYU.
But he wasn't great in the NBA. But and to say, when we say people aren't great in the NBA, if they came out and played basketball with any person in the world, they would destroy us. But NBA great's a different kind of great. Let's shift over to another thing that's happening in America right now, because there's a lot happening right now. The World Cup. I'm hearing a lot about the World Cup, from, ticket prices, how much it costs to get there, to even there's still seats available. What's going on with LinkedIn or your hand over there in the World Cup?
Yeah. So, I mean, this World Cup, so I will just say very quickly, if you go back, the Russian World Cup, there was a lot of negative press before that started because of Russia. Qatar, same thing. There were talks about forced labor and negative headlines. And then the tournament starts and the play starts. And what happens on the field is so captivating that we kind of forget. Because this one is in our backyard, the sheer volume of negative headlines that have come out of this tournament based around things that really are totally within FIFA's control. Dynamic pricing is the first one. For the first time, they have decided to base ticket prices on demand. And how they determine demand and supply is shady, to be frank. What they do is they don't release all their tickets at once. They release the tickets in little dribs and drabs. They create artificial scarcity, and they drive the prices way up. And what we're seeing, we just saw it in Game 3 last night for the Knicks. The get-in prices for that game, $7,000, $8,000, the cheapest tickets you could get. What's happening is normal fans are being priced out of these games. And it's kind of like, I've seen it, or this would be more your domain, but the whole K-shaped economy, it really is kind of reflected in how these soccer game, it's like the ultimate haves can attend these games and everybody else is on the outside looking in. So I think that beyond anything else, beyond some of the, whatever FIFA sort of shenanigans accompany every major tournament, the ticketing is really the thing that is upsetting people. And you mentioned tickets available. So the Financial Times had a story today. On the resale market, there are about 180,000 tickets currently available, and they estimate that virtually all of them are going to be sold for a loss once you subtract FIFA's fees, because it's their resale market. These tickets are going to be sold for below market prices because Canada, for instance, has two venues, Toronto and Vancouver. They haven't sold out. As of yesterday, they had not sold out a single game. USA Paraguay, the opener for Team USA, you would think one of the hottest tickets in the tournament. As of the last I looked, there were still about 4,500 seats left for that game. And so what you're having is you just have a lot of people who say, I'm not paying for this. I'll watch it on TV.
Yeah. And it's very it's sad that people can't go watch live sports anymore. Live sports is the one thing that one of the few things AI can't seem to come take over are live sporting events. I remember when you could go to an NBA game or an NFL game, because we have the Hornets, we have the Panthers here, a family, like $100, you and a couple kids. Definitely to the NBA back in the 80s, $100 was, you were living good, eating big hot dogs and everything, $100 won't get you in there by yourself now, really, to an NBA game or NFL game. So it's just a very interesting paradox. Do you want to say anything else on the World Cup and just the impact that you're seeing?
Yeah, I mean, I guess the other thing is, we have to be honest about America's place in the world at the moment, and then if there are trade wars with multiple countries and, our immigration policies aren't as friendly as they were, say, 3 3 years ago. So you have a lot of people who, even if they want to come here, it's difficult. It's hard to get over here. So I think it's also a tournament right now that kind of reflects America writ large, where a divided country, sadly. And this is supposed to be a uniting tournament. This was supposed to be a uniting bid. I mean, it was North America for a reason. It was how Canada, Mexico, and the U.S. could work together. And now, because of tariffs, there's no secret there, we have Canada and Mexico at odds with the U.S., or the U.S. at odds with them. And so I think you can never, the World Cup is it's always a political event in some way. And unfortunately, I don't think you can really extricate the politics from it right now.
Yeah, there's so much geopolitical tensions going on right now. And yeah, you mentioned that it's across 3 countries right now. So there's so much going on. This is a unique type of World Cup environment. But there has been political tensions while World Cups were happening before. I mean, I remember the 90s, you had Serbia and all those things happening when World Cups were happening, like the literal dissolution of the Soviet Union. So, but we're definitely more polarized right now. We're going to take a second here before we jump into these labor NIL. I want to share something with everyone. So a big topic lately has been NILs, contracts with players. How do you keep players engaged? How do you keep teams competitive? I mean, I'm down here in Charlotte. Loves the meme of him getting paid into his 60s. I think we're looking at it wrong. Let's look at it from a purely business lens. That was a .com. We got here this day. The internet loves the meme of him getting paid into his 60s. I think we're looking at it wrong. Let's look at it from a purely business lens. That was a .com contract. We're in the AI era, so that contract wasn't a win. It was a .com era relic. It was a trade of massive future growth for a fixed guaranteed paid out. We moved past the .com era and into the AI infrastructure era. And in today's market, value isn't just about cash flow. It's about capital expenditures and equity. Think about it. If Bobby had taken the same $5.9 million deferred in 2000 and treated it like a venture capital play, taking a stake in the Mets franchise instead of a deferred paycheck, his payday would have been the $30 million over 25 years. When Steve Cohen bought the team for $2.4 billion, the equity stake would have been worth around $40 million in a single liquidity event. So why are we still paying our biggest stars like it's 1999? We're stuck in this cycle of supermax salaries that trap the players as an employee. We want to align the incentives of this AI-driven market. We have to move to an equity-linked model. Imagine that instead of just a massive salary, a star player's contract was structured kind of like an annuity of equity. You vest it over time. The longer you stay, the more you own. You're not just an athlete, you're a landlord of the franchise. Your off-court brand work, your NIL deals, your social media presence, all of that is now marketing for an asset you hold a piece of. If a player acts out or their brand suffers, the value of their own equity drops. It makes the athlete a self-policing partner, not just a high-paid guest. NBA, NFL, NHL, MLS is kind of doing this a little bit with Messi, but these aren't just teams. They're corporations. They have boards, they have franchises, and they have a massive corporation infrastructure. Nike, Adidas, Reeboks, they're all looking for ways to lock these players into their ecosystem. So why not create a tri-party deal? The sponsor, the player, and the franchise all sharing the growth of the team's valuation. That's something to think about. We see the business flow news every day. Leagues, there's someone from every league watching this. Are y'all ready to bring the players into the ownership tent? Or are you still comfortable with that 1999 model? What you think, John?
I love that. But I think you asked the key question at the end. Owners, are you ready to bring the players in as equity partners? And the answer to that is no. But I shouldn't say that, because certain players, you have to be a stature of a Messi. Messi can get a piece of a league if he wants to. You have to be the status of a player like LeBron. But for the rank and file, the owners don't want to give. This is why MLB is about to go to labor war. The owners don't want to give the players anything. But I love your point about the Bobby Bonilla contract. Bobby Bonilla Day rolls around every year. He gets like $2 million, or I forget the amount, but 2.2 million or something like that. And it's this deal that he signed like 30 years ago. And so it's this curiosity. He plays it up. He likes it. But you're right. It's kind of short-sighted. I even wonder with Shohei Ohtani's humongous $700 million contract with the Dodgers, where he basically deferred like $600 million of it. And it's like, you're just giving the team an interest-free loan, But this is how, I mean, it's still $600 million at the end, or $700 million at the end of the day. So I don't want to cry poor on behalf of Shohei Ohtani. But I think you're right. And you are definitely seeing athletes, if not being able to take a piece of a team, they are much more in charge of their own brands now than they have ever been. And I think it's really a step towards what you're talking about.
Yeah. And with the Bobby Bonilla deal, he wasn't the first player to take deferred salary. So that goes all the way back to like Catfish Hunter. Shout out to North Carolina. He's from down here in North Carolina. But players were taking, they were taking deferred salaries. Other players are taking deferred salaries. Even who I think Manny Ramirez took a deferred salary. So these deferred salaries work out. People ask like, why would the Mets defer his salary and pay him? So not to sit in too long, but the Mets at the time took this. They agreed on the rate. I think it was 8% interest that they were going to pay Bobby Bonilla, but they were getting 10 to 12%, but they were invested in a Madoff scheme. So they didn't even get that money back. Think about it, all that time, they've gotten that money back. They've recouped that money. I think of small market teams, and like I said, I'm down here in Charlotte, so listen to me, Hornets. If you want to keep LaMelo Ball, give that young man like 0.01% of the team that he can grow into up like 1% of the team, but still pay him a salary, defer it, and you'll get more commitment from players. That's my opinion.
I like that. And I'll say, by the way, I like your Hornets a lot. I love LaMelo. Obviously, you did great with Concanipple in the draft, and that's a fun team to watch. So, and they were a tough out this year. So I'm curious to see how good. I just hope LaMelo stays healthy.
Yeah, well, he doesn't wear his dad's shoes, so that helps him out. That definitely helps him out.
Yeah.
And even with the Hornets, speaking of the equity part, and I said if a player does something bad, that they may lose part of it. Miles Bridges, you got to think back a few years with Miles Bridges. If Miles Bridges didn't have that incident, this Hornets team's not constructed the way it is. The Hornets got a huge discount for Miles Bridges by acts of his own being, but they got a huge discount for Miles Bridges, and that helped create the court they have. And they actually drafted once Michael Jordan decided to go to NASCAR, which is very interesting.
Can't argue with any of that.
We kind of gleamed over labor, NILs, and Major League Baseball. So let me ask you a question. First of all, you heard about the player. This is like breaking news before we even got the topics out. The player who is now going to be able to play college football this year out at Texas Tech. I think he's going to trial in like 27. But it's the same day they announced that Terry Rozier has to forfeit his entire contract. Both for gambling, both for playing sports. What's your take? What are you hearing?
Yeah, so it's Brendan Sorsby is the quarterback at Texas Tech. When he was at Indiana, he admitted he wasn't really playing at that point, but he admitted to betting on games and betting on his own team. So that is a no-no. And Terry Rozier, I mean, his scandal is pretty well known now in the NBA. He was seemingly throwing games, certainly throwing his own performance in games, to help bettors hit the unders on his various points, rebounds, assists. The videos are wild if you've watched some of the games, where he's just throwing. I covered Terry Rozier. I saw, and some of the shots he was missing seemingly intentionally. An NBA player couldn't miss that badly unless they were trying. So anyway, we have two big gambling scandals. What's fascinating to me, and this is not an original thought, but just the way the leagues are everything is sponsored by FanDuel and DraftKings and BetMGM, and it's gambling ads everywhere. And, you look at the regional sports networks, they build in, or not even that. You look at TNT and then ESPN with the Inside the NBA guys. Chuck, what's your pick at halftime? Oh, I think Jason Tatum's going to go over. So gambling is so intertwined with these sports, and I'm a little uncomfortable with the players having to face these career-ending consequences. And don't get me wrong, what Rozier did is beyond the pale, so that's fine. But for instance, a college kid who bet on a game when they are bombarded with advertisements about gambling, I'm hesitant to end his career. And he was supposed to be permanently banned by the NCAA. He won his appeal, so he's instead, as of now, going to sit out 2 games to start the year. Then he's going to be able to transfer to Texas Tech and play. You already have Big Ten teams saying, we will ban Texas Tech from our schedule. I just think this holier than thou attitude from these leagues and these institutions when they are so in bed with gambling companies is really problematic to me. And yes, we don't want gambling in sports, but we have gambling in sports. So I just think it's a really tough one to break down right now.
Yeah, there's definitely plenty of gambling in sports and plenty of gambling. People gamble on everything now. You have Kalshi, you have poly markets, they gamble on everything. Like, it was interesting with the Knicks, that the money, they have more money on the Knicks.
That's not gambling, though. Poly market and Kalshi and those things, those are prediction markets. That's different. You're trading. So, I mean, that's the kind of thing where you sort of have to say, if they can all get away with that, why should a college kid be banned for life?
Right. Okay. So let's say, all right, you work at LinkedIn. So there are things that happen at LinkedIn behind the scenes that people won't know. Let's say there was some Kalshi or poly market bet about LinkedIn, some rollout or some feature in the background, and someone that worked there could bet on it. What do you think about that? Like, where do you see the line? Because you're blurred, right? We're blurred
to me,
here.
that's a complete no-no. And that's, you know, it's no secret that one of the big criticisms of the prediction markets is that they're just insider trading farms. I know people who are gamblers and are pretty good at it and even almost make the living at it, believe it or not, and they won't touch the prediction markets for that reason. They say it's insider trading, and now this is a separate thing, but the banks and some of the bigger places that are involved in this stuff now, they have so much data at their hands. They're not doing anything illegal. I'm not saying that, but they have such a leg up on the common, somebody who goes on to just make a bet. You're going up against these financial behemoths that just have so much more information and so much more data and so much more analytical power that it's not a level playing field.
Yeah, and that's always kind of been the case with people when you try to invest or bank or do any type of move against large institutions like that. They use their money and their power for reasons. Like, they use them to gain and continue control. When did you first hear about NILs?
Probably when it happened. I'm not like the biggest. So, I mean, first of all, being in sports for years, I remember Marcus Camby, at UMass, going back from my neck of the woods 30 years ago now, 96 Final Four team. They had to vacate all of their wins because Camby took money, and it was really kind of quaint by today's standards. And so we've had that discussion, that debate for so long. Should college athletes be paid? And my contention has always been yes. The NCAA, to me, exploited their labor, and the argument that, well, you get a college scholarship, you say, well, okay, a college scholarship in today's money might be worth $400,000 at one of the priciest schools in America. These kids are generating a lot more revenue than $400,000. So I'm glad that they get paid. But the system right now just is broken. It does not work. And I don't know if you have thoughts on how to fix it. My thing would be, can you give these kids contracts? Can they sign multi-year deals? So you can at least, I'm going to sign a 3-year deal to play at USC. And the transfer portal is not going to just churn. It feels like no two players spend 2 years in a row at the same school, and that makes it hard to watch. It makes it hard to invest in as a fan, emotionally. And so I think that's something the NCAA needs to fix. But as far as NIL existing, I think it's the right thing. I think the model needs tweaking, but the idea is fair. These players deserve to get paid.
Very good, very good. Yeah, and I don't know how you keep players there anymore. I think they're referring to giving them another gap year if you do transfer, so you can't just transfer and play immediately. That'll be played out. We'll see how it works out with the NCAA. I know the NCAA, some conferences are talking about splitting off and starting their own thing. Maybe the SEC said they wanted to do that with football. SEC may be overrating football, just for the record, but there's a lot of good football across this entire country. That's all I'm saying. And then Major League Baseball's in a situation, you mentioned earlier, they don't have a salary cap. Do you think a salary cap's coming to baseball? Or are we about to see, I'm old enough to remember a lockout baseball season. Are we headed to that?
Yeah, I think all signs are definitely pointing to a lockout. Maybe I'll be pleasantly surprised. This is the sport I covered the most. I covered baseball for 25 years. I've been through a lot of labor negotiations. I wasn't there in 94. That predates me. But certainly in the early 2000s, I think it was 2000, they nearly had a strike/lockout that they avoided at the last minute. Just a couple of years ago, coming out of the pandemic, it looked like the season wasn't going to start. And they again had a last minute CBA agreement. Right now, though, you are talking the cliche about the irresistible force and the immovable object. That's what you've got right now, because you have owners saying, this is the CBA where we institute a salary cap and you can't stop us. And the players say, over our dead bodies, we have fought a salary cap successfully for 40 plus years. We are the most united union in sports. And if we're saving our money, the union has a big fund to help players who are going to lose paychecks. And if you want to lock us out, be prepared to go to the mattresses, because we are. And I wish I had an answer to this question. Is there going to be a salary cap or no? A lot of people who are around the game right now think that this is coming out hell or high water. There's going to be some kind of cap. I'm not so sure, because the union, that is the one issue they have never given in on. And Bruce Meyer is the leader of the union right now. I don't know that I want to be the MLBPA head, who replaced Tony Clark, by the way, because of a scandal. I don't know if I want to be the guy who gave in on a salary cap.
Yeah, I mean, baseball definitely has crazy salaries. And it's interesting how you were mentioned earlier, so baseball, basketball, the sports, soccer, the sports where you get injured the least per se, pay the most amount of money. But then as you go into hockey and football, those players tend to make less money. What else are some points of consternation with the MLB labor agreements?
Yeah, I mean, there's also the issue of the salary floor. If you're going to have a cap, so what a lot of the players are upset about is, we want to make teams spend. You have teams like the Oakland A's before they became the Sacramento A's, on their way to being the Vegas A's, who just had pathetic salary structures, so they want a floor. They want the low spending teams like the Pirates. The Pittsburgh Pirates are one of the lowest spending teams in MLB. They have been for a long time under their owner, Bob Nutting, I want to say. And so the players want the lower spending teams to be forced to invest in their rosters. But really, you can strip away anything. For instance, one criticism that the players got was the last CBA. They were more concerned with getting things like suites on the road and just these kind of minor perks that should not have been front and center in a labor negotiation. All of that, I can guarantee you, is out the window this time. This time is going to be about no cap versus cap.
So that's the big point right now.
Yeah, I mean, that's really it. I don't even know the cap and the floor. After that, I honestly don't know what the third issue is, because I don't think they're going to get that far.
Gotcha. Do you know the date, off the top of your head, when they will have to reach some type of before this
December 1st. So December 1st, the current CBA expires. So they're going to get through the playoffs and all of that. This season will go as planned. Then the next date would be, February 9th, 10th, whenever spring training is supposed to start. That will sort of be the next deadline. And then you look, basically opening day is usually right around April 1st. So we'll have a good idea, I think, by February, when spring training is supposed to start. If there's no agreement there, then we're really looking potentially at a lockout. And I think the owners are sort of girding up for a lockout. I think that's what they want, because that's really the only way they can impose their will on the players, unless the players just fold. But the MLBPA's history is not to fold.
Gotcha. And we mentioned earlier that the players and the revenues, there's definitely record revenues coming through in certain sports, like with hockey and how many people are watching. Where are you seeing with advertising dollars? Because that's what these contracts are based on. That amount of advertising dollars that these companies can get, these corporations.
Yeah. So in the case of MLB's having a renaissance. I don't know if you've seen the tarps off phenomenon, where young male fans are stripping off their shirts and waving them over their heads. It started at a Cardinals game 6 weeks ago with a college baseball team, and it's all young fans, and they're all engaged with baseball. You look at baseball's numbers with Gen Z, they're on the upswing. You look at their TV ratings, they're on the upswing. Therefore, their advertising rates are higher. The time of game has dropped because they instituted a pitch clock. So baseball is really at a moment where it's finally reclaiming some of its place. For the longest time, baseball was the number one sport in America. Then the NFL displaced it probably 40 years ago and has held that spot ever since. But there was a time where baseball versus basketball was getting really tenuous, which was the number two sport in America. And right now, if you look at the numbers, even though basketball probably has more of the sort of cool factor, baseball is still, revenue-wise and all of that, the number two sport in America. And so this labor deal really risks messing that up. To answer your question more broadly, advertising dollars in pro sports, I mean, we've been talking about it now, how ABC has been dominating this recent TV stretch because they have the finals in both sports. We were talking about streamers, how they are willing to spend any amount of money to get live sports. We're talking about World Cup tickets and World Cup rights. You know, World Cup broadcast rights have been an issue, not just in America, but India and China for a while. The two most populous countries on earth didn't have World Cup TV agreements because FIFA was holding out for more money. Live sports are the most valuable entertainment product in the world right now. That might actually not even be an overstatement. So you're looking at just in this fractured media age where people watch clips on their phones and don't watch TV shows anymore like they used to, and there's a million channels for everybody. Live sports are the one thing that people will tune in at this time for this duration. They'll sit through the commercials, the whole thing. That makes it hugely valuable.
Yeah, live sports are definitely a game changer. And yeah, so the revenue, so it's just going to come down to where they're being paid inside of that. You mentioned how you mentioned that you've been in a reporter, a journalist for decades now. I don't know if you saw the post I made, newsletter actually published about the broke athlete, the broke mindset. Do you remember that ESPN 30 for 30, where they were talking about broke and how people were going broke from it was 2008, I think, is when it came out. And Bart Scott said you can live like a prince for a year or a king, or prince forever or king for a year. What were you seeing with athletes back then?
Yeah, so I mean, this has certainly been an ongoing concern. I've covered plenty of guys who went from, I mean, it was always kind of sad to me. I covered, for instance, Scott Williamson, pitched for the Red Sox. He was a good closer for the Reds. He was an all-star. The Red Sox acquired him. He got hurt, but he was still on the team that won the World Series in 2004. And I remember his wife actually calling me when I was at the Boston Herald. He was selling his World Series rings. And, you know, whether it was for investment and whatever, it's still just kind of sad when you see athletes get to that point where something precious and priceless, they have to part with it, you know. And I've seen guys spend all their money. I've seen guys, the one thing that always jumped out at me, and this was across sports, I saw it a lot in baseball because that was the sport I covered the most, but you see the entourage that players have, and not in the sense of the show, like the TV show, but just like all the people around them. A lot of times it's family. They're with them on road trips. There's a dozen of them after every game, and they all have this job or that job. So maybe it is kind of like the TV show. And you just say to yourself, there's no way you can support these people while you're making your millions. But the second that faucet turns off, what are you going to do? And I think players are much smarter about that now. But certainly 15, 20 years ago, there was very much a live in the moment sort of approach to that, to wealth. And a lot of these guys came from nothing, you know, whether you were a basketball player from the inner city or a football player from the cornfields, suddenly you are rich. And not everybody knows how to handle that. I don't know if I were 20 years old and somebody threw 10 million bucks at me, that I would spend it very wisely.
Oh yeah, man. I'm such an advocate of financial literacy and just the interesting things that the lack thereof, it doesn't matter whether you have money or whether you don't have money, it's how much you spend versus how much you save. At the end of the day, this portfolio here is what they suggested. And this was several financial advisors who were on here at the time for a model portfolio. This is what they were suggesting. This is what, so you see that 50 to 65% equities, 15, 20% alternatives. That's a big thing now. private equity. So that could be, that could be your ownership in that company we were talking about, in your business, and then real estate. This is how they were actually allocated. So, yeah, a bunch of private equity, like you said, people are coming up to the athletes and saying, I got this idea, I got this thing. I think they pointed out car washes is one of the big things. Although car washes are making a comeback now. Like car washes are actually somehow making money again. What did you see any athletes trying to help athletes understand that this is the money they're going to live with for the rest of their lives? I heard a story where Charles Barkley said, I think it was Julius Erving told him, hey man, this money has to last you the rest of your life.
Yeah, so that's an interesting question. I mean, the one guy that comes to mind, and unfortunately this is on the flip side of what you said, but I distinctly remember during that 2000-ish labor negotiation where it looked like there was going to be a strike/lockout. I remember talking to Ricky Henderson, one of the all-time greats, rest in peace, just passed away in the last year or so. But Ricky at that point was maybe, 43, 44 years old. So he had a better handle on finances than everyone else. But I remember him, and this is not answering your exact question, but I remember him holding forth where I asked him about, what the players wanted in the deal and, what the owners were offering or whatever. And he said that there's really no difference between me, Ricky Henderson, and a truck driver. He said, if I make $100,000 a week and I spend it all, and he makes $1,500 a week and he spends it all, we are the same. And there is a point to that. That is true. But it also made me think, and he was famously cheap actually, so he did save a lot of money. But it did make me think like that might not be the best message for a young player. I'm not sure.
Yeah, you're going to spend it. Spend kind of what he said. Like you said, he was frugal. Who else was frugal with their earnings?
So famously, Manny Ramirez. Manny Ramirez was somebody who he kept money in shoeboxes and he made million. I mean, he had a $200 million contract with the Red Sox, or $160 million contract with the Red Sox when there weren't too many of those in baseball. And he was someone who, I don't know that he invested well, but I know that he was someone who was notoriously cheap. I heard stories about how, another guy was J.D. Drew. So J.D. Drew, former Atlanta Brave, when he played for the Red Sox, he was someone who did invest money, and he would encourage players to be smart with their money. But his cheapness was more like he would, I'm trying to think, like, he would ask for somebody's Wi-Fi code, in a hotel so he could send like the $5 kind of thing. And this is someone who had signed a $75 million contract. He's one of my all-time favorite players to cover. He was a smart guy, and he definitely was of the mind that you have to be smart with your money at a time when not everybody felt that way.
Nice. No, that's very cool. Another one, did you hear stories about Rob Gronkowski while he was up there?
Gronk. So I'm not as familiar with Gronk, the businessman, but fill me in.
So I heard Gronk, I actually heard him saying it. So it's not like I heard it secondhand. I love firsthand source, primary information. He was speaking when he moved up there. He said, okay, so I'm up here. I got 4 years, $4 million. I can live off $4 million for the rest of my life, because it'll be like, he did the math. I think he said he could live off $50,000 a year from the interest payments. So I'm guessing he's just putting it in cash. He's not even investing at this point.
Yep.
Just putting it in cash. But he was talking about how he lived with his expenses. He said him and his roommate had a $1,500 a month townhouse that they were renting. Right. Think about that. They're playing in the NFL. They're renting a $1,500 townhouse in Boston. He said they pretty much stayed at the stadium or at the practice facility, so they fed him 3 meals a day. It's just, who else was I think it was, there was another athlete who said they would sleep there when they first started in the NFL. Maybe it was Chad Ochocinco. He's extremely frugal as well. I digress on that, but are there any athletes who are infamous that you know for spending too much? Maybe not say their names, but maybe some stories.
Yeah, I'm trying to think. Okay, so I won't say the name, but there was a Red Sox player that I covered when he signed a big contract and he was young. The first thing he did was he showed up pretty much the next day in, I'm not a car person, so I couldn't tell if it was a Maserati or a Ferrari or whatever, but it was some, $500,000 car But what I remember was it was tricked out so that it had lights along sort of like the runners or whatever on the side of the car, that he had a special logo made of himself and he had his number, and these lights like shined it down onto the road. So wherever he went, you would see his logo and his number. And I just remember being like, that was not a good use of your money. And that was somebody who flamed out fast. And I would not be surprised if he is broke right now, unfortunately.
That's personal branding. That's his personal branding just out there. But I guess he was ahead of his time. Are you seeing any initiatives from franchises and teams to help their players move forward with this?
Yeah, that's a good question. So I can't say off the top of my head. I'm trying to think of like a financial literacy something. I think the union has probably been, and at least in baseball, has been more proactive about that. But you certainly look at a guy like Steph Curry, who just signed his huge, sneaker deal, and really more than that, he took the whole Curry brand over to a Chinese company, and that's
million.
somebody who is saying, I am looking well beyond my playing career. And Steph Curry, by the way, is active on LinkedIn. There's a few players there, Jalen Brunson. So there are a number of players now who are really taking that sort of literacy thing to their personal brands. And I think Curry's probably the best example. LeBron's another one, obviously. LeBron owns a piece of the Red Sox. LeBron is somebody to go back to, the graphic and presentation that you had made earlier about giving players equity. LeBron is somebody who is big on equity. He wants to see former players in ownership roles. He wants to see, people, players come out of their careers with a vision of how they can take a piece of these teams, take ownership of these teams, and then build something lasting. And I'll give you one other player. I'll give you a good one. Jaylen Brown in Boston. Jaylen Brown in Boston started basically like a wealth fund where he wants to ensure that, as he said, black and brown children in Boston can learn how to build generational wealth. And that's something and he's put, a ton of money into this. Like, I don't want to say a number because I can't remember it exactly, but I think it's in like this 7 and 8 figures. Like, he's really putting his money where his mouth is on that. He wants to build generational wealth.
That's very cool, actually, Jaylen Brown. He might be one of the highest paid players in the NBA with that deal. He just got that max contract extension. Jaylen Brown will be one.
Yeah, he was briefly the highest paid player in the NBA.
And he's giving it back. Before we go to the LinkedIn area part, I want the questions, because I have questions. With Jaylen Brown, with these NBA players, with these portfolios, how can the NBA, NHL, MLB, anyone who may watch this, NASCAR, PGA, there's a lot of people who signed up. How can they help even more with these athletes? You think maybe mentoring them or partnering them with a former athlete? How can they help?
Yeah, I think they should be, when you think about how the owners made their money, and when you think about how the owners have been successful in business, I think that they should give that back in some way to their players. And they should be, if not literal partners, where they're not going to give up a piece of their franchise willingly, because we've talked about that. If they can at least be partners in the literacy part of this and explaining how to build wealth. I think what we're seeing now is there are a generation of players. Curry and LeBron are the two immediate examples and even, if you go to the NFL, Tom Brady, he's become a part of the ownership group with the Raiders. He's got his business empire, between health stuff and all of the various brands that he has. I think you need a generation of star players to really impress upon the next guys that this is how you do it. And I think there has been a movement towards that. I think you've seen it with some of the most high profile players in these sports.
Yeah, it's definitely not where it was before, like the awareness that we have with concussions and head injuries. One interesting player last year was, or maybe that was 2 years ago, when Caleb Williams signed his contract and he wanted to get it all into a nonprofit. Do you remember that? So he wouldn't have to pay taxes.
Yep. Yeah. Caleb Williams is an interesting dude for sure. And I also think you look at where all these athletes are right now, and they're just, the older generation was every man for himself. And I think these guys have a much more sort of like holistic view, if that's the right word, or overarching view of their place and their fellow players' place and how they build real lasting wealth as opposed to whatever they can grab as a player.
Gotcha. Yeah, just you have to establish it, understand it, and make moves with it. I mean, people just waste money like it's going to be there forever. It's a sad thing to see. Um, so we're going to go into some of the questions that people ask you, John. We're going to go into the role as a LinkedIn editor. Before we get into that, let's just tell me a little bit more about how you became the sports editor over there at LinkedIn. I've given you that name. Other people have given you that name. Whether you want to claim it or not, you can't claim the title. But yeah, how did that come about? What made LinkedIn decide that it was time to go into sports?
Yeah, I think, like I was saying earlier, I think it's there's been this recognition. Yahoo's doing it. They've expanded their business coverage. You look at the sites that have popped up. Front Office Sports is tremendous. Sports Business Journal has been around. They're good. Sportico is good. Sports business is just hot right now because I think, A, people are into business stories to begin with, but B, we know how valuable the rights deals are, the franchise valuations are. Sports are huge business, and it's a way, I think, to draw in fans to business coverage a little bit. And so I think, we've recognized that like anybody else. And, we want to give people a reason to be on our platform. And if you can expand that reach a little bit by bringing in some sports fans who also have expertise in business, then what is there? There's no harm in trying. So that's where we're at right now.
Yeah, you were mentioning LeBron James and Steph Curry. How are they using LinkedIn? I imagine
I don't know if
Fitzgerald.
LeBron uses it as much, but Steph is on there, to announce his deals. Jalen Brunson is on there. AJ DeBonsa has been posting quite a bit. He's probably going to be the number one pick in the draft coming up. He's at BYU. He's been on there a lot. Fernando Mendoza has been LinkedIn's MVP. That's the only social platform he uses. And in fact, when he won the national title, the first thing he did was go in and post on LinkedIn. So I do think that it's really a Gen Z thing in a bigger sense, that there's a lot of financial literacy with that generation because they're looking at AI and disruption and wondering what jobs they're going to have. And maybe they're looking at their parents struggling to pay mortgages or keep jobs. And they're saying, you know what, we need to be on the ball with our investing from the beginning. And there's all kinds of stats about how that generation is investing younger and more smartly than their predecessors, like Gen X, like me, or millennials. And so I think you have a lot of athletes right now who recognize that value, and they see LinkedIn as a valuable platform to make some of that stuff known. And then I will say on the flip side, we just added Billie Jean King has been posting quite a bit, someone in her 80s who just graduated from college again, but is a huge name in the history of sports. So I like to think that there's a home for everybody on LinkedIn.
That's very good, John. I feel like LinkedIn should let you make a commercial where you just expand that. I want you to sit back for a second. I have one more video to show you, Steven. Let me know what a person should do with this.
LinkedIn is pretty great for discussing the latest ideas. We cannot stop your brother-in-law from discussing his ideas.
I call it the swimming desk. It's work up here, you swim down there.
We can help you explore new roles. We cannot help if the patients still don't know the row closest in the back. Thanks. And while we can't stop what's growing in the office fridge, LinkedIn can help you grow in your career. LinkedIn is the network that works for you.
I love that. I kind of like the idea of the swimming desk, honestly, but
until it falls in the water, man.
Until you get electrocuted. But it's I mean, listen, I think LinkedIn is really kind of in the zeitgeist right now. I'm not just saying that because I work here, but I think you see a lot of people who recognize that some other social media sites feel a little bit past their prime, and it feels like LinkedIn's on the ascent. I feel comfortable saying that. even as an employee here, and they are paying me, but that's how I honestly feel.
Nice. Even though they are paying you. And
yeah,
we're going into some questions that I have. People, Jerry, want to know. People are always saying, like I said, the algorithm is a secret. So it's not, people aren't really going to get the algorithm. People are mad at the algorithm, which is amazing to me. The reason, like how mad people get at LinkedIn. Let's start with what makes a good LinkedIn post. I'm pulling up your site right now, your LinkedIn page. But what makes a good LinkedIn post?
Yeah, so I think I'm just going to give you my perspective as an editor here and someone who reads a lot of these every day. And I want to say one of the things that I think really differentiates LinkedIn news from anywhere else is, yes, we blurb the news and we're a good site to go if you want an idea of business headlines, just the kind of like overview, what's important today. You are going to find all of that, and that is great. But I think what differentiates us is the perspectives provided by people like you. So people who post about the news, who have interesting things to say about it. When I read one of our stories and then I go down to see everything that's linked underneath it, that's really, to me, the differentiator. So I guess to me, a good post kind of maybe touches on one of four areas. One is expertise. This is kind of obvious, but if you're a banker and there's some big banking news and you have firsthand experience with it and you can explain something in layman's terms, I think you do this tremendously well. I'm not just saying that because you're having me on your show right now. But one of the things I enjoy about your posts is how you can take complicated subject matters and put them into English, for people to read, because you have expertise in a lot of these financial areas. So that's one thing, expertise. The next would be insight, and that's a little different from expertise in that you don't have to be the banker, but maybe you're somebody who works in a connected industry or somebody who has dealt with a similar problem in their job or issue or whatever it is, and you can take your experience and your insight and apply that to what we're writing about. So if you're insightful, if you have expertise, those are two obvious ways to connect with a post, something that you want to maybe see featured or you hope to have featured in LinkedIn news. I think after that, if you have a personal connection to something or a passion about it, when I was a sports columnist and I wrote columns for the Boston Herald, for WEEI.com, for NBC Sports, my first question anytime I started writing something was, what's my hook? What makes this interesting? And passion certainly works. If you're passionate about a topic, even if you're not a quote unquote expert on it, that's okay. We love opinions that feel lived and personal and real. And so that's great. And along those lines, if you have a personal connection to something, we had a great post. It was a few months ago. It was a random story. It was about AOL was finally unplugging their dial-up service. Everyone for years, you dialed in, you heard the weird squawking, of the computer and everything. And a lot of us didn't even realize that business still existed. They pulled the plug on it. There are only like a few thousand people in the country who still used it. Well, a woman posted about she was from the woods of Oregon, and dial-up was the only way people in her family could connect to the internet because there was no high-speed internet there. They couldn't afford Starlink or anything like that. Or wait, Starlink, did I say that right? Elon's Starlink, right? They couldn't afford satellite internet. And so it was really important to them that AOL still existed. And that's a personal experience. And it was really well written. And it was something that it never would have occurred to me, right? And so those are the kind of things that I think resonate. Now, you can't force it. You can't if you have no experience with AOL dial-up, you can't make it up. You can't try to force it. But so this is a very long-winded answer. I apologize. But I think the last thing I would say coming out of this is pick your spots. You don't have to weigh in on everything. Pick the things that matter to you, that resonate with you, that you feel you have. Like I said in writing a column, what's my hook? If you feel like you have a good hook, weigh in.
That was a great 4 points right there as well. And I noticed what you didn't say was AI. Well, how are y'all feeling about AI over there?
Yeah, I mean, listen, I work for a tech company. We have Copilot. We have AI tools. I would never tell people don't use AI. Use AI to, organize your thoughts. Use it to write a draft if you want. What I would encourage, though, is whatever your final product is, make sure it sounds like you, because a lot of the AI tools sound the same. And you may think this reads really well from ChatGPT. Well, guess what? Everyone else who writes with ChatGPT, it's going to kind of sound the same. So I would encourage people, use the AI tools. They're valuable. If that's part of your writing process, just be comfortable with whatever you produce, whatever you finish, whatever you put your name on. Read it and make sure it sounds like you.
Okay, got you. Okay, so another shift with LinkedIn. Like I said, I'm asking questions that poor friend. Sometimes we make posts on LinkedIn. You can make the exact same post. So with a post, even in like the structure format, I went down LinkedIn rabbit hole. So you got like you said, what's the hook? What's going to get the reader to dig deeper into what you're talking about? Obviously, you have to have some expertise in what you're talking about or relate to the subject. But what I've seen lately is you can, or at some point, you can create a post. I've seen people pretty much do the same post and get totally different results in their impressions. And they're on LinkedIn complaining about it. That's the only reason I know. Like what jumps out from one post to another? How are these posts getting impressions?
Yeah, so I wish I had an answer to that. And short answer is I don't. I don't understand what hits and what doesn't as much as anyone else. You know, there are things that's just way beyond my pay grade, unfortunately. I do know that we as editors, we really do search for good posts. So if we are writing a story, you know, about Meta's latest investment in a data center or whatever, and say it's in a particular, maybe they're building something in Tulsa, like we will not just do a cursory search. We will try to find, you know, posts from Tulsa or, so this is my way of saying, if you write something good, at least from the LinkedIn news perspective, we will do our best to find it.
Nice. Yeah, and I'm sorry, I didn't want you, like we said earlier, you're not going to give away the algorithm. No, LinkedIn's not even giving away the algorithm. Microsoft's keeping that under lock.
Yeah, I
and
mean,
key.
I have your
Yeah,
guess.
I wasn't trying to just expand on that. I just was trying to figure out like maybe there was a difference between one type of post versus another type of post.
Yeah, I don't have a good handle on that, honestly. I know, I mean, I've seen the complaint. We've all seen people wondering why, why didn't this hit? Because I wrote something similar earlier and it did. And I wish I had an answer, but I don't.
Perfect. Yeah, and I personally, LinkedIn is pretty much my only social. LinkedIn, I do the YouTube channel for anyone who's listening to YouTube. We have the Main Street Meets Wall Street podcast, but I think LinkedIn is so powerful. Let me tell you some of the reasons why I think LinkedIn is so powerful. Then you can expand on why you think LinkedIn, how it helps folks. One thing is that it connects you directly with people, right? So you can connect with, you'll be surprised who you can connect with on LinkedIn. Like you said, direct message and you're having a conversation. We connected on LinkedIn. Now we're sitting there having this conversation. LinkedIn is a very powerful tool. I feel I think if you're an executive or if you own a business, you should probably be talking to the other business owner. Or as opposed you're reaching into those other levels with assistance, LinkedIn can connect you straight with that business owner. What are you seeing as some of the differences between LinkedIn and these other social media platforms right now? X was big, Meta was big. What are you seeing that's pushing LinkedIn?
Yeah, so I would say the thing that has jumped out to me, being very active on the site now, is how you don't have a bad conversation on LinkedIn. When I was on Twitter and I was a Red Sox writer, I mean, just the amount of vitriol, and people would say, how can you tolerate that? I'm like, yeah, it's just noise. I don't care. But here, the number of times I've had an interaction that was, disrespectful, it's one or two. I mean, anytime, and even people will occasionally reach out and say, hey, like I had a great interaction with a guy who was an expert in immigration law. And when a lot of the stuff was coming down at the beginning of this presidential administration, and we were trying to write about H-1B visas and all of that stuff, I got some wording that I thought was right. And an immigration expert reached out to me, a guy who kind of like does pro bono work, I want to say in Miami, in that area. And he very patiently explained, while citing, the various parts of the statute, why this one particular word I used wasn't accurate. And I mean, I'm no expert on this stuff, but I pushed back just a little because I was like, well, wait, this is how the Wall Street Journal framed it. And it feels to me like it is accurate. He said, I see why you said. Anyway, we had this long, respectful back and forth. And by the end of it, I realized I was definitely 100% wrong. And now, more to the point, I understand why I was wrong. And so I changed it and I let other editors know, if this issue comes up, and I wish I could remember the exact thing, but it was related to the visa program. And the whole point is that is not a conversation I was having on Twitter. That's not a conversation I was having on Facebook. That is a conversation that you can have on LinkedIn. And that made me a better journalist, and it gave me more insight, there's that word, via his expertise into a subject that when that day started, that was something I just didn't know.
Gotcha. Yeah, and I do agree with the level of visceral that you get on Facebook and X, just other places, Reddit, perhaps. I don't think I've ever even been on Reddit, and that's nothing against those sites. I really dig into like LinkedIn. So like you said, I can have higher level conversations. Not to say that anyone else is dragging knuckles, but these are conversations where we're not arguing, we're not using profanity at one another. We're just talking. Well, we can disagree. You can point out what my differences and your differences, and we can explain it. People, what is a day in the life of a LinkedIn editor like?
Yeah, I mean, so we are on top of the news from start to finish. We're constantly scanning Bloomberg, Wall Street Journal, CNBC, the information. I mean, you go down the list just to make sure we're always looking at it from the lens of what will resonate with our readers. We obviously it's going to be business centric stuff. At times it will be cultural stuff. And just the idea is we're always looking at it. If I were a reader, what would I want to read? And so, then from there, the mechanics of it are kind of what I was explaining earlier. We really do search. We want the good takes from people that help illuminate our stories and help, like I said before, differentiate our coverage. So that's the main thing.
Perfect. And how much in your day life, like when you're searching, how much are you using AI to scan, and how much are you like actually looking yourself?
Yeah, there's a mix. I mean, without getting too specific about behind the scenes stuff, since it's not really my place to talk about that, we use all tools at our disposal to find stuff. But, there's certainly still a place for sure for the human eye and the human sort of like, hey, I think this story would really hit.
Got you. Yeah, that's good. That's a good explanation. And you have folks, so people usually think of LinkedIn and they think, oh, that's the place where you upload resumes. What's different now? Why is that not the place you upload resumes?
Yeah, I mean, you should still upload resumes, but but it's sort of like you were saying. It's really a place to connect with people, and you'd be surprised at how many people you can, like you were saying earlier, you can message and actually engage with. I found that people have been very responsive to just random DMs or, hey, I have a question about this particular topic. People are willing to help. I think that's like, especially in an economy right now where even though the jobs numbers have been kind of surprisingly encouraging, it doesn't feel like a lot of people's lived experience at the moment. And I think LinkedIn is a valuable resource for people who are looking for new work or have just been laid off, or even just on the opposite end, want to help people who are in that situation. I think it's a really valuable resource. A friend of mine just got hired at a high level job, and the whole interaction started on LinkedIn. So I think that those stories are common.
Yeah, it's going to be hard to get a job with a resume nowadays. Like, not that you shouldn't upload resumes, but they're scanned by AI. You need the personal connection. People don't realize, like, those big executive jobs, those guys aren't filling out applications. They're meeting people, and they already know the people who are, making these things happen as far as it goes. Man, John, I've talked to you forever about just LinkedIn. I'm trying to think of another question. What are questions you get on LinkedIn? I imagine you get people who are mad at you. Like, people think that, what do people give you too much power for, like, that you can control on LinkedIn, and not enough credit for what you actually do control on LinkedIn?
Yeah, I mean, certainly people wonder why, their posts, why didn't this? And I'm like, listen, that is beyond me. I am a small, tiny, teeny tiny cog in a machine. But actually, most people have been respectful. Occasionally, I will get feedback that's almost in the sports vein, where it's like, if it's a particular company that people feel strongly about and you've written something with a sort of negative headline, you will definitely get fans of that company. I'm not going to name any names, but they might they might make their displeasure known. Who are you? How dare you? Kind of thing. But that to me, I'm like, that's sort of my I don't want to say my happy place, but that's what that's what I dealt with for so many years in sports. So I'm totally fine with that.
Yeah, you're probably like, this is nothing. What are y'all doing? Like,
Yeah,
I've been in locker rooms after teams have won championships and after teams have lost championships.
I've been screamed at by players and managers. I've yelled back at them. But trust me, there's nothing you can say that I haven't heard.
Oh, you got to give us one story, man, before we hop off give us one of those.
All right, let me think of. So, all right, so there was one. This one happened on camera, so I can say it. So I was in maybe I won't name the player, but I was in the Patriots locker room after a game, and a player who is one of my all-time favorites, like one of the best guys I have ever covered. He was mad at something I had written. And so I asked him a question after the game, but I didn't know he had even seen it, I didn't even know it was something he would be mad at. And he said, "I'm not answering any questions from Tomasi. He's a bad guy." And I was like, "Wait, what?"
A bad guy.
Said, "I am not answering questions from you. You're a bad guy." And I was like, "I don't even know what you're talking." I thought he was joking. He was not joking. So afterwards, I said, "You just got to let me know. What did I do? I honestly have no idea what he did." And he goes to his locker and he pulls out a copy of the Boston Herald, the paper I was writing for at the time. And he has a paragraph circled. And this is going to be a little bit in the weeds of journalism, but the paragraph was, it was the Patriots who were playing the Cowboys. And I have to have a story written at halftime of that game because of our deadlines. And my halftime story was about how this particular player hadn't played well. And if he didn't play better, then Dallas Clark and the Indianapolis Colts were going to eat his lunch the next week, kind of thing. The thing was, that paragraph only went out to like Western Massachusetts. How anyone got a copy of it, I have no idea. Because by the second half, this player had played so well that I ripped up that story and threw it away. This is just the hazards of writing for a newspaper with deadlines. You have to file at halftime. This is what I saw at halftime. Well, by the end of the game, the story was completely changed. So I didn't even write. So anyway, I had to tell him, that's not even what I ended up writing. That's not the story that 99% of the readers saw. I don't know how you got this story from Chicopee. That's a Western Mass town. But you somehow found it. And anyway, we hashed it out and it was fine. And I could call him today. And he's a well-known player. You would know him. And he's one of my favorite people ever. But that was the kind of thing you dealt with in a locker room.
That's very cool. That's very cool. I don't even really want you to expand on this next question too much. I think I may know the player. I don't know if I know the player. I probably don't.
You can ask me off the air.
Yeah. But so just as far as, and I'm trying to think of the best way to say this. Recently, you have the Patriots, you have reporting. We just had the trade with A.J. Brown, who went to the Patriots. That's been reported for months.
Yep.
Vrabel, Rusi, whatever. I don't really want to get into that. But how deep do reporters go for sources? Like, if it's a male, whatever. Like, how intertwined is it? You just said you could text this player if you wanted to talk to him. Like, where's the line with that?
Yeah, I mean, a source is whoever you can convince to talk to you, So, it could be an executive with the team, it could be a player, it can be an agent, it could be a family member, it could be someone who works in a lower level for the team, it could be somebody who works on the grounds crew. I mean, it can really be it's as deep as you can get, And so it's kind of like whoever trusts you. But the AJ Brown thing, that one was so obvious from the beginning because he had the history with Vrabel playing for him in Tennessee. There were no other teams linked to him at all. He wanted out of Philly. The Eagles wanted to get rid of him. They drafted his replacement. They signed his replacement. He was clearly gone, and they couldn't trade him until June 1st because of the salary cap hit that they were going to take. So everyone knew that this deal was going to happen once that deadline. I think it might have been June 3rd. I think it was June 1st. Anyway, it started June. So that deal, that wasn't a particularly tough one. That was pretty much everybody who covered both teams knew that deal was going to happen.
Gotcha. Do you think it hurts the integrity of sports reporting?
To know that deal was coming?
Just in general, just the light has been shown on where people are talking about like now as to how you get sources when people do sources. Well, I know I've heard Stephen A. Smith speak before about how he would speak with Allen Iverson. You know what I mean? I imagine that relationship is just as deep. Do you think it's tarnished the image?
No, I don't think so. I think that's the job. I mean, your job is to get to know people as long as you're not doing anything illegal or doing favors for them or anything like that. I mean, readers read you to find out information about their teams. So as long as you're doing it in a professional way, no, I don't think it's Stephen A. If you know Allen Iverson, I'm good for you. That's a huge get if you're covering the Sixers or whatever, you know? So, yeah, I don't think there's any issues with that at all. The Diana Rossini thing, unfortunately, was a little different with Mike Vrabel. But, you know, I think the consequences there have been pretty clear, at least on one side.
On one side. Yeah, you got that part right. I'm grateful for your time. We're going to wrap it up here in just a second. I want to ask you, what's the question you receive the most on LinkedIn as a LinkedIn editor?
Oh, interesting. Oh, actually, that's an easy one. Can you include this post with your story? You know, I get that question all the time. And by the way, 90% of the time my answer is yes, because it's good. It's you know, I mean, you've emailed me things that from time to time. Hey, I see you've posted this story. I wrote this, you know, like I get that message all the time, and I'm happy to, because that's how, and I end up clicking the follow button on a lot of people
Nice.
who email me. Yeah, because that's where the expertise is. And I think that's what separates us.
Yeah. Are you an anomaly when it comes to LinkedIn editors? Like, or do other editors reach out to people that way? Are y'all connected that way?
Well, I'm not reaching out. I'm saying they reach out
to you.
Yeah, they reach out to me and I will click a follow button. Yeah, I don't want to speak for anyone else because I don't know exactly, but I think every editor at LinkedIn at some point in their in mail has gotten a message from someone saying, "Hey, I saw you wrote this. Could you consider what I wrote?" You know, that's what I like when the people ask. They don't demand that I post it. Sometimes people occasionally demand, but for the most part, people are very respectful about, "Hey, I wrote this. I think it would fit your story. You know, I just want you to consider it for inclusion."
Very good. If people tell us where we're going with the LinkedIn sports editor, the new role they're going with sports, is LinkedIn going to have a live show? Why do they not have anything streaming? I know we have like this is streaming live, but are y'all coming with some live TV?
That I have no idea. That's beyond me. So I got nothing there.
What do you have with what you got with the sports part? How are
Yeah,
you
so I
doing that?
mean, we'll you know, we're gonna keep pumping out as many stories as we can. We've obviously got the World Cup coming up, and that's gonna be a huge one for us because there's so many business angles to that. So yeah, if you've got ideas for sports stories, feel free to send them my way.
Very good, very good. And I think that probably about covers it for today. I mean, it's been a great conversation, man. I've enjoyed your time. I've enjoyed you taking the time to chat with me. Before we go, don't worry, there is one more thing we can watch. One more time, please.
Back to Folk. Red Sox fans have longed to hear it. The Boston Red Sox are
direct snap to Brady. Standing in there. Goes to the left, loses the football. It's on the ground, and let's see if it's a fumble or a pass attempt. I believe it's going to be called.
It's a fumble. Where were you, John, when when Boston hit that home run to beat the Yankees that started the dynasty?
Oh, so when they came back from the 3-0 deficit, I was at all I was in Yankee Stadium. So yeah, I was right there covering the action. I had also been there a year earlier when Aaron Boone took Tim Wakefield deep. So, you know, I will say just one final thing. As a sports fan, as a sports writer, you kind of lose the fan part of it. Like, you cannot be a fan of the teams you cover. Like, I stopped being a Red Sox fan the second I started covering them. The only exception I made, and I will leave you with this, was the Red Sox won the World Series in 2004 in St. Louis. And at the end of it all, they were all celebrating on the field. It was probably 2 a.m. And I saw one of the executives of the team who I'd known for a long time. He was a New England kid like me. He was my age, went to a very similar college. And I just stuck out my hand. I said, "Congratulations." And he swatted my hand away and he said, "Bleep that. Just for 1 second, be a fan." Then I was like, "All right, it's fine. I will let down the journalistic objectivity just for 1 minute here because you did end the curse."
Nice. John, I'm going to let you have the final word before we go. I want you to answer 3 questions. You only get one word per question, okay? So first one is, well, you can have more than one word, but one team. First one is the best team in Boston.
Best team in terms of like just right now?
No,
Celtics.
best team ever. So Celtics over Bruins, over Patriots, over Red Sox.
Celtics guy for all time.
So you're counting those 13 world championships they won when there were like 4 NBA teams. All right, that's cool. Second question.
Hey, they've won 5 since. So yeah.
Yeah, I guess they have. Yeah, they won in the 80s and the 90s and like the late 70s. I'll give you that.
Yeah, and the 70s.
Yeah, the late 70s, the Dave Cowens teams. Who wins the NBA Finals and how many games?
I'm going to go Spurs in 7. I think that Wemby has come alive. He's the best player on the floor. And there was a little bit, if you remember when Giannis won, I think he lost the first 2 games of that finals, but he was the best player on either team. And eventually he kind of exerted his will. I think that's what's going to happen here.
Okay, so I'm putting a bonus question here. I'm sorry, John. Best tournament for championship in sports, like NCAA, March Madness, NFL playoffs. What's the best tournament?
It's probably either the NCAA. It's probably the NCAA tournament. I mean, from start to finish. And I'm not even a big college guy anymore, but the NCAA tournament's amazing, especially the early rounds. I mean, the early rounds. It's the one tournament where the early rounds are better than the finals typically, but you really can't beat that first weekend of March Madness.
Perfect. Yeah, the first weekend's good. And then who wins tonight? Like we said, we got to let people watch the game. Who wins tonight and who wins the series? Hurricanes or Knights? And this is important.
Yep, Carolina for both. I think Carolina wins, and I hope it goes 7. I think they were the better team during the year. They've been a little unlucky. They had 2 goals bounce off their goalie. Like, one got deflected by his own defenseman. The other weird one off the backboards. I think Carolina is the stronger team, so I'm going to go Hurricanes, and I'm not just saying that because I'm with a Hurricane fan.
And that's the final word. That works for me, man. Thank you, John, for coming down. We really appreciate your time. We'll have to do this again, man. And if there's any way I can help you with your platform, like I said, I am a huge advocate for LinkedIn. I'm a LinkedIn advisor, for those who don't know. John's LinkedIn sports editor. Thanks, LinkedIn. Thanks, YouTube. Thanks, John, for joining us.
You got it. It's fun, Marcus.
Assets are appreciating and increasing their wealth, even though they're not really doing anything other than owning those assets, right? I think that there's a very clear distinction between, do you own appreciating assets or do you own depreciating assets? Meaning the things you own, are they going up in value or are they going down in value? A car is a great example of a depreciating asset. When you buy a car, you drive it off the lot, it immediately loses value. And if you own a piece of land, if you own a home, if you own some commodities, if you own stocks, those can be appreciating assets over time.
Got you. So it sounds like what you're talking about is kind of the wealth effect.
Yeah, that's part of the wealth effect. And if 4 in 10 families don't own stocks, it doesn't matter what's happening in the stock market. They're not benefiting, like their household balance sheet. It's like what you own versus what you owe. What you own is not really going up. And in an environment where prices have increased, right? I mean, the price of cars have increased, the price of groceries have increased. Going to fill up your gas tank every week, that's gone up. So many families, you see this on a weekly basis. Your expenses are increasing and your paycheck is not keeping up with that. So you're getting squeezed. So I think on Main Street, a lot of people are feeling that taking place. And it's very different from the stock market that is celebrating new highs. Now, I will interject and say that because I spent a lot of time on LinkedIn and other social media channels, just based on comments, I think a recurring theme for many people, especially that 4 out of 10 families that don't own stocks, they're skeptical. And I think rightfully so. But I think that there's a feeling that, okay, the stock market, that's controlled by the wealthy, by corporations, by Wall Street. And it's more gambling than anything else. And there's some pushback. They don't want to participate in like this crazy game. You know, there's skepticism and a lack of belief in the stock market. It can feel like gambling. But I've been doing this for about 27 years. If we get into my background, I mean, I grew up in a family. My dad was a money manager. He was director of research at the Bank of New York. My mom was a stockbroker at Merrill Lynch when I was a kid. So I do not believe that the stock market is all about gambling. Yes, you can speculate. There are those who are speculating in the stock market. They're purposefully trying to go for long shots and, you know, make these bets that can be like gambling. But I think the flip side of that, when I talked about earnings growth driving the S&P 500 and the market going higher, I think that if you boil down investing to like the most basic thing, what matters? Earnings matter. If you look at one company that is increasing its earnings year over year, every quarter, the stock price should go up also. There should be a correlation between the stock price and that company's earnings. If they're making money, they're generating shareholder value, that stock should go up over time. If you own the S&P 500 and you own all 500 companies, similarly, if the earnings of the 500 companies are increasing, the whole index should be going up. And let me point this out, because there has been a lot of skepticism, I think, this year and last year. Corporate earnings are very strong. At the beginning of this year, the forecasted earnings growth for the S&P 500 was 15%, right? Like at the beginning of the year, compared to the year before, the companies are forecasted to earn 15% more than they did the year before. We're now more than halfway through 2026. We've had at least 2 quarters where companies have been reporting their earnings. And on a whole, those companies have been increasing their earnings guidance. So what was once 15% growth, I can't speak. What was once 15% growth is now 24% growth. Like the companies are feeling good about their ability to make money right now, to cut costs, to go into new markets, to have new products. They think that they're going to make more money by the end of this year than they did from the year before. And if earnings growth is up 24%, I think the S&P 500 should be going up. And if I can inject my opinion for a moment, if we didn't have a war going on and there were peace in the Middle East, I think the stock market would be higher than where it is today.
Yeah, for sure. And that's a great breakdown of kind of how the wealth effect impacts everyone and everyday Americans. And inside that 40% who own stocks, we mentioned yesterday, like the top 1% own a majority of those stocks, right? So we just see these different moves, and you expect with the earnings growth, you see they're being revised up. We're seeing we're 2/3 of the way through the year now. So we're seeing a lot of just movement inside of earnings, like as you mentioned, upward revisions, which is, good if you own stocks. But for the folks who don't own stocks, it can be detrimental to not own stocks. So that brings me to my next point. The K-shaped economy. Help us out with the K-shaped economy.
Yeah, the K-shaped economy. I think that we've seen that. I think the K-shape has been taking place for some time now. And the K refers to really like 2 prongs. You've got 2 very diverging things happening in the economy. You have the wealthy who are earning more, who are investing in appreciating assets, and therefore their wealth is increasing. And then the bottom part of the K, it's what we were talking about earlier. You have people who are getting squeezed by higher expenses and their pay not increasing. So therefore, they're not growing at the same amount as the top of the K. And the top of the K is still spending and driving most of the consumer spending in the United States. And our economy is a consumer-driven economy. 2/3 at least of our economy is driven by the consumer. It's consumer spending, but more than 50%, a super high percentage of consumer spending today is by like the top 10, 15%.
So how long do you think this K-shaped economy can continue? And what are some perils if it does just get over, the top part gets too heavy, I guess is the way of putting it.
Yeah, I think the answer to that question is above my pay grade. I don't know how long it's going to go. I don't know what factors are actually going to spark a change. I mean, I think that systemically, there's a big divide. There's a wealth gap in earnings. Like, the C-suite are paid more than ever relative to the rank and file employee. Some CEOs are incentivized through stocks and through their salary. They can make many, many millions of dollars, sometimes 200 million, 300 million. And their incentive is to get the stock price up. They're given a lot of stock. If they can get the stock price up, their wealth is going to go up almost exponentially. And the average person doesn't have the ability to do that. So the guys at the top are going to keep spending. The people at the bottom are spending, but they can't spend as much. And I don't know what's going to change that. I mean, historically, when you have too big an imbalance, there's a revolution. People push back. But yeah, like I said, above my pay grade.
Got you. So we're not letting them eat cake just yet.
We're not letting them eat cake just yet. Exactly right, Marcus.
Yeah, let them eat cake. Let them eat cake. And then it's just a broader impact in the long-term effect. Like you said, I have friends who say the stock market is rigged, and then they'll go play a parlay or buy a scratch off.
That's the funny thing. Yeah, I think that my dad taught me when I came into this business. He loved the fable about the tortoise and the hare. He's like, everybody wants to be the hare. They want to run fast. You want the next hottest thing, right? I mean, people go to work, they talk around the water cooler. Everybody talks about these water cooler stocks. It's like, what's the next home run going to be? I want to double my money like in the next 30 days. Fear and greed. We all have greed. That's the same thing like the, Powerball is $1 billion and everybody's trying to play for that chance to win. My dad taught me you really want to be the tortoise. When it comes to investing, that is true. If you can own companies that are growing their earnings 10 to 15% every year, if you own a portfolio of those companies, it's going to be very rewarding to shareholders. And if we simplify this as much as possible, you don't have to pick stocks. Picking stocks is very difficult. Warren Buffett he's been a great stock picker. There's only one Warren Buffett in this world. Warren's advice for most people is just to own the S&P 500. If you own the S&P 500, you're going to do well over time. The reason? Because the S&P 500 are like the 500 biggest companies in the United States. Many of them are multinationals. They're growing their earnings. The companies that don't do well, they get removed from the index. The companies that are doing well, they go into the index. So over time, those 500 companies are growing earnings. And if you just own the S&P, by definition, you're owning this earnings stream of 500 companies, super diversified, and you don't have to worry about trying to pick the next winner. I think that's the secret to growing wealth and doing it while you're sleeping. Just, one tip or tactic, it's if you can automate your investing, it goes a long way. And what do I mean by that? That means if you have a job that offers you a 401k retirement plan, participate, contribute into your retirement plan because it's automated. You don't have to think about it. Once you select what your contribution is going to be from every paycheck, that's just going to go into your plan, and then you can make a selection just to own the S&P 500. And that just happens every 2 weeks, every pay period. You don't have to think about it. There's tremendous power there. And then just ignoring the noise. It's like you're not paying attention to what's happening in Iran. Is there going to be a peace deal? Isn't there going to be a peace deal? You just put your head in the sand, knowing that you're contributing every 2 weeks, you're investing every 2 weeks, and history will tell you that over 20 years, over 30 years, over 40 years, the growth of that money that gets invested consistently is like mind-blowing. So many millionaires have been made that way. And I equate that story to being more like the tortoise. It's a boring story. You make your election, how much am I contributing into my 401k? And then it just kind of happens and you're not even paying attention to it. It's a lot less interesting than saying that, you bet on the like football game or boxing match, or now, we have Poly Market now. You can bet on anything. So people are gambling a lot. And I think that one of our core messages here is that you want to do what's boring. If you have a 401k, make sure that you're taking advantage of it, because it can make you a millionaire. It just takes time, and it takes patience and consistency.
Yeah, the millionaire next door, right? I think we spoke about this a little bit yesterday too. Like retired teachers end up being a high percentage of millionaires, whether people realize that or not. I want to set with, so you mentioned the S&P 500, and then we mentioned some macro things occurring like Iran. What is your outlook right now? So over there at your firm, do y'all have a balanced, like diversified portfolio that you put people in? So what's your thoughts on like international? Where is that playing into investments right now?
Yeah, my firm, we are a registered investment advisor. We're fee only. A lot of our client accounts, it's not just one portfolio or a cookie cutter of like, do you want portfolio A, B, or C? It's pretty customized. But I would say the majority of our client accounts are trying to invest in a diversified portfolio of companies that just have very consistent earnings growth. Because in my career, I've just witnessed how many people have built tremendous wealth just by owning great companies. My dad gave me the book, One Up on Wall Street by Peter Lynch, when I was in high school, or maybe when I graduated high school right before I went to college. Read that book. I always recommend that book. Peter Lynch, famous for managing Fidelity's Magellan Fund, and outperformed the S&P 500 consistently for many years. And his philosophy was really invest in what you know and keep your eyes and ears open to see what types of products or services are you using at home. It's like, I think back in the day, his family was shopping at the Gap a lot at the mall. So he looked at the Gap, said, oh, this is a publicly traded company, and let me take a look. Saw how many stores they had, what the growth plan was for the next 5 years, 10 years. And he said, this is a great growth story. I want to own this company. They're going to be earning more. They're going to be expanding their store base. And I think it pays to pay attention, right? If you're at home and your whole family is using Apple products, maybe you want to own some Apple. I mean, it's pretty simple. But again, I love that because you can see what types of companies like reward investors over time. So at our firm, we try to own a portfolio of those companies, different sectors, different industries, and it's just that earnings growth, that earnings stream that we're trying to identify. I mean, we look at like three things. We look at the management team, we look at the earnings stream, and we look at the balance sheet. It's like we don't want companies with a lot of debt. We want companies that have quality earnings, and we believe that the management team can grow that, over the next 3 years, 5 years, 10 years. If you own a company like Johnson & Johnson, double-digit earnings growth for 70 plus years. That's very rewarding over time. And then we also believe in diversifying into, S&P 500, different indexes, because it gives you very low cost diversification. And so for us, it's a little bit of a hybrid approach. I find that, a lot of investors are either, hey, I'm a stock picker, or I don't believe in picking stocks. I just want to own the whole market. We kind of try to have our cake and eat it too. I mean, I want to own great businesses, and I also want to just own the market too. And I think that you can have a little bit of both.
Gotcha. Yeah.
I
And
didn't answer your international question.
sorry, I think go ahead and say more.
International, it depends. I mean, I think when you own the S&P 500, it's like, I think more than half of the companies or more than half of the revenues of the companies in the S&P are derived internationally. So by nature, you have exposure to international. But yeah, there are many exchange traded funds, many different mutual funds that you can invest internationally too. I think that investing internationally is a great way to also diversify. But it's been tricky. I mean, it's been like for a couple decades now. People say, oh, Europe is undervalued. I want to own Europe. Or Asia is a big growth driver. They have population and a rising, like a rising middle class. So they want exposure to Asia. But I think in the last 10, 20 years, the US has been the place to invest, with exception to maybe the last year or two. And it really comes down to the US dollar. It's like when the US dollar went down, a lot of international markets went up. But over the long term, it's been better to own the S&P 500 for a lot of longer periods.
Yeah, the American exceptionalism trade definitely, at quote unquote, air quotes for anyone listening, definitely ran for a very long time. And now we're seeing the rotation into international, a more balanced portfolio. I don't know if 60-40 is the thing anymore, but what are your thoughts on like small caps? Small caps have led the market quietly for like the last year. People don't realize it. Like, what are your thoughts on small caps? Where are they playing into this?
Oh my gosh. I've seen so many studies showing that small caps, just because they're smaller companies and they tend to have higher growth rates just because they're smaller, that over time, the small caps outperform. In recent years, that's been really challenging because you've had a market dominated by the Magnificent Seven. Like the biggest tech companies, nothing else really mattered. Small caps underperformed significantly because everybody owned Amazon, Google, Meta, Tesla. Like 7 companies dominated. And I think the AI story is still a big one. It'll be interesting to see, because we have seen a broadening of the bull market this year. Like we've seen small caps doing better. We've seen other sectors starting to do better. Healthcare has been doing better. And we've seen a little bit of a correction in semiconductors and the AI names. I mean, maybe I shouldn't say little. I mean, we've seen like a 20% correction off the top for semiconductors, while more defensive sectors have been doing better. But again, it's like if you own the S&P 500, you don't really worry about these things because you own the index. And the rest is just noise kind of underneath.
Yeah, it's absolutely amazing. Noise versus signal. That's what people need to listen to as well. Like earnings, that's a signal, right? What we hear every day, tweets, posts, and for everyone who's watching, most people know, anyone watching knows this show, we don't get political on it. We red, blue, we're talking about green, right? So, but we see people who are hesitant to invest, hesitant to only want to invest inside those large caps. And then you saw that concentration of nearly 40% from the Mag 7. People get taken out to lunch when that reversed. So are you thinking this rotation is more secular, or do you think this is a more of a secular rotation?
I think it's anybody's guess. And I'm going to make the point that it almost doesn't matter. I mean, we can argue all day and talk until we're blue in the face. It's like, how much S&P 500 large cap do you want to own? How much small cap do you want to own? How much mid cap do you want to own? I mean, that's just size of companies, right? Large, medium, small. How much US? How much international? I think the majority of people, that's not the problem that people have. I mean, if we go back to where we started, the problem is that 40% of people just don't own stocks at all. So it doesn't matter. Do you own the S&P 500? Do you own international? It's like, do you own anything versus not owning anything? I think that's the starting point. And when we talk about financial literacy, because we don't get enough financial literacy in school, we don't get enough classes. My son is in high school. He's taking a financial literacy course. That's like a summertime self-study. I think he's getting something out of it. But it's like, it's not even, they're addressing the course at least, so I'll give them that. But they're not treating it like history or algebra or calculus. Like, he's not sitting in class with the teacher and actually going through the curriculum. So we don't get enough money lessons in school. Money's often like a taboo subject. You're not supposed to talk about money or religion at the dinner table at Thanksgiving. So,
or politics, right?
Well, now politics, that's newer. Mm-hmm. We can't touch politics. That's just
yeah.
That's a lightning rod. But I think that it's like financial literacy, there's a gap that needs to be closed, and it doesn't have to be complex. It's really simple. I mean, everybody is in a different situation, like where you were born, where you live, what your opportunities are or were. But the fact is, no matter how much money you're making, no matter what job you have, you just need to figure out a way. How do you live within your means? How are you spending less than what you make? And then there are other times where, depending on what you're earning, it's like, can you make more? I think that in the 21st century, because between having the internet, between having artificial intelligence, and even if you didn't own a computer, but you could go to the library and access the internet and AI, there are opportunities to create businesses that you could never have done before. I'm not going to sit here saying that things are equal, everybody has an equal opportunity, but there are probably more opportunities here in the US than a lot of other places in the world. And because you have internet, you could start a business tomorrow. It might not take a lot. And that's why we still have immigrants coming to this country, not to get into the politics, but people want to come to this country because there is opportunity. You can come to this country and start a landscaping business. You can start a bookkeeping business. All the kids now want to become Instagram and YouTube influencers. We laugh, but there are people making careers or leaving corporate and suddenly being able to hang a shingle and start their own business doing consulting that they would not have been able to do before. But now they have like a Google business listing and they have Facebook and they can make connections on LinkedIn. Suddenly they have a business, and either as a side hustle or they can actually leave their corporate 9 to 5. So there are opportunities out there. But the point that I was trying to make is you're just trying to live within your means. You try to figure out how do you spend less than what you make. And the tactical lesson, I think most people know how much they make in their paycheck, but too many people don't know where money is going out every month. So my advice is always just to track it for 1 month. It's not the B word, it's not budgeting, but just take a simple spreadsheet and see where your money is going out. The 4 big ones are going to be they're going to be healthcare, your transportation, your food, and your housing. So it's like either your rent or mortgage. So how much to put the roof over your head? How much are you spending on food? If you just did 2 items, they're big ones. But the majority of people's budgets are like those 4 items. So if you just monitor the 4 items, you know how much you spent most of your money on last month. And if you do it a second month, then you can identify a trend and say, oh, wow, I didn't realize how much I spent on takeout or going out to the restaurant last month. Let me try to make an adjustment this month. It's human nature. You can't help. Once you start tracking, you can't help but try to make improvements. Or out of curiosity, you're like, let me see how much better I can do if I, go out to McDonald's one less time.
Yeah, if you can't measure it, you definitely can't improve it, right? If you're not measuring it, you're probably not improving it. So many great things you just said in there. I love how you mentioned that, just 4 things can get you started. If not, you just start with 2 things to see where you're at inside of your budget, and you can track those. And yeah, once people start tracking things and noticing things like working out or whatever you may be doing, you're going to appreciate that. I want to, you mentioned your son earlier. Yesterday we were talking, you mentioned that your daughter was going off, and one of these segments that we're speaking about is credit cards. Let's talk about how people can actually use credit cards, in ways that they understand, like responsibly, and some of the conversations that you have with your children.
Okay, sure. Yeah, I have 3 kids, so I have lots of practice and lots of mistakes that I've learned from over the last 12 to 18 years. So I think when it comes to credit, it's important for people to understand that there's good credit and there's bad credit. I mean, if we watch the news right now, constantly hearing about the Federal Reserve, is the Federal Reserve going to hike interest rates or cut interest rates? And, taking a step back, I always see that as like money in the economy is like oil in an engine. So when the Fed cuts rates, they're adding liquidity into the system. So it's like the economic engine can run faster. If they're hiking rates, they're trying to remove liquidity from the system, and the economy should slow. The impact that makes to people's wallets is that if you're a saver and you have cash in the bank and you're earning interest on that money, when interest rates go up, that's a good thing because you're going to make more interest on your cash. If you have credit card debt, it's the opposite. Then you have bad credit because when rates go up, it's going to cost you more, right? Money is going to be more expensive to you. And I think that's an important difference to understand. Those are probably things that I have not shared with my kids yet. I think, my kids are 18, 16, and 14. So I'm just trying to make sure that they understand the value of the dollar. All 3 are working jobs this summer. So they know how much they're making per hour And suddenly that gives them perspective when they go to the mall or they go to Starbucks and they say, wow, if I go to Starbucks, I'm going to have to work.
That's an hour.
I have to work an hour, just to buy a couple of drinks at Starbucks. And then I have a daughter who's about to go off to college, and we're going to give her a credit card to use. So, I had the discussion with her 2 nights ago. I said, the way we use a credit card is not the way a lot of people use the credit card. I'm like, we're not using the credit card to buy things that we cannot afford. We're not using the credit part of the credit card. I said, the only reason why I'm using the credit card is because it gives me 2% back. Or if you have an airline, or you get hotel points, or you get miles for travel. I said, I'm using the credit card for the benefits. Otherwise, I'm paying my credit card bill every month. And that's going to result in a higher credit score. I said, when you have a higher credit score, it's easier for you and money costs you less, because if you go to the bank, they're going to give you more services. If you needed a loan, you can get a loan. So I've been trying to teach my kids credit score, how to use a credit card. And, still goes back to live within your means. Like, don't buy things that you can't afford, because it's just going to cause you a lot of headache later.
Yeah, those are the basics of right there, right? Don't use the credit card for the credit part. That's a real big nugget that people aren't realizing. Use it for the rewards. Pay it off every month. Also, you mentioned the protections. You want to expand on some of the protections of using credit versus debit?
Yeah, I was trying to tell my daughter, because she started with a debit card first, right? We got her a bank account when she got a summer job. And now that she's going to go off to school, we want her to have the credit card so that she can start building a credit history and start working on that credit score. Because with the debit card, you don't have a credit score, because with the debit card, you're only spending what's in your bank account. But I wanted her to know that there are differences between the credit and the debit card to the consumer, because the debit card, your account at the bank puts more responsibility on you because that's your money. If you have a fraudulent charge using your debit card and you're not monitoring, the bank may say, unless you notify the bank within 60 days, that's your problem. Like, the bank's not going to make you whole. You need to monitor your own bank statement. But with the credit card has more motivation to monitor for fraudulent charges, because that's their money. Because they're fronting you, right? They're giving you credit. Mm-hmm. If there are fraudulent charges on your credit card, you have a much longer period. I think almost any time you could tell the credit card company and say, hey, this was not me. Which is why the credit card company is constantly monitoring your charges, things that are out of the ordinary. Like if you're traveling, they may call you and say, hey, you just had a charge outside of the United States. Is this you? Because they don't want that to run up, because that becomes their problem. So from a consumer standpoint, the credit card has more protections for you than the debit card. But of course, that comes at the expense of, you have to know how to use your credit card well and not run up your credit card bill and be paying 20% interest every month.
Great explanation. And yeah, I don't think a lot of people actually do realize like the added layer of protection that you get from using the credit card. But as with all things, for every gimme, there's a gotcha. So you do have to rely more on yourself if you do use that debit card, but you're not going to overspend and go over your credit limit. I want to, great points. I want to expand a little bit more. We were talking, me and Andy had a great conversation for anyone watching and listening yesterday. We could have recorded that and it could have been a podcast. It was really good.
He said we should have recorded that. Maybe that would have been, more fun.
No, this is very fun. This is very fun. And thanks for anyone watching on YouTube, LinkedIn, people who are watching later, X, these usually get a lot of replays. So we want to thank everyone watching. Leave comments. We're going to answer some of the questions here in a little bit that people have already left in comments from before we started. One of the things that I want to talk about here, Andy. So I saw a commercial. It was an old commercial, and it was a young adult lady asking her dad for like financial advice. I'm going to butcher the statement that he responded, but it was something to like, she asked him something about saving or what should I invest in? And his response was the camel with the biggest hump has the most water. Like, these are the conversations that people are having. Like, growing up in my house, we didn't have very many conversations about financial literacy. Clearly, with your folks working in the industry, y'all probably have more conversations about financial literacy. What are you seeing with conversations of financial literacy just outside your home, people you knew?
I think that generally people are curious and they're trying to learn. I mean, just like I was saying that, you know, there's so much information out there. There are opportunities out there. If you want to start a business and you want to do something online, there are so many podcasts like your show. There are YouTube channels. There are so many resources to get people on the right track because there's a gap, right? If you're not getting it in school, traditionally, you learned about money because now you're out in the real world. It's like once you left school and you're working, you're learning generally by making mistakes, which is why you hear so many stories about people who got a credit card in college and, you know, they're just ordering, they're living it up. They're ordering pizza and beer every Friday, but they're not working. So suddenly it's like you have a $5,000, $10,000 credit card bill. Then maybe you start working and, you know, your salary is not that high and you're going out on Friday night. So suddenly that balloons to like, you know, $50,000 in credit card debt. That's a problem. Too many people are learning by doing and learning the hard way. It's like you made your mistakes, you recovered from them, and you said, all right, well, I learned my lesson. I think the benefit of having like the internet, having YouTube, having podcasts is that we can hear so many people sharing their stories, whether it's the things they're doing right or the things that they did wrong. It can save us from making a lot of those mistakes on our own. I think that people want to learn. There are a lot of people who are trying to learn. I think one of the challenges, you know, we even have ChatGPT. We have AI now. You can ask anything to AI, and it's giving you generally pretty good information. It's a process. I mean, you know, sometimes the risk is always that AI answers so authoritatively. It sounds like it's right, and it's not always right. You know, what I see is that I see prospective clients coming to me because they have done like preliminary prompting to AI. So then they come to me and they're asking better questions kind of further along, but they're not always knowing what questions to ask AI. Like, you have to know what to prompt, right? I kind of say that it's like if my refrigerator has a problem, I'm going to